Hello students, now we move on to another very important and interesting standard, which is Accounting Standard 10, that deals with property, plant and equipment. Now whatever you have learned earlier in terms of fixed assets is getting covered under this particular standard. Before we start the standard, let us get our basic logics right so that we have a correct understanding of which standard is applicable in which scenario. If I were to ask you, forget you have started learning accounting standard, when you learned accounting in 11th and 12th standard, whenever there was a question or whenever there was an item, let us say the company purchased land. Now when I say the company has purchased land, where will you show this land in the balance sheet? Immediately your response would be, sir, we will classify this as our fixed asset in the balance sheet. Now I want you to stop that approach, and before classifying a particular item as a fixed asset or property, plant and equipment, ask some questions. What are those questions? Number one, what is the use? What is the use? Understand what is the business. Based on these two questions, only then you can classify the items correctly. For example, if I tell you this land was actually purchased by a builder. Now, why will the builder purchase land? The builder purchases land so that they can construct flats or they can build homes and sell it to customers. So, the land is purchased for what? For sale in ordinary course of business. So, if I am purchasing something in the ordinary course of business, I cannot call it a fixed asset. I have to call it, what do we call? Inventory. I'll call it what? Inventory, and this will be covered by Accounting Standard 2. If I change the argument and say, sir, this was purchased for capital appreciation or to earn rental. The land or the land and building was purchased to earn rental income for capital appreciation purpose. It was not for sale to the customers. Then in that case, I will classify this as my investment property. Sir, which standard deals with investment property? AS 13 doesn't deal in depth, but AS 13 deals with investment property. So, depending on why have we purchased the asset, what is the use of that asset, we will do the classification accordingly. But if I tell you this land was purchased to construct a building, ultimately we will use it for our office, then you can call it, sir, this is a property, plant and equipment, this is an item of fixed asset. I hope it is clear. One more example. Computers. You can purchase computers for sale. Like if you are a computer dealer, you have purchased a computer for selling it to the customers. Will that be a fixed asset? It will not be a fixed asset. It will not be a property, plant and equipment. But you purchase the computer, and what is the purpose of purchase? The computer is purchased for the purpose of accountant. The accountant needs a computer to pass day-to-day journal entries, to prepare the GST returns, to prepare TDS return. The accountant needs a computer. You are in a computer business. You are running a computer business. You buy and sell computers, but this computer is for accounting purpose, invoicing purpose. Then in that case, this will become property, plant and equipment. Here it will be classified as inventory. I hope it is clear. This basic distinction is very, very important for us to understand what gets covered in AS2, what gets covered in AS10, and what gets covered in AS13. Then we also have a standard called Accounting Standard 26 that deals with intangible assets. So, intangible assets like software, trademark, copyrights, all of these are dealt by which standard? Accounting Standard 26. If something does not have physical substance, you will take it to Accounting Standard 26. If something has physical substance, then you will cover it in Accounting Standard 10. Alright, now with this understanding, let us see what are property, plant and equipment. Property, plant and equipment are tangible items. If it is intangible, AS 26. In Schedule 3 balance sheet also, you have property, plant and equipment and intangible asset. Two separate heads are given. Okay, accordingly you should classify. Which are, now this is the most important part, Held for use in production or supply. Held for use. We will not sell them. Of course, if it becomes, scrap, or if it is no longer useful, we may sell it. But otherwise, it is held for what? It is held for use. So, intention of the company or the business is to use this asset in the business. So, why will it be used? Say, for example, you have a factory. In that factory, you have a machinery. Why will you use that machinery in the factory? To produce goods. Okay. Or let us say you have a truck which is used to dispatch goods to the customers. It is used in supply of goods. Or you have some other kind of machinery which is used for production or supply of goods. That is one aspect. Second aspect is supply of services. For example, you are watching these classes. I am providing you teaching services. Now, what are the property, plant and equipment in this particular studio? I have the camera, I have the iPad, I have my MacBook, I have the studio lights, I have the air conditioning system. All of these are what? These are used in supply of services. So, whenever we say property, plant and equipment, they are used in production or supply of goods and services. That is the first category. So, for your understanding, whenever you go out and look at a factory, all the machinery and equipments you see there, those are property, plant and equipment. If you go to a retail store, there you may see furniture fittings, there you may see items related to air conditioning, there you may see the invoicing system. All of these are property, plant and equipment. Then this is the first category, use. Second category is rental. Second category is rental. For example, I am in a taxi business. I am in a tours and travels business. I provide cars on rent. Okay, so I purchase the car. My business is to provide the car on rent. So if I have a car which I am providing on rent, that car is my property, plant and equipment. Sir, but you said if it is a land or building that you are giving for rental purpose, that is more for investment. Okay, so ACE 13 specifically covers land and building which are to be given out for investment purpose. I don't buy car for investment purpose. If I am buying a car, either I am using it in my business. Let us say I am giving it to my director. In that case, it is my property, plant and equipment. Or I have purchased that car to give it on rent to others. Then also it is my property, plant and equipment. Then third use is administrative purposes. Lot of property, plant and equipment are not directly required for production or supply of goods and services. For example, let us say there is an office. Okay, in the office premise, we have air conditioning system. We have installed AC. Now the business can function even without AC. AC is not mandatory. But for the comfort of my employees, for the efficiency of my employees, I have installed the air conditioning system. Now that AC does not directly supply or produce goods and services, but it is indirectly helpful in the overall functioning. So that is called administrative purpose. Say for example, there is a company with lot of branches. You have a corporate head office. Now corporate head office is not directly into supply of goods and services, but what are they doing? They are administrating. There is a centralized mechanism, centralized head office which controls the entire operations of the company. So assets which are used for administrative purposes are also classified as property, plant and equipment. Okay, sometimes what may happen is a company may be installing these chimneys more than the legal requirement as a part of the environmental concern. Maybe 5 meters is sufficient, but because they care about the environment, they have installed a 10-meter chimney. Without that chimney also they can operate, but they are doing it for environment purposes, for administrative purposes. So such categories are categorized under this administrative purpose category. So property, plant and equipment are tangible items which are held for use in the production or supply of goods and services, for rental to others, or for administrative purpose. So why I'm re-emphasizing this, because if at all a case study based question comes in the examination, you must know the definition. All right, and it is expected to be used during more than a period of 12 months. So the threshold criteria is what? 12 months. So you have to use that particular item for more than 12 months. Okay, so this is the definition of property, plant and equipment. Now there are some aspects around what is included, what is excluded, what are bearer plants and all of that. This will come towards the end of the standard. Okay, right now we'll focus on the core part of the standard. Now This standard, as well as most of the asset and also liability based standard, talk about initial recognition. Means when should we recognize an item in the books as an asset or as a liability or as a revenue? When should we recognize? Recognition means when can we pass the journal entry? So this is about initial recognition. So it talks about initial recognition. Then it talks about measurement. To pass any journal entries, you need the date. Okay, date is given by initial recognition. Then you need the amount. Amount is given by your measurement. What is the amount, or at what amount should I record that particular item is given by measurement. Then there is measurement at initial recognition and there is measurement subsequently. How do I measure the asset subsequently? So in case of property, plant and equipment, accounting standard 10 tells us when should you recognize PPE first, at what value should you recognize PPE, right? Then subsequently, how should you measure it? How should you charge depreciation? What are the aspects related to revaluation? All of that is covered. Then when do you de-recognize? When do you bring into the books? Recognition. When do you move it out of the books? De-recognition. And also disclosure related aspects. Okay. So now we'll talk about what is the recognition criteria. What is the recognition criteria? As far as recognition criteria is concerned, whenever we talk about PPE, PPE means what? In the balance sheet, under non-current asset, we show property, plant and equipment. Property includes your property like land and building. Plant includes your manufacturing plant, etc. Equipment includes other items like furniture, air conditioning system and all of those things. Okay. So when can I recognize an item of PPE in the balance sheet? Indirectly, I am asking, when can this PPE item be shown as an asset in the balance sheet? Recognition means when can I show this item as an asset in the balance sheet? So the criteria for recognition of PPE is very simple. The first criteria is it has to meet the definition of an asset. It has to be an asset. Asset means I should be in control of that particular item, and future economic benefits associated with the item should flow to the entity. So whenever I say that this particular item is an asset, I am making two claims. One, it is a resource controlled by the enterprise. Any asset is a resource controlled by the enterprise. Sir, what is the meaning of control? Control means I can decide how to use the asset, when to use the asset. I can prevent others from using that asset. So that is when it is a control thing. And the future economic benefits, whatever is the benefit associated with that asset, will flow to the entity. Now, what are the benefits we are talking about? The benefits we are talking about is, for example, there is a manufacturing plant. What is the future economic benefit? The plant will manufacture products. Those products will be sold in the market. We'll get cash. We'll get debtors. Those are the benefits. If I have a car, I'll give that car on rent. That is the future economic benefit. See, there may be a loss or gain. That I'm not talking about. I have an asset. With that asset, I am able to produce something. I am able to supply something with which I will get future economic benefit. This you need to remember, a very important term. Future economic benefit will flow to the entity. So if I have this camera, I'll use that camera to record the content. I am selling this content to the students. I am getting future economic benefit. Okay. So future economic benefit should flow to the entity, and cost of the item can be measured reliably. So what is this cost of the item can be measured reliably? I must be able to measure what is the cost of that particular property, plant and equipment. Okay. So there are two things. One, future economic benefits should flow to the entity. Second, I should be able to measure the cost of the item reliably. In case of property, plant and equipment which are purchased, generally we will be able to measure this cost reliably. Measuring cost reliably means what? At what price did I purchase that asset? For example, I purchased this camera. What is the cost of this camera? Can I tell that? Yes, then you can recognize. Will future economic benefit flow to the entity? Yes, then you can recognize. But sir, what is the scenario where we have purchased an asset and future economic benefit will not flow to the entity? Say for example, I purchased a computer. Instead of using that computer in the business, I donated that computer to a charitable trust. Now tell me one thing, will future economic benefit flow to the entity? Of course not, because charitable trust is using it. I am not using it in my business. Hence, this condition is not met. I cannot recognize PPE. Sometimes what may happen is, we may be constructing roads. We have constructed roads for access to the factory. We have constructed road for access to the factory. But that road can be used by public also. Means I cannot solely control that particular asset. In that case also, I cannot recognize the item as PPE. Okay, so the condition is future economic benefit should come to the enterprise and cost must be measured reliably. Now we have understood what is the initial recognition requirement for PPE. What is the initial recognition requirement? First thing is, it has to give us future economic benefits. So the future economic benefits must flow to the entity. Second, the cost must be measured reliably. As far as the cost aspect is concerned, generally we will be able to measure it. In some cases we may not be able to measure it. In that case also we will see what is to be done. Now one question that may come to your mind is, sir, if the recognition criteria is not met, then what is to be done? If the recognition criteria is not met, we cannot show that item as an asset of PPE in the balance sheet. Hence, we will have to expense it off in the P&L. Basically meaning, if the recognition criteria is not met, the expense will be treated as a revenue expenditure and we will show it as an expense in the balance sheet. Alright, so that is about initial recognition. Now moving on to the next very important part, which is measurement. At what amount should I record the item of PPE in the balance sheet? At what amount should I measure? Now there are three categories. One is when you purchase the PPE. Second is when you do a self construction, and the third one if you exchange assets. You also exchange, right? You give your old mobile phone and get new mobile phone. In that case, what is to be done? Now first part, as far as purchase is concerned, whatever you have learned in AS2, similar principles are applicable here. Okay, so if I am buying an item of PPE, say for example the camera or air conditioner or a truck or a plant and machinery item, what is the cost? The standard says all of these items you should consider as cost. Apart from these, you should not consider them as cost. Okay. Second, for self-constructed asset, we will see what is our cost of construction and accordingly we will determine the amount. And exchange, there is a separate discussion which we will understand later. Now the fundamental principle of initial measurement is that an item of PPE should be initially measured at cost only. There is no other basis. What is the cost you have to determine, and based on that cost you have to measure the item of PPE. Okay, so first is you have to measure the item of PPE initially at cost only. Subsequently we can measure it at fair value, that will come later, right? Now the question is, how do we determine the cost? How do we determine the cost? Let us say we went and we purchased an item of property, plant and equipment. Now when you purchase basic things, let us say we purchased a car. We purchased a car. Now on that car, let us say the cost of car is 10 lakhs. On this GST, I am taking a round figure number 20%, 2 lakhs is paid. GST of 2 lakhs is paid. Then GST of 2 lakhs is paid. Then road tax of 1 lakh is paid. Okay. Then we threw a party. Because we purchased a car, we threw a party. For this, we spent another 50,000. So who spends 50,000 for a car? Just for example. Okay. Now, what should be the cost of PPE? First thing that you have to ask, or the most important thing you have to ask is, what are the directly attributable costs to bring the asset to the location and condition necessary to operate for the purpose intended by the manager? What are all the costs that will be incurring to bring that asset to the condition and the location necessary to operate as intended by the management? So all those costs should be included. After that, any cost we are incurring, we should not include. That is the first thing. Okay. So in this case, is this cost relevant? Yes, this cost is relevant. This cost I have incurred to buy the car. GST, do I need to pay GST? Yes. Now the question is, will this GST form part of my cost? will this GST form part of my cost? Now here the thing that you have to understand is, if this GST is refundable or recoverable, or if I can adjust this against my liability, basically if I can get an input or if I can get a refund. So will the government refund GST? Yes. If you meet some export obligations, they refund. Even import duties in some cases are refunded. Okay. So if this GST is claimable, if it is refundable, then we will not consider that as a cost of the asset, because I am getting a separate benefit out of it. Okay. So this 2 lakhs will not be considered if input is available. Now, as far as cars are concerned, if I am buying a car for my office purpose or office use, I cannot get GST credit. This is an item of blocked credit. You will understand that in taxation. So, this GST, I will not get credit, and hence I will include it as a part of my cost. Then, road tax. Now, without paying road tax, I cannot run the car on the road. So, this will also be a cost of my car. Okay, so all of these will become the cost of the car. Now this party expenses, now this party is my discretionary expense. Even without throwing that party, I can run the car, I can use the car, so that will not be included. Initial inauguration cost, ribbon cutting cost, and all of those are not included. Now to give you another example of all the directly attributable costs, say for example I need an air conditioner. I have purchased the air conditioner. So the price that I have paid, the purchase price that I have paid to buy that air conditioner, it is included in the cost of PPE. Then I would have paid some GST. Now if this GST is refundable, don't include. If GST is non-refundable, then include. Non-refundable means if I cannot take credit, or if I have chosen not to take credit, then you can include the cost. Okay. To this we will add any non-refundable taxes and duties, generally import duties, entry tax, purchase tax. The question will tell you whether it is refundable or non-refundable. Okay. Then initial delivery and handling charges. I purchased the AC. Now that AC cannot sit in the showroom of the supplier. I have to get the AC in my office. So that AC, the cost to bring that AC from the supplier location to my studio, that also will be added. Okay. So this will basically include your transport charges, loading, unloading, all of those things. Then cost of site preparation. Sometimes to install that particular asset, I have to do some leveling of the surface. Let's say a machinery has to be installed, I have to level the surface, or I have to put a concrete slab. Let us say to install this AC, I need some structural changes to be made in my office setup. So that also will be included. Installation. The installation guy will come, he will install the AC, the outdoor unit, copper wires would be used, all of the costs will be included. Then professional fees. Professional fees means if I have taken some professional help or professional advice. This typically happens in case of, let us say, if I have to construct a building, I'll go to an engineer, I'll go to an architect, I'll go to an interior designer, I'll incur those professional costs, that will also included. Then borrowing cost as required by AS 16. This you will understand in AS 16, what are borrowing costs, what are the costs to be capitalized, and what are the costs to be expensed. Now what accounting standard 16 says is, if you have borrowed money to acquire or construct a qualifying asset, the borrowing cost should be capitalized. Okay, so principles and all we'll learn in AS 16. Then cost of testing. Sometimes once the machinery is installed, we may have to carry out trial runs, we may have to carry out trial testing. So if there is any cost of testing that is involved, that also should be capitalized. Now sometimes while testing, we may get some output. That output we may sell it in the market. So the proceeds from sale of product should be reduced. So for example, cost is 1000, cost of testing is 1000, we got 600 as revenue from sale of product. So 400 is the cost. Sir, what if this revenue is more than the cost? Then that amount will be reduced from the cost of PPE. Okay, but what? Only the cost of testing. Cost of testing. Sir, how do we know whether it is testing or not? See, once the asset is ready for use as intended by the management, then testing and all is over. Okay, this will come to it later. Then we talked about any directly attributable cost. So say for example, when I purchase the AC, I want that AC to be installed in the wall in front of me. So whatever is the cost to bring the AC from the supplier to my studio to install it, all of that is included. Later I realized that the AC blows out cold air and it hits my head and I am getting headaches. Now because of which I want to remove it from that place and put it on the left side of my office. Now that uninstallation cost and reinstallation cost cannot be capitalized. So why? Because only those costs which are incurred to bring the asset to the condition and location to be operated as intended by the management. So that will be capitalized, right? Subsequently, if we are uninstalling and reinstalling, that cost cannot be capitalized. Now, such costs are generally expensed out, and we can capitalize those subsequent costs only if we get more benefit in the future from that particular asset. So that we'll discuss sometime later. So the thumb rule is all the cost incurred till the time the asset is ready to use will be capitalized. Subsequent cost will be expensed. Subsequent cost will be capitalized only if we get excess future economic benefit, which we'll be discussing separately. From the cost of PPE, we will reduce number 1, government grant as per accounting standard 12. So this you'll understand in AS 12. If there is a government grant received and the entity chooses to reduce it from the cost of fixed asset or PPE, they can do that. Second, trade discounts and rebate. So there are two types of discount. One is called the trade discount. Another one is called cash discount. Trade discount is negotiated at the time of purchase. If I have negotiated a trade discount at the time of purchase, let us say 5% trade discount, I will reduce that from the cost of the asset. Whereas if it is a cash discount is given for prompt payment. The supplier says, if you pay me within 30 days, I will give you 1% discount. This is discount for prompt payment that will not be reduced from the cost of PPE. So what will be reduced? Only trade discount and government grants. Okay. So once again, quickly, you will take the purchase price, you will take the non-refundable duties and taxes, initial handling cost, initial delivery charges, installation, professional fees, cost of testing, right? Then any cost that is incurred to bring the asset to the location and condition to be operated in the manner as intended by the management. This you have to remember. Keep on repeating and you will be able to remember. And we will reduce government grant and trade discount. That will give us the cost of property, plant and equipment to be capitalized. Now, there is one very important aspect in this all, that is present value of decommissioning and restoration cost. Pay 100% attention. If required, watch it 2 times. Concepts must be absolutely clear for this. Very, very high chances of being tested in the examination, and at the final level also, this is very, very important. Now, to understand the next important thing that I talked about, present value of decommissioning cost and all. So here you can see on the screen a refinery. Okay. Say for example, a company, there is a refiner or there is a company which is into petroleum business, they want to set up this particular refinery. The government says, okay, I will give you a land on which you can set up the refinery and you will run the refinery for 30 years. You will run the refinery for 30 years. Till that time you have permission. Okay. Or maybe, the crude oil that is available nearby that area is only available for 30 years. So that is the condition given. So what does the company do? The company is constructing these particular assets. Company is constructing tanks, the plant and machinery and all of those. They would be acquiring something. All of that is done. Now what the government says is, for 30 years you run the refinery. You carry out your operations, right? You follow the environmental norms and all of that. But after 30 years, what you have to do? You have to remove this entire setup. You have to remove this entire setup. You have to level back the land. You have to maybe plant some trees and all of that. You have to restore the place. You have to restore the place. You have to decommissioning your plant. You have to decommission your plant, means remove all these tanks, remove all the machineries and all, take it to a different place. Then there would be a lot of environmental pollution nearby. You have to clean up all of that. So after 30 years, you have to do that. After 30 years, you have to do that and hand the land back to the government. Now, maybe the construction of refinery would have costed, let us say, 1,000 crores. Construction costed how much? 1,000 crores. This is the cost incurred today. To carry out all of this cleaning up activity, we call it decommissioning and restoration activity. Decommissioning means, commissioning means start, decommissioning means stop, restoration means to bring it back to its original condition. So the refinery has a cost of 1000 crores today. It has a cost of 1000 crores today, and after 30 years, to restore and all of that, to decommission and restore, let us say you have to spend another 100 crores at that point of time. So today you have incurred 1000 crores. After 30 years you have to incur how much? Another 100 crores. Now this 100 crore, is this the cost only for the 30th year? Can I say, because I am incurring the 100 crores of cost in year 30, I will charge the entire cost to year 30 P&L? If you do that, the matching concept will be violated. Sir, why? Because this 100 crores is being incurred as I have started the refinery today and I am operating the refinery over a period of 30 years. So it is not appropriate to say that this cost of 100 crores is purely belonging to the 30th year only, because I am operating the factory for 30 years. I am operating the refinery for 30 years. I have got the benefit for 30 years. To correct the, so whenever I have to restore and decommission and all of that, that 30th year cost of 100 does not only belong to 30 years, it belongs to all of these years. It belongs to all of these years. Now what the standard says is, because this obligation at 30th year of 100 has arisen because we have started the refinery today and we'll get the benefit over a period of 30 years, you should add this to the cost of refinery itself. So this cost is the cost related to overall refinery. The obligation has arisen because we have constructed the refinery. So because it is attributable to construction and operation of the refinery, this 100 crores also should be added to this 1000 crores. Now one thing you should understand, that this 100 crores we are incurring after 30 years. So this has to be added to today at present value of 100 crores. We cannot add 100 crores. We have to compute the present value of 100 crores and add that to the cost of refinery. Okay. This is related to construction. Similar thing may be required maybe for purchased assets also. Say for example, a company purchases a ship, and as per the rules and regulations of the government, after 10 years, 15 years, 20 years, whenever the ship's life is over, you have to break down the ship and you have to dispose of the ship. So that cost is also incurred. So such costs which are incurred for decommissioning and restoration at present value is added to the cost of machinery. Now to understand this, let us take a very simple example. Cost of a machine. Cost of a machine is 10,000. Life of the machine is 3 years. Decommissioning cost after 3 years is, let us say, 600. You have to spend 600 after 3 years for decommissioning. Okay. And appropriate discount rate is 10%. Now all of us know that future value is equal to present value into 1 plus rate to the power of n, or present value is equal to future value divided by 1 plus rate to the power of n. So this is a future value and I need the present value. So how much is the present value? 600 divided by 1 plus 10% to the power of 3, which is 600 divided by 1.1 to the power of 3. This I can write it as 600 into 1 divided by 1.1 to the power of 3. So 1 divided by 1.1 is equal to once, 2 times, 3 times, I get 0.751. So this is equal to 600 into 0.751. This 0.751 is also called as present value factor of 10% for 3 years, which means if I will receive 1 rupee at the end of 3 years, The present value is 0.751. So how much is this? 600 into 0.751, I get 450.6. I am rounding this off to 450 for ease of calculation. Okay, but in examination you will take 450.6 only. So cost of PPE is equal to 10,000 plus 450, that is 10,400. Now, whenever you depreciate the property, plant and equipment, you will consider 10,450, which means this cost of 450 in present value terms is automatically charged to the P&L. Okay. Then second thing what we need to do is we need to prepare a interest schedule, which is also called as unwinding of discount. See, we have discounted 600 and brought it to present value. So this difference of 150 has to be accounted. So here 1, 2, 3, opening balance, interest at 10%, closing balance. 450 interest is 45, closing balance is 495. Opening balance 495, interest is 49.5. So 495 plus 49.5 is how much? 544.5. Then 544.5, 54.45. We get 598.95. So in examination, what we will do, to round it off to 600, we will treat this as a balancing figure. So 600 minus 544.5, we get, this will be 55.5. So this interest expense will also be charged to P&L every year. So you would say interest expense 45 to provision for decommissioning 45. At initial recognition, the entry that you will pass is debit property, plant and equipment at 10,450, credit cash 10,000, credit provision for decommissioning expense 450. So this 450 is your liability. This liability, by adding interest every year, will ultimately become 600. So every year when you charge the interest expense, you will debit the interest expense and credit the provision for decommissioning. This is a very basic example. As we do questions on decommissioning, liability and all, you will have more clarity on how is that handled. So what is included? Present value of decommissioning restoration cost is included. Okay, right now we just need to know how to calculate this present value. Subsequent accounting and all, when we understand depreciation, when we look at some more questions, it will be more clearer. All right. So this is one thing which you need to keep revising and remember. And in the examination, when you get a question from this, it is very simple and straightforward. For each item, you will be given marks for correct treatment. Okay. So even if you make a mistake here and there, out of 5 marks, 3 to 4 marks can be scored. Now we have understood that what are the costs to be included in the cost of PPE. The standard also gives us specific items that have to be excluded from the cost of PPE. Excluded means we should not consider them as the cost of property, plant and equipment. Now what are those? First one is cost of conducting business in a new location or with a new class of customer. Say for example, I want to expand to a new city. Okay, I want to expand to a new city. I want to open a branch in a new city. If I have to open a branch in a new city, I have asked 5 of my employees to relocate to that particular city. Now, if I've relocated those employees, the cost incurred in relocating those employees is not my cost of property, plant and equipment. Okay, see, if I have purchased a branch office there, if I have purchased a building there, that is definitely my cost of PPE. Relocating my employees, the cost incurred to relocate my employees is not my item, is not my cost of PPE. Now here the reason is, though I am incurring the cost, I don't have control over the employees. The employees may leave, I may not get business. Okay, all of those things are there. So these are my day-to-day operating expenses and I don't get any tangible property, plant and equipment out of this. So similarly, let's say I want to deal with new segment of customers. Okay, the customers are based out of Middle East. I have relocated 2 employees to that particular place. That cost of relocation, salary expenses and all are not cost of PPE. If such costs are incurred, even if those costs are incurred, we will not capitalize, we will expense them. Then cost incurred in introducing a new product or service. We have, let's say, a launch event. We are doing some advertisement for marketing our product or for marketing of the new launch. We did a press conference. Okay, we did some road shows. All of that are not included. Cost of opening a new facility, inauguration expenses, ribbon cutting expenses, what I call. These are also not considered to be a part of cost of PPE. And administrative and other general overhead cost. So if there is any administrative overhead, if there is any administrative expense, if there are any general overheads which are being incurred, these are also not included in the cost of PPE. If the overhead is specifically incurred for the PPE, then that is included. For example, if I am incurring cost on a security guard who is exclusively taking care of the construction site, then that can be included. But security guard expenses of the corporate head office, I want to allocate that overhead expense to the cost of PPE, not. So in the examination you have to see, if it is general overhead cost, you will not capitalize because that cost anyways you would have been incurring. If it is a specific overhead cost or if it can be allocated on a reasonable basis, if it is related to that activity, only then you will capitalize. So these are also important for you to remember. Then of course, if there are any abnormal losses, if there are any abnormal wastage of material, if there is a strike because of the work could not happen, all of these costs are also excluded. So this principle, what we have learned, is for calculating the cost of PPE for purchased assets or acquired assets. Then we have cost of self-constructed PPE. Same principles. Now self-constructed means what? The company or the entity on its own is constructing the PPE or building the PPE. For example, the factory premises. For example, the machinery. You can build machineries on your own also, right? So if that is happening, how should we calculate the cost? Two principles you have to keep in mind. One, all the cost which are required to be incurred to bring the asset to the condition and to the location to be operated as intended by the management. That is the fundamental principle. Everything has to be taken at cost only. You will not take any internal profits or you will not take market price. For example, labor. Now, labor cost for us is 10,000. Market price, if I have to get a labor from the market, I have to incur 15,000. You will not take this. You will take only cost of 10,000. Sometimes what may happen is the same company may have two divisions. Let us say there is a construction division and there is a operating division. This construction division is doing the construction for the operating division. They are constructing a factory. There is an arrangement that the construction division will invoice the operating division at cost plus 15%. Okay, so what the construction division does, it carries out construction activities for other businesses in the company. Whenever it carries out construction activity, it says it charges the other division at cost plus 15%. Now you may have a doubt, sir, is there actual payment happening? Actual payment is not happening. It's like, let us say I am the construction division, you are the manufacturing division. Okay, you want a plant to be constructed. You say, okay, construction division, you have to construct a plant for me. I say, okay, fine, I'll come and construct. Now, whenever I'm constructing the plant, what I'll say is, okay, if my cost is 10,000, I will charge 10,000 plus 15% from you. Sir, why is that the case? Because I also have to show that, yes, I have provided services worth 10,000 plus 15%, that is 11,500. Okay, so I have to show, yes, I have also made a profit of 1,500. It is not an actual profit, but notionally I have made a profit of 1,500. If the manufacturing division would have gone outside and got those services, they would have paid 11,500. I am providing the services at 10,000. Does not mean that the manufacturing division is efficient. I am efficient. So this profit I will charge for my internal reporting purposes. Okay. So if there is any internal profit, that should be excluded. That should be excluded. So what are included? Cost of construction that directly related to the asset, cost that can be attributable to the construction activity, Borrowing cost if it is a qualifying asset. What are excluded? Internal profit. Always take the cost and not the selling price or interdepartmental transfer. And the cost of abnormal amounts of wasted material, labor or other resources are also excluded. Very simple and straightforward. So we have seen two scenarios, purchase and self-construct. The third is PPE acquired by exchange of non-monetary asset. Here I'll have to give some examples so that it is clear. So whenever we talk about assets, there are monetary assets and non-monetary assets. So you have monetary assets and non-monetary assets. Monetary assets are those assets whose amount is determined in monetary terms. Means what? Say for example, if I have cash 1000. Now this cash of 1000 is fixed. It is determined in monetary terms. I know I have a cash of 1000. I can go to the government and say, government, you have made a promise that you will pay me 1000 rupees. So this 1000 rupees is the cash with me. It's fixed. It will not change. Okay. Or trade receivable. Let us say 5000. Somebody has purchased goods from me or services from me. I have to receive 5000 from the other party. Will this 5000 change? It will not change. I can go to the customer and say, boss, you have agreed to pay me 5000. Please pay me 5000. That amount is fixed. It does not change. It is a different thing that the customer may default. Customer may not pay. But I can still go to the court and claim 5000. Amount is fixed. Or if I have a FD with bank, if I have given a loan to someone, all of these cases, the amount is determined in monetary terms. It is fixed in monetary terms. Hence, these are called monetary items. This you will understand further in AS11. So then what are these non-monetary items? Non-monetary items are those items other than monetary items. Means amount is not determined in monetary terms. For example, fixed asset. See, fixed asset you may show at 1 lakh in the balance sheet. Okay. Can you quantify the monetary benefits? No. If you sell the asset, will you get 1 lakh? You don't know. Okay. Same way, inventory. Inventory is shown at 10,000. Is it a monetary or non-monetary asset? See, the value we have decided 10,000. But do I have a right to receive 10,000? Can I go and ask 10,000 from someone for the inventory? No. It depends. When this inventory will become trade receivable, then it becomes a monetary item. So non-monetary items are those items whose amount in monetary terms are not fixed. For example, equity or owner's fund. Now, the amount that the owner will receive when the business finally gets wound up, that is also not known. So this also is not fixed. Whereas loans, the amount is fixed, and hence that is called a monetary item. Okay. So this is the distinction between monetary and non-monetary item. Now, what the standard says is, whenever there are exchange of non-monetary asset to acquire a PPE, means I am acquiring a property, plant and equipment, but I am not giving a monetary asset. I am not paying by cash. I am not incurring a liability. By the way, creditor is also a monetary item. It's a non-monetary item. So I am giving some non-monetary asset to acquire a property, plant and equipment. For example, I have a parcel of land. Cost of the land is 10 lakhs. Fair value today, if I have to buy this particular asset, it is 50 lakhs. Okay. What I did was, I gave up this land. I transferred the land to the other party, and from the other party, I purchased, in return, I purchased a machinery. Now, this machinery normally is sold in the market for 55 lakhs. Okay. What is there? I have a land, cost is 10 lakhs, fair value is 50 lakhs. I purchased a machinery normally which is sold in the market at 55 lakhs. Now tell me one thing. You can maybe pause the video and tell me at what value will you record the machinery which has come to your books? Because land we have given up, land we have transferred. We got what in return? We got machinery in return. This machinery, at what value will you show it in the balance sheet? At what value will you record it initially? What will be the measurement value? Right? Will you record this at 10 lakhs? Will you record this at 50 lakhs? Or will you record this at 55 lakhs? Always remember, and this principle keep in mind when you are doing CA final also, whenever we are acquiring something, let us say I have purchased a camera. What will you measure at what value will you measure the camera at? You will measure the camera at amount of cash paid, correct? So here also, machinery you will record at what is the amount of asset given. What is the amount of asset given? Now here, amount of asset given, will I take 10 lakhs or 50 lakhs? See, normally common sense if you apply, I have given something worth 50 lakhs. So I will take fair value of asset which I have given. I will take fair value of asset which I have given to record the machinery. Means I will say machinery account debit 50 lakhs to land account 10 lakhs, and I'll say profit on disposal of land 40 lakhs. So think of it like I sold the land in the market, I got 50 lakhs from the land and I purchased the machinery. Okay, so what will you take? You will take amount of asset given up, that is fair value of the asset given up. So whenever there is an exchange of non-monetary asset to acquire a property, plant and equipment, you will measure it at fair value of asset given up. That's the first. Sometimes it may happen that the fair value of the asset given up is not known. Let us say I gave a painting. I don't know the fair value of the painting. There is no market for that. In that case, what will I do? If fair value of asset given up is not known, second we will go to fair value of asset received. That is, we say if the fair value of asset given up is not known or not evident, we will take fair value of asset received. In that case, it will become 55. Sometimes we may know fair value of asset given up and we may know fair value of asset received, but fair value of asset received is more evident. It is more reliable. Why? Because the asset that I have given up is a land. I may get a customer, I may not get a customer, I may be able to sell, I may not be able to sell. But this asset received is regularly traded in the market. It's regularly bought and sold in the market. So I know the fair value. I can go to 10 suppliers and get the price of the machinery. So if the fair value of asset received is more evident, then we will take the fair value of asset received. Now in the examination, for you to remember, you will take fair value of asset given up or received, whichever is more evident. If both are equally evident, then you will take given up. Always first priority is given up, second priority is received. Then you will check which one is more evident. Sir, what if the fair value of asset acquired is also not known? Fair value of asset given up is also known. Say for example, I want an antique car from my business. I gave up some other antique piece for that. The fair value of both of them is not known. If fair value of both of them is not known, that is, if fair value is not available, then we will take carrying amount. We will take carrying amount. What is the amount recorded in my book of the asset that I have given up? That is what I will take. Okay. So when it comes to PPE, which is acquired by exchange of non-monetary asset, we have to check whether fair value of asset required or given up can be measured reliably. If yes, we will take the fair value. Always fair value of asset given up is the first priority, then fair value of asset acquired is the second priority. If fair value of asset acquired is more evident, we will take fair value of asset acquired. Then if fair value cannot be measured reliably, then we will take the carrying amount. We will take the carrying amount. All right. So this is one decision to be taken. The second decision that has to be taken is, does the transaction have commercial substance? This is one more question to be asked. So one is you check the fair value and all. Normally you will get questions in the examinations with transaction having commercial substance. But if the transaction does not have commercial substance, then what is to be done? For that we need to understand, sir, what is this commercial substance? Say for example, I have this calculator. I give this calculator to you. I take Casio calculator from you. I have given my ORPAT calculator to you. I have taken your Casio calculator. Now, because of this exchange of calculators, will my computation be faster? No. Will I save so much of time in my teaching or you in the examination? No. It is just a calculator. Your business did not change. My business did not change. Our operations did not change. Such situations we say these transactions do not have commercial substance. Another example. Say I have a car in Hyderabad. You have a car, let us say, in Mumbai. Okay. I have a car in Hyderabad. You have a car in Mumbai. Both the car are of similar model, same purpose. I want a car in Mumbai. I want to transfer my car to Mumbai, and you want that car to be transferred to Hyderabad. Your car should come to Hyderabad. My car should go to Mumbai. Your car should come to Hyderabad. My car should go to Mumbai. That is what our objective is. Now, if I go for the transfer route, I have to pay road tax in Mumbai. You also have to pay road tax in Hyderabad. You will not get refund of road taxes paid. A lot of nuisance value is there. Instead, what we said, okay, let us exchange the cars. I will give my car to you. You give your car to me. So I'll get a car in Mumbai. You get a car in Hyderabad. There is an exchange of asset. There is an exchange of asset. Now, does this exchange have commercial substance? Sir, how to check? Sir, how do we know whether it's a commercial substance or not? So what you have to check is, after this transaction, is your cash flow significantly different from the cash flow that was happening earlier? So, an exchange transaction has commercial substance if the risk, timing, and amount of the cash flows of the asset received are significantly different from the cash flows of the asset transferred. Meaning to say, because of this exchange, our cash flows should significantly differ. If I am giving my car and if you are giving your car, very unlikely that the cash flows would differ. But say for example, if I give you a piece of land here and you give me a machinery in exchange, then definitely you can see that there will be a change in cash flow. So if there is a significant change in cash flows, what are we saying? Risk, timing, and amount. Will the amount change? Will the timing change? Timing also has an impact, because if I receive cash flows earlier, it is more valuable to me. Risk. How does the risk change of the cash flow? After the exchange of the asset, is the cash flow risk same? So if these are significantly different, then we say the transaction has commercial substance. And the second thing to check is, there is a significant effect on the present value of the after-tax cash flows that an entity expects from continuing use and disposal of the asset due to exchange transaction. So basically what they're saying is, present value of after-tax cash flows. If I continue to use the asset, let us say it is 1000. If I exchange the asset, that I have disposed the asset and got a new asset, maybe it is 1200 or 800, whatever it is. If there is a significant change or difference, then we say transaction has commercial substance. For our understanding purpose, in layman terms, if you are exchanging similar assets, then generally you will not have commercial substance. If you are exchanging different assets, then you will have commercial substance. The question will mention this in the examination. Now, based on the rule that we just saw, okay, so based on the rule that we just saw, let us say we exchanged car. Okay, you have car A, I have car B, we have exchanged this car. Both are similar cars, same model, almost same year of registration, similar kilometers run, and all of those. Carrying amount is 10 lakhs. For you, carrying amount, that is the amount at which we are showing this asset in the books, is 9 lakhs. All right. Fair value is, generally fair value will not be higher, but for our example purpose, fair value is 15 lakhs, here also fair value is 15 lakhs. If we are exchanging as per the principle that we learned, what do we say? Let us say this is me and this is you. Okay, I will record car B at fair value of asset given up 15 lakhs, and I will say to car A 10 lakhs, to P&L 5 lakhs. What will you do? You will say car A debit 15 lakhs to car B 9 lakhs to P&L. This is what we will do, right? If we follow fair valuation method, you will also record at fair value, I will also record at fair value. There is a gain in the transaction or there might be a loss also. Okay, we are recording that in P&L. We are overstating the car, and this amount may be distributed as dividend. So to avoid such scenarios, what the standard says is, and just by entering into this transaction, by exchanging similar assets, we are showing a higher asset in the book and we are showing higher profit. The reverse also is possible. We may try to manage the profit by showing lesser profit. That is also possible. But what is happening? Are our cash flows changing significantly? No. Is the transaction having some commercial substance? No. Is there significant difference in benefit to you and benefit to me? No. Both of us are exchanging cars which are similar in nature. So what the standard says is, if commercial substance does not exist, don't use fair value. You can use only book value. So if the transaction does not have commercial substance, we will record it at carrying amount. The idea is not to unnecessarily inflate the asset, record unnecessary gains or losses. Alright. So to summarize, if there is no commercial substance, carrying amount. If there is commercial substance, then fair value of asset given up. Second, fair value of asset acquired. If one is more evident, you will use that. Simple. This is the summary of entire exchange transaction. So we have seen three categories of initial measurement: payment, that is outright purchase; self-construction; exchange. For purchase and self-construction, you will take all the cost incurred to bring the asset to the location and condition as intended by the management. You will not take refundable taxes. You will reduce trade discount. You will not reduce cash discount. You will not take any internal profits. Any abnormal losses you will ignore. Cost of opening at a new place, not considered. Cost of launching a new product, not considered. General overheads, administrative overheads, not considered. So that is what you have to understand. Then this thing you have to pay extra attention: present value of decommissioning expenses. Then when it comes to exchange, you will take fair value of what is given. If that is not available, then fair value of what is taken. Then if one is more evident, you will take that. If both are not available, carrying amount. And if commercial substance is not there, then also carrying amount. This summarizes how will we initially measure an item of PPE. Now what we'll do is we'll look at some of the questions and have great clarity on the concept that we have discussed so far. So we have understood what are the various costs to be included in the cost of PPE, what is to be done when we purchase, what is to be done when we do a self-construction, what is to be done when there is an exchange. Let's now have a look at few questions more on conceptual part to have a better understanding of things that we have discussed so far. So first, a quick summary of various costs. Import duties and non-refundable purchase taxes, these are considered to be the cost of PPE. We will include it in the price of PPE or purchase price of PPE. If they are refundable, we will not include. Initial delivery and handling cost, we will include. These are directly attributable cost of PPE. Initial operating losses, if at all, let us say we have started a new branch. The new branch has low demand, low sales, because of which we are incurring some losses initially. Can we add that loss to the cost of PPE? We cannot add. Okay. Cost while asset is capable of operating but not fully utilized. Asset is ready. It has a capacity of 1000 units per day. We are utilizing only 600 units per day. So can we capitalize some cost because the asset is not fully used? Can we capitalize some cost to such asset? We cannot. Once the asset is ready for use, we will not capitalize any further cost unless the future economic benefits that we will receive are improved. Okay. Then trade discounts and rebates, we will reduce it from the purchase price. Cash discount, we will not do anything. We will not consider that as a reduction. Cost of relocating or reorganizing operations, cost of relocation, cost of training staff, cost of starting business in a new location with a new set of customers, all of these costs are not included. Installation and assembly cost, yes, these are directly attributable cost. Administration and general overhead cost, these costs are not included. Okay, this is a summary. Now let's have a look at some questions. Neon Enterprises operates a major chain of restaurants located in different cities. So there is a company which operates restaurants. The company has acquired a new restaurant located at Chandigarh. The new restaurant requires significant renovation expenditure. So we have to carry out renovation. Management expects that the renovation will last for 3 months, during which the restaurant will be closed. So 3 months so 3 months is the time required to renovate the restaurant. Think of it, you purchased an old car, you purchased an old bike. Similarly, an existing restaurant is purchased. We will have to carry out some renovation activity. Can we capitalize the renovation cost? The first thing that you have to understand. Okay. Now, can we capitalize the renovation cost? See, without renovating, without bringing the restaurant to a good quality restaurant, good quality of, maybe infrastructure, seating arrangements, ambience, all of that, we will not be able to get the future economic benefit. So, such renovation costs which are incurred to improve the performance of the restaurant will be capitalized. Management has prepared the budget for the period. Salaries of the staff engaged in preparation of restaurant before its opening, 7.5 lakh. Construction and remodeling cost of the restaurant, 30 lakh. So whatever cost we have incurred in constructing and remodeling the restaurant, that will be capitalized, because this will give us future economic benefit. So what about the staff salary? Now here they have said staff engaged in preparation of restaurant. So actually the wordings used are not proper. These are basically operations of restaurant. These are basically operations of restaurant. They are involved in running the restaurant. The salary of the workers or employees who are working in the restaurant. Now for 3 months, there is no revenue. There are only salary costs. Can we capitalize this salary cost? The question you have to ask is, are the salary, say for example, this includes a cook. Is the cook service required to bring the restaurant to its present condition and location? Of course not. Okay, the cook will be required for operational purposes. So such cost of staff salary will not be included in the cost of restaurant. Explain the treatment of these expenditure as per provision of AS10. This is a 5-mark question. How should we approach this question? First thing that you need to write is, what is the requirement of the standard? When can we recognize an item of PPE in the books? We have already discussed this. The cost of an item of PPE should be recognized as an asset if and only if it is probable that future economic benefit. So one more thing, probable here means greater than 50% chance that future economic benefit associated with the item will flow to the enterprise. The cost of the item can be measured reliably. Here we are able to measure the cost, 7.5 and 30. But the 7.5 is not giving us any future economic benefit. That cannot be capitalized. Any cost directly attributable to bring the asset to the location and condition necessary for it to be capable of operating in the manner indicated by the management are called directly attributable cost and would be included in the cost of PPE. This also we have discussed multiple times. The management should capitalize cost of construction and remodeling because they are necessary to bring the restaurant to the condition necessary for it to be capable of operating in the manner intended by the management. Without remodeling, the restaurant cannot function as required by the management. Hence, this cost should be capitalized. The cost of salary of staff engaged in preparation of restaurant before its opening are in the nature of operating expenditure that would be incurred if the restaurant was open. So, if the restaurant was open, it was a part of our day-to-day operating expenses, and hence this cannot be capitalized, right? 5-mark question. You can get 3 to 4 marks in this if you write proper theory, proper application and proper conclusion. Next one. Entity A has an existing freehold factory property. Freehold means owned, which it intends to knock down and redevelop. So it wants to bring down the existing factory and redevelop. During the redevelopment period, company will move its production facility to another temporary site. So, I have a factory, currently operations are going on. I want to build a new factory in that place. So, what will I do? I will demolish the factory and build a new factory. In the meanwhile, how will I run my business? I am moving to another site, temporary site. The following cost will be incurred. Setup cost of 5 lakhs to install machinery in the new location, rent of 15 lakhs, removal cost of 3 lakhs to transport the machinery from the old location to the temporary location. Can these costs be capitalized to the cost of new building? Now here what is happening is, in the existing place I am constructing, and in the meanwhile, because I want to run my business, I am moving my machinery, I am moving my staff, I am moving other things to another temporary location. Now this cost of relocation, can it be capitalized? Sir, how do we answer this? You have to ask, is that cost necessary to build the factory? Okay, see, I am incurring that cost to run my business. Even if I don't incur those costs, cost of factory construction is independent. I can still construct the factory without incurring those costs, because those costs are more of my operating costs. I want to do the business, I want to continue to earn profit, and hence I am incurring those costs. That cost has nothing to do with factory construction cost. See, construction cost of factory will include your cost of preparation of site, material, labor, all of those costs which are incurred to construct the factory. These costs are operating costs. These costs are directly not related to construction of factory. You may say, sir, how will the company construct the factory without incurring those costs? See, even if you don't incur those costs, what will happen? You will incur losses, but you can still construct the factory. So, any cost directly attributable to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management, this cost has to be capitalized. The costs to be incurred by the company are in the nature of relocating and reorganizing operations of the company and are not necessary for bringing the asset to the location and condition intended by the management. They don't meet the requirement and hence cannot be capitalized. An amusement park has a soft opening to the public to trial run its attractions. Tickets are sold at a 50% discount during this period and the operating capacity is 80%. The official opening day of the amusement park is 3 months later. Management claims that the soft opening is a trial run necessary for the amusement park to be in the condition capable of operating in the intended manner. Accordingly, the net operating cost incurred should be capitalized. So what is happening? There is an amusement park. It has a soft opening. Soft opening is like, we are not doing a big bang announcement. Okay, before the big bang announcement, before the grand announcement, we are running it just like that for 3 months. Whoever wants to come and enjoy the rides, they can do. Okay, during that period we are giving tickets at 50% discount and capacity running is at 80%. So if you are giving a discount, you are incurring some losses, correct? Now what is the management saying? These losses should not be debited to P&L, rather we should add it to the cost of the park. Now here, how do we decide whether we should capitalize the losses that the company is incurring during its soft opening? Now the first thing is it a trial run? See, if it is a trial run for a park, you cannot invite public. You have to get the trial run done, get the certificate of completion, only then you can allow the public to enjoy the park. Okay, for example, if you look at, let us say, some railway lines or some metro lines and all, when they say it's a trial run, public is not allowed. Public, you cannot sell tickets to public and earn money there. When it is trial run, it is purely before it is open to the public. So this soft opening is not a trial run. It is more like a initial period when they want to create awareness or when they want to understand what kind of rides are being enjoyed, what kind of rides are more popular, etc. So here this is not a trial run, and because 80% occupancy is happening, public is using, the park has reached the condition as intended by the management. Okay, so it is like completed. So any cost directly attributable to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management should be capitalized. See, I am repeating again and again because this is very important part of the answer. Cost incurred after the asset is ready to use are not capitalized. So if the park is already open to the public, even though we may call it's a soft opening, is the park open for public? Yes, it is open for public. So this cost cannot be capitalized. Even though it is running at less than full operating capacity, there is sufficient evidence that the amusement park is capable of operating in the manner intended by the management. Hence, this cost would be expense. Let's look at the next one. An entity bought a plot of land for development of office building. So we purchased a plot of land. Development of the land was scheduled into 6 phases. So there is a parcel of land 1, 2, 3, 4, 5, 6, something like that. Okay, part development. The land scheduled for development in phases 5 and 6 was leased to another entity on a short-term basis as a parking lot for vehicles. So what has happened? There are 6 phases. All the phases are not happening simultaneously. So till the time that 5th and 6th phases construction activity starts, what the company thought, let me give this on rent. We'll earn some income. What is the treatment of rental income? This will be a real big challenge in your day. This will be a real big challenge when you start working. Okay, what to do with this kind of income? And you will always find the client or the management, fighting that these kind of income should be reduced from the cost of the asset. And you will be like, no, we cannot reduce it from the cost of the asset. Okay, so that is very important, because what happens is, let us say if the budget is 1000 crores. Okay, the budget for construction is 1000 crores, and if they don't have sufficient budget, what they would do is they will treat this income as a reduction of the cost and incur more expenditure. That should not be allowed. Okay, now here, how do we decide whether this income should be reduced or not? Because if you remember, we said that deducting proceeds from sale of any product, so cost of testing after reducing any proceeds from sale of product. Here also we are earning some income by giving that car park on rent. Can we reduce the cost? Can we reduce the income from the cost? So for that we need to answer, is it necessary for us to give the land on rent for construction of building? What is the answer? The answer is no. So if that activity is not necessary, it is not related to construction of fixed asset or construction of building. Because the activity is not related, any income that has come, we cannot reduce. We have to take that income to P&L. Some operations occur in connection with the construction of development of PPE, but are not necessary to bring the item to the location and condition necessary for it to be capable of operating in the manner intended by the management. In the given case, land scheduled for development was leased on a short-term basis as parking lot. The car park activity is incidental to entity's principal activity of development. The income and related expense of incidental operations are recognized in the statement of P&L. These are incidental. These are not directly related to my construction activity. So transfer that to P&L. Sir, why does the management want to reduce it from the cost? Because if you transfer it to P&L, then it will be part of your income. You have to pay taxes. Okay, so for that purpose, they may say, okay, we'll reduce it from the cost so that we don't have to pay income. We don't have to pay taxes. Okay, so that could be one reason. Now, having understood the basics, let us go to the computational part. ABC Limited is installing a new plant at its production facility. It has incurred the following costs. See, these are typical questions which come in the examination again and again. Okay, and so let's say there are 7 items. They may give it for 7 marks or 5 marks. Even if there is an error in 1 or 2 items, you will be able to score good marks here. So such type of questions you should ensure you are attempting in the examination. Cost of the plant, cost as per supplier's invoice plus taxes, 25 lakhs. Now, is this taxes refundable or non-refundable? Unless anything is mentioned, we will assume it is non-refundable. Initial delivery and handling cost, 2 lakhs. So what we will do? Will we include this in the cost of PP? Yes. Will we include this in cost of PP? Yes. Cost of site preparation? Yes. Consultant used for advice, professional fees, will we include? Yes. Interest charges paid to supplier of plant for deferred credit. Now this is borrowing cost. Now you may say, sir, how do we know whether to consider or not consider, whether it is to be capitalized or not? Now what has happened? They are installing a plant and they are paid to supplier of plant. Okay. Now typically, so you will understand this more in A16 as well. Typically, if I am buying some asset which is ready, for example, car, truck, and which does not take substantial period of time, then in that case, the interest on such asset is not capitalized. Okay. So here also there is a supplier of plant, means he is supplying the plant. Is the plant in its condition? Is the plant ready? The plant is ready. I may have to install it later. That is installation part. but the plant is ready, and interest is charged on deferred credit. So interest is more, it is charged more for deferred credit, not because the asset takes substantial period of time. So this we will not consider. Present value of estimated dismantling cost to be incurred after 7 years. Will we include this? Yes. Now here in examination, sometimes they just say estimated dismantling cost and they don't mention anything. They don't give discount factor, they don't give number of years and all of that. In that case, you will assume that it is a present value. Operating losses, we will not consider. So by the time you read the question, you know what all items are to be included. How to write it in the answer? All of these as it is, you can copy heads, and wherever it is not included, you have to write 0, 0, and here also 0. And then you have to give a note. Why have you not considered this item and this item? Okay. So how to answer this? Cost of item of PPE includes purchase price, all taxes other than those which are refundable, and cost directly attributable to bring the asset to the location and condition necessary to be capable of operating in the manner intended by the management. So you will include cost, initial delivery, cost of site, consultants, present value. Interest charges paid to suppliers will not be capitalized unless it is a qualifying asset, and initial operating losses are also not capitalized, right? So you'll get your answer. So what all we said? 25 plus 2, 27, plus 6, 33, plus 7, 40, plus 3, 43, 43 lakhs is the answer. Next. Preet Limited intends to set up a steel plant for which it has acquired a dilapidated factory, factory having an area of 5,000 acres at a cost of 60,000 per acre. That dilapidated is basically damaged, or khandar is what you call as khandar. So this dilapidated basically means that it is fully damaged, not in a workable condition. Okay, it's like something, the building is about to fall. Okay, 5,000 acres at a cost of 60,000 per acre. Okay. Preet Limited incurred 1.1 crores on demolishing the old factory building thereon. So how much is incurred? 1.1. A sum of 63 lakhs including 5% GST thereon was realized from the sale of the material salvaged from the site. So what has happened? We incurred a cost of demolition, and whatever scrap we got, that we sold, we got how much? 63 lakhs. Now tell me one thing, is the demolition of factory necessary to build a new factory? Of course yes. Without demolishing, how will you build? So is the cost relevant? That cost is relevant. So this 1.1 crores of cost we will include. Then we got 63 lakhs from sale. What do we do with this sale? See, after demolishing, whatever scrap we got, we have sold that. That is also a part of the construction activity. That is also part of the building process. So that sale of scrap will reduce. How much will be reduced? 63 lakhs? No. Because if base value is 100, GST is 5%, which is 105. What we have got is 63 lakhs. This 63 lakhs includes GST, that is 105. How much will we reduce? We will reduce only the percentage. We will reduce the portion related to 100. So 63 into 100 divided by 105. So 6300 into 100 divided by 105. 6300 into 100 divided by 105, we get 6000. So only 6000 portion will be reduced. Sir, what about this 5 collected? The GST portion what is collected, that is 5% of 6000, that is 300, that will be paid to the government. Okay. Preet Limited incurred stamp duty and registration charges of 7% of land value. Will we include that? Yes, because registration charges are cost. I will include that. They paid legal and consultancy charges of 8 lakhs for land acquisition and 1,25,000 on title guarantee insurance. Compute the value of the land acquired. So what happened? We purchased the land. We demolished the land so that we can bring it to. So what happened? We purchased a factory. We demolished the factory so that the land reaches the condition as intended by the management. So original cost of 60,000 per acre into 5,000. So if you do 60,000 into 5,000, we get, when we calculate, we get 30 crores. Okay. So how do we write that in the examination? To save time, we can write in rupees lakhs. Okay. So if you have to do in rupees lakhs, 60,000 into 5,000 is 3,000 lakhs. Okay. Stamp duty and registration charges at 7%, 210 of this 3,000 into 7%. Legal and consultancy fees of 8 lakhs. Yes, because we have incurred that expenditure for the consultancy process, any legal charges that you have incurred, 8 lakhs. Then 1,25,000 on title guarantee insurance. So what is this title guarantee insurance? See, when you purchase land, you have to be sure that the title to the land is clear. Maybe you have paid some amount to ensure that if the title is not clear, the insurance company will reimburse us. So there is also cost incurred for the purpose of the land. Because without this, the land may be worthless for us. To safeguard ourselves, we have incurred this expenditure. And demolition expense is how much? 1.1 crore. 1.1 crore minus 60 lakhs that you have received. Say 63 lakhs minus GST. If you do 60 lakhs, 1.1 minus 60, 50 lakhs. So total of all of these is your cost of land. Let's look at the next question. Star Limited purchased a machinery for 6,80,000 inclusive of GST of 40,000. Input credit is available for the entire amount of GST paid. So what happens if 6,80,000 is the machinery cost and GST is 40,000, for which we will get input credit? Our net cost is how much? 680 minus 40, only 6,40,000. So in your answer, you will consider only 6,40,000. Okay. Cost of preparation of site will be included? Yes. Labor charges 56,000. 200 out of the total 500 man hours work were spent on installation of the machinery. So this is the total charge. This is for how many hours? 500 hours. How much is incurred for installation? 200. So what you will do? You will take 56,000 into 200 out of 500 only. Spare parts and tool consumed in installation 5,000. So if you have used some spare parts, some tools and all, is it a cost of construction? Yes. Total salary of supervisor 26,000. Time spent for installation was 25%. So there is a supervisor who is supervising the work. Of this, we will consider 25%. Total technical expense 1/10 relates to the plant. So of this, we will take only 1/10. Test run and experimental production expense will include. Consultancy charges for plant setup. Yes. Depreciation on assets used for installation 12,000. Sir, can we take depreciation on another machinery? Of course. A simple example I'll give you. Let us say we need a crane. We need a crane for installation of machinery. One is we can get that crane on rent. Will we include that cost? Yes. Instead of getting it on rent, if we already have a crane, we are charging depreciation on that crane. That expenditure is attributable to installation of the machine. Because we are using the crane for installation, that cost will be included. So the depreciation on asset used for installation, this will also be included. So what all will be the cost? Let us do a fair working. So cost of machinery. In your notebook, you will write this as the first item. How much? 6,40,000. Or what you can do? You can write 6,80,000 minus 40,000. That also is possible. Cost of preparation of site, yes, will include. As it is, we will write. Total labor charges 56,000. We will consider only 200 out of 500. 56,000 into 200 divided by 500. We get how much? We get 22,400. This is 21,200 fully. This 6,40,000 I am writing it here. Okay. Then spare parts, yes, 5,000 we will consider. Then total salary of supervisor, only 25%. So 26,000 into 25% is 6,500 we will consider. Total technical expense 3,400 we will consider, 1/10. Test run 18,000. Consultancy charges 11,000. And depreciation on asset used for installation 12,000. The machine was ready for use on 15th of January, but was used from 1st of February. See, once the machine is ready, only till that date expenditure will consider. After that, any other expenditure will not consider. Due to this, further expense of 8,900 were incurred. Will we include this? No, will not include. Calculate the value at which plant should be capitalized. So, 6,40,000 plus 21,200 plus 22,400 plus 5,000 plus 6,500 plus 3,400 plus 18,000 plus 11,000 plus 12,000. So we get total of 7,39,500. In the examination, when you get this question or when you're writing down in your notebook also, as it is, you just need to copy these heads and what all are included, you need to write that. Okay. Such a simple question, and we keep getting this for 5 to 7 marks in the examination. Okay. Just you need to be aware what is to be included, what is not to be included. So as I said, either you can take this as a net item from here or you can write it on this basis. And also explanation of why 8,900 is not considered, because once the asset is ready for use, subsequent expenditure are not considered. Let's look at next one. Again, see 5 marks, such an easy question. Srishti Limited contracted with a supplier to purchase machinery which is to be installed in its department in 3 months' time. Special foundations were required for the machinery which were to be prepared within this supply lead time. Cost of the site preparation and laying foundation were 1,41,000. Will we include this? Yes. Cost of site preparation is included. So, see if you see the question, ascertain the amount at which the machinery should be capitalized. So, first item is site preparation. How much? 1,41,870. There is no difficulty in identifying this. Then, these activities were supervised by a technician during the entire period who is employed for this purpose. 45,000 per month. The technician services were given by Department B to Department A, which billed the services at 49,500 per month. So, you have 49,500 and 45,000. I have already told you, we will not consider interdepartmental profit. If Department A is giving services to Department B, we will only consider cost. We will not consider market price or with profit amount. After adding 10% profit margin, the machine was purchased at 158,34,000, 1,58,34,000, inclusive of IGST at 12%. So, if for which input credit is available to Srishti Limited. So, what we will do? This 158,34, this represents what? Including GST, means this represents 100 plus 12. We need only 100. So, 158,34,000 divided by 112 into 100, we get 1,41,000. Sorry, 1 crore 41 lakhs 37,500. This is the base price. So, while calculating, we will take only the base price of 141,37,500. Supervisor salary 45,000 into 3 months, 1,35,000. We will not take with profit amount. Okay. Then 55,770 transportation charges were incurred to bring the machine to the factory. Architect was appointed at a fee of 30,000 to supervise the installation. So, will we include this? Yes. Transportation cost 55,770, architect fees 30,000. All of this will be included, and we get the cost of PPE. The payment under the invoice was due in 5 months. However, the company made the payment in 3rd month. Company operates on a bank OD of 14%. Now, 2 things here. This information on borrowing cost is given because if it is a qualifying asset, we have to capitalize. Now, here there are 2 things. One, it is only 3 months period. So, 3 months is not a substantial period of time, and we should not capitalize the borrowing cost. Okay. Second, we are purchasing a machinery which is generally in a ready to use condition. Again, there also we should not capitalize. So, what all should be considered? We should consider site preparation as given, supervisor salary, purchase price without taxes, transportation and architect fee. So, this is one point where you might need to be careful about the calculations. Okay. Apart from that, rest all is simple and straightforward. Now, sometimes you may think that, sir, as per GST, this credit is allowed, this is not allowed. If it is construction, then we'll allow, will not allow. Don't break your head. If the question says it is allowed, means it is allowed. If the question says it is not allowed, means it is not allowed. Let's now have a look at the next question. Similar to the one that we have already discussed, now this has come in an examination for 7 marks. Okay. Hardy Limited intends to extend the factory setup on the adjacent plot with disintegrated old premises. So, there is a factory, there is a disintegrated old premises, means some old building or something like that which is in a dilapidated condition. It acquired the land having an area of 250 hectares at a cost of 25,000 per hectare. So, 250 hectares of land was purchased at a cost of 25,000 per hectare. So, what is the purchase price? 25,000 into 250, that is our purchase price. Simple and straightforward. Hardy Limited incurred stamp duty and registration charges of 5%. Will we add this to the cost of land? See, any taxes you pay, you will add it to the cost of land, and nobody is going to reimburse the stamp duties. Legal fees were paid 4,75,000 for land acquisition. So whatever professional fees we pay for consultants, lawyers, etc., even that will be added to the cost of land. Hardy Limited incurred 37,85,000 for demolishing old premises thereon. So in that old structure that was purchased or land that was purchased, there is a building that is in a bad condition. We have demolished that. Should this cost be added to the cost of land? Now the question that you have to ask is, what are the costs I am incurring to bring the land to the condition and location? Of course, location cannot be changed, to the condition as intended by the management. Now when I have purchased the land for the purpose of constructing something, that land must be clear of all the existing structure. So this demolishing cost will also be added to the land cost. Now you may have a doubt, sir, can we add it to the construction cost? No, because we need a flat land, we need a leveled land, correct? We are purchasing a land, so we will add it to the land cost. Then a sum of rupees 12,600 was realized from the sale of material salvaged from the site, including 5% GST. So typically what happens is, when you break down an existing structure, you will have some iron rod, some wood and all of those things which can be sold. How much did we realize? 12,60,000. This includes GST. So we have collected 12,60,000. This represents 105%. 100 of normal value, 5% of GST. Our net revenue or net income is only 1260 divided by 105 into 100, that comes to 12 lakhs. Sir, what about this 5% GST 60,000? That has to be paid to the government. That is my GST liability. So the entry would be debit bank 12,60,000, credit cost of PPE 12 lakhs, because whatever I have recovered from the cost of demolition, whatever I have recovered from the sale of scrap, that value I will reduce, and credit GST payable 60,000. Okay, then till the new site with extended factory premise is ready, the company needs to move the present production facilities to another temporary site. The following incremental cost will be incurred. So we want to construct the factory. Till the time the factory is ready, we will have to operate from a temporary premise. We have to move our setup and all to a temporary premise. Setup cost of 7,50,000 to install the machinery in the new location, rent of 12 lakhs, removal cost of 2,50,000 to transport the machinery from the old location to the temporary location. So what are the incremental costs being incurred? You have to incur a setup cost. So think of it, I have machinery at my current location, I have to move that to a new location. By moving that to new location, I will incur some cost. What are the cost? Setup cost, that is to install there. Rent, I have to pay the rent of the new premise, and removal cost. So to remove the machinery and to transport the machinery, I will incur 2,50,000. Now the question is, can I capitalize these costs? Now 2-3 things you need to understand. One thing is very sure, that we have incurred this cost because we want to construct the factory. That is very clear. But is this cost related to construction of the factory? Am I incurring this cost, and is this cost directly attributable to bring the land to the current condition and location, or to construct the factory? The answer is no. These costs I have incurred, as I have explained in the previous example also, this is more for my operating purposes. This is not directly related to the construction of the factory. Now if I am operating from a new place and I am paying rent there, that is not my cost of the factory. That is my existing operating cost, which I will anyways incur, right? So these costs cannot be capitalized. Now the other way for you to understand this is, just by moving the machinery from one location to another location, is the value of machinery increasing? No. Is the future economic benefit increasing? No, because I will get the same economic benefit what I was getting earlier, and I'll get the same economic benefit once I move it to a new place. So the capacity of the machine is not changing, the asset or the machinery is not changing, and hence we will not consider these costs as capital cost. So what do? All of these costs will be expensed out. Though these are cost which are incurred because we are constructing, but this does not add to the value of the asset. It is like you want to renovate your home. You want to bring down your existing structure and build a new structure there. The cost that you are incurring by paying rent somewhere else, that is a part of your day-to-day living expenses and not the cost of the building. That is how you can understand. So, these costs are not included in the cost of the asset if they are not directly attributable to bring the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management, and hence the cost cannot be capitalized. See, these specific terminologies you need to write in the examination to score better marks. Okay. Then, management is of the opinion that the cost of moving production facilities to another temporary location can be capitalized. You are required to advise. It cannot be capitalized. We have advised. Now, you have to also see what is the question asking. You are required to advise. So, you have to write your answer in an explanatory format and tell that these costs cannot be capitalized. That is the first thing. Also compute the cost of the land acquired. Now, as far as cost of land is concerned, what all costs are incurred? First is purchase price. Purchase price is your 25,000 into 250. So, to compute the cost of land, first one is purchase price. How much is the purchase price? 25,000 into 250. Please show proper workings in the examination. This is 25 into 25, 625, 1, 2, 3, 4, 62 lakhs 50,000. Then, what is the next cost? Registration charges. So, that is also added. Stamp duty plus registration charges. How much? 5%. So, 62, 625. 625, if you compute 5%, you will get 3125. Okay, 6250 ka half and 00. So, that is 3,12,500. Please use calculator. Okay, I am doing it. Even if I make a mistake, I have opportunity to cross check. In the examination, you will not have an opportunity to cross check. Then, they incurred 37,85,000 for demolition cost. How much is that? 37,85,000. Out of this, what is recovered? Amount recovered on scrap sales. Scrap sales we have computed is 12 lakhs. Please show it in the working. 12 lakhs 60 divided by 105 into 100. So, 37 minus 12 is 25. So, this will be 25 lakhs 85,000. Then, what all costs did we incur? We incurred 4,75,000 as legal fees. So, that also will be included. Legal fees 4,75,000. Other costs cannot be capitalized. Okay. So, what is the total cost? The total cost 62 lakhs 50,000 plus 3,12,500 plus 2585,000 plus 475,000 96 lakhs 22,500. By doing this, you will get 4 marks in the examination. Okay, very simple and straightforward. Let's now have a look at the next question. This is on exchange of assets. Now, before we start exchange of asset, always remember we will consider fair value of asset given. This is the first priority. Second priority is what we have received. If one is more evident, then we will take the one which is more evident. If both are not available, carrying amount. If commercial substance is not there, then also carrying amount. If you remember this much, this is done. Alright. Now, entity A exchanges surplus land with a book value of 10 lakhs. Carrying amount is how much? 10 lakh. For cash of 20 lakhs and plant and machinery of 25 lakhs. So, what is given? Given up land. How much? 10 lakhs. Is this the fair value? No, this is not the fair value. This is only the book value. We don't have the fair value. What did we receive? We received cash of 20 lakhs and machinery of 25 lakhs. See, always remember the currency, the cash in hand, cash at bank, the value itself is the fair value. You can't say that, okay, I have 100 rupees, the fair value of this is 200 rupees. That's not possible, right? And plant and machinery, the value is 25 lakhs. What is happening? Exchange is happening. First priority, fair value of asset given up. Did they give the information? No. Second priority, fair value of assets acquired. Fair value of cash is 20 lakhs and plant and machinery is 25 lakhs. So, the assets that you have acquired. What have you acquired? Plant and machinery. So you will record plant and machinery account debit 25 lakhs. You have received cash, cash account debit 20 lakhs. What did you give? We gave land of how much? 10 lakhs. Now think of it. We gave land worth 10 lakhs. We got assets worth 45 lakhs. So basically, can I say that the land I disposed of at 45 lakhs? Yes. Cost is how much, or carrying amount is how much? 10 lakhs. So the difference is profit on disposal, which is 35 lakhs. Okay. So at what value will we record the plant and machinery? 25 lakhs. Okay. Because we don't have fair value of assets given up, we will take the fair value of assets acquired. Let's look at the next one. Entity A exchanges car X with a book value of 13 lakhs and a fair value of 13 lakhs 25,000 for cash of 15,000 and car Y which has a fair value of 13 lakh 10,000. So again, what is given? Given up car X, book value 13 lakhs, fair value 13.25 lakhs. Okay. Then what did we receive? Received cash of 15,000 and car Y have a fair value of 13 lakh 10,000. So car Y has a fair value of 13 lakhs 10,000. The transaction lacks commercial substance as the company's cash flows are not expected to change as a result of the exchange. It is in the same position as it was before the transaction. Of course, if you exchange similar car, you will not get new cash flows. Your cash flows will not change, which means the transaction lacks commercial substance. If the transaction lacks commercial substance, at what value will we record? We will record these at the carrying amount of assets given up. We will record these at carrying amount of assets given up. What is the carrying amount? Carrying amount of asset given up in this case is 13 lakhs. That is the book value. Carrying amount means book value. We compute carrying amount as cost minus depreciation minus impairment. We will understand this subsequently. Okay. So carrying amount is how much? 13 lakhs. So the value of assets acquired, is measured at carrying amount of asset given up. So carrying amount is how much? 13 lakhs. That is the value of asset given up. Now against this 13 lakhs, we got 15,000 of cash. Which means out of 13 we got 15,000 of cash, which means for car Y we have got 12 lakh 85,000 worth. Which also means then car Y is worth 12 lakh 85,000 for us, because we gave up something worth 13 lakhs, we got 15,000 in cash and 12 lakh 85,000 worth of new car. So the book value of car is 13 lakhs, cash received 15,000, car Y measured at book value 12 lakh 85,000. Okay, so the book value of asset given up is split between cash received and new car. So the entry will be debit car Y 12 lakh 85, debit cash 15,000, credit car X 13 lakhs. Now here no profit or loss is recognized. Because the asset given up is measured at carrying amount and we are assuming that whatever we get is at the carrying amount of asset given up. Hence no profit or loss is being recognized. Now in the same case, if we assume that the transaction has commercial substance, then what we will take? We will take fair value of asset received. So 13 lakh 10,000 plus 15,000 cash received. So fair value of, then if we assume that the transaction has commercial substance, then what we will do? We will take the fair value of asset given up. So 13.25. Out of that we got cash of 15,000. Balance will be the value towards car received. Okay. Now in this case, fair value of the car given up is 13 lakh 25,000. So what we will do? We will debit car Y by 13.1. We will debit cash by 0.25. Credit. So now what will be the entry here? We will debit car Y by 13.10. We will debit cash by 0.15. Okay, we will credit car X at the book value of 13 lakhs. So extra amount whatever you have received will be P&L of 0.25 lakhs. Alright, let's look at the next one. Entity A carried plant and machinery in its books at 2 lakhs. These were destroyed in a fire. So, there is some fire and there is a destruction. The assets were insured new for old and were replaced by the insurance company with new machines that cost 20 lakhs. The machines were acquired by the insurance company and the company did not receive 20 lakhs as cash compensation. How will entity account for the same? Now, what is the scenario here? Here also, the asset is not actually being exchanged, asset is destroyed. Our existing asset is destroyed and we got new asset. Now, first thing, will it have commercial substance? Now, think of it. If I have a 10-year-old car or 10-year-old machine and now I get a new machine under the insurance policy, fully new, no cash has been paid, fully new machine has been received. Will my cash flows change? Yes. Will my future economic benefits change? Yes. So, here you can think of it that this 2 lakhs, whatever machine we have, this actually is lost and in return for that we got a new machine worth 20 lakhs. So, what we need to do is this 2 lakhs we should recognize as a loss. And this 20 lakhs we should recognize as a gain because we are receiving new machine from insurance company. Sir, can't we show the new machine at 2 lakhs? Then we will be understating our asset. The new machine is worth how much? 20 lakhs. So, debit new machine 20 lakhs, credit old machine 2 lakhs and credit P&L 18 lakhs. This is if you pass a combined entry, or the better way to do that is to de-recognize the old machinery as a loss. So, debit P&L, credit plant and machinery for loss, then debit insurance company for machine receivable because insurance company has to give us that machine. So, we are saying okay, insurance company, we have to receive this machine from you and credit P&L as a gain. Then plant and machinery account debit to insurance company account 20 lakhs when we have finally received the plant and machinery. So, now so far we have understood when do we recognize the property, plant and equipment, and please remember you have to write those conditions. Future economic benefits, cost can be measured reliably. What are the costs to be capitalized? The costs which are incurred to bring the property, plant and equipment to the condition and location as intended by the management. Even that has to be considered, right? Then we also saw in 3 scenarios how to compute the cost. When we purchase, when we construct and when there is an exchange. Now we will see when do we stop capitalization, when should capitalize stop. Cessation of capitalization. Cessation means stop. When should we stop? Recognition of cost to the carrying amount of PPE ceases. This is stops. When the item is in the location and condition necessary for it to be capable of operating in the manner intended by management. That is why initial operating losses, cost of relocating or reorganizing entities operations are not included in the cost of PPE. So, what happens is in many instances the property, plant and equipment takes significant amount of time to be ready. So, till the time the asset is ready for its intended use, if we are incurring some cost for that particular asset, we will add that to the carrying amount of the asset. So, typically what happens is you have something called as CWIP, capital work in progress. Okay. So, we will accumulate all the capital cost, PPE related cost to this account called capital work in progress account. It is a separate line item in the financial statements in the balance sheet as well. So, say for example, I am constructing a building. So, initially there in the first year we incurred cost for laying up the foundation and putting the first 2-3 floors. All that cost will be added to CWIP, including borrowing cost. Then in the next year we incurred cost to complete the structure. Then in the third year we incurred cost for flooring, tiles, furniture and all of that. So, furniture of course is a different thing. So, to the structural part of the building, whatever costs are being incurred, we will add it to capital work in progress account, and finally when it is ready on that date we will say that okay, a property, plant and equipment in the form of building is ready. Okay. So that is how accounting actually happens. And when should we stop? Once it is ready for its intended use. That is how you can understand. Now, after a property, plant and equipment item is ready, plant is installed, machinery is installed, I talked about AC, right? AC is installed and all of those things. Then how to deal with subsequent cost related to the property, plant and equipment. So, say for example, there is an air conditioner. Now, the air conditioner was installed. Over a period of time, the gas which is used for cooling the air, the gas got over. We have to incur the expenditure to refill the gas. Is that a capital expenditure? That is not a capital expenditure, because that does not increase the future economic benefits of that particular AC. So let us say initially the machine was performing this. Gradually the performance will reduce. Why is the performance reducing? As you use the asset, the performance starts declining. Then what did we do? Then we carried out some repair or servicing. Again it came back to original level. Again it is continuing at original level. Again it will dip. So if I am incurring any cost to bring the asset back to the condition at which it was initially performing, such expenditure are not capitalized. Such expenditure are expensed. That is why general repairs, general maintenance expenditure, general, let us say you have a bike. The bike you take for periodic servicing. So what will happen? Initially when you purchased, it was giving you, let us say, 50 kilometers per liter mileage. Gradually it dropped to 40. Again you carried servicing, it came back to 50 kilometers per liter. So that repairs and maintenance cost is not considered to be the cost of PPE. The other way to understand this is, these are periodic expenses which you will be incurring on almost an annual basis, okay, and hence such cost cannot be capitalized, okay. So whenever we talk about subsequent cost, day-to-day repairs and maintenance are taken to P&L. They are taken to P&L. They are not capitalized. So any day-to-day expenses that are incurred on a property, plant and equipment, some repair work here, some small part got damaged and all of that, those will be considered to be a revenue expenditure and they will be taken to the P&L. So any day-to-day repairs and maintenance, they are generally charged to the P&L. They are treated as revenue expenditure. But sometimes what may happen is, if we incur certain expenditure to increase the efficiency of the asset beyond its originally assessed capacity, or we are incurring some expenditure to enhance the production. So if we are incurring some expenditure which will give us more future economic benefits than what we were originally getting, then such expenditure can be capitalized. Then we also have replacement of parts of PPE and major inspections and overhauls, okay. Now these two things we can understand with the help of some examples. Let us say we are talking about an aircraft. We are talking about an aircraft. Now in the aircraft, for simplicity purpose, let us say there is engine, there is the body of the aircraft, and there are seats in the aircraft, okay. Now for simplicity's sake, let us assume this engine has a life of 30 years. Body also has a life of 30 years. But the seats, they have life of only 5 years. The seats have life of only 5 years. When you originally buy the aircraft, you buy everything at once. So you bought the engine, seats, body, entire aircraft. Of course, there are other parts also. All put together, let us say you paid 100 crores. You paid 100 crores. Now, these seats have to be replaced after 5 years. Seats have to be replaced after 5 years. And these seats are major part or major component of the aircraft. And once you replace the seat will last for another 5 years. Right? The seat will last for another 5 years. Now, this subsequent expenditure, whenever we are replacing a major part, should be capitalized. So, after 5 years, let us say we purchased in year 1, okay, and in year 6, we did the replacement of seats. Now, this replacement of seats, the cost should be capitalized, and you will subsequently depreciate this cost over the life of 5 years, okay. So that is one principle. When we come to depreciation accounting based on components, we will take examples for this. Then what happens to these original seats? When we purchased the aircraft, we purchased the entire aircraft for how much? 100 crores. Out of this, we are saying engine is 30 years, body is 30 years, other part is 30 years, seats are only 5 years. And after 5 years, whatever cost we incur for replacement, we will add it to the cost of the seats. will capitalize these as a separate component of the aircraft. What about these seats which are already there? This has to be de-recognized. These have to be de-recognized. So what happens is, we will estimate the cost of this seat and will depreciate it over a period of 5 years. We will estimate the cost of seat and will depreciate it over a period of 5 years. After 5 years, the new seats will get added to the aircraft components and will continue to depreciate that over a period of 5 years. These remaining parts will depreciate over a period of 30 years. So whenever a major component of an asset is being replaced, then that cost has to be capitalized. Say for example, one more example for us to consider, we have a UPS system. Now this UPS system has a UPS machine plus we have batteries. These batteries have a life of 4 years and this machine has a life of 15 years. So what we should do, this machine will depreciate over a period of 15 years, these batteries we will depreciate over a period of 4 years. After 4 years, when we buy the new batteries, we will capitalize the cost of new battery and we will de-recognize the cost or carrying amount of existing batteries. Sometimes what may happen is, we may have thought that, so if you see a furnace, okay, so the furnace is a place where heat is created like this, okay. So in the furnace, these internal linings that you see, okay, sometimes these linings may get damaged. Initially when you build the furnace, you thought that life is 10 years. But subsequently what happened? The linings got damaged. Now you have to replace the linings. Now when you have to replace the linings, it is a major part of the furnace. The cost to replace the lining will be capitalized and the estimated original cost of lining depreciated over the period will be de-recognized. Okay. Or let's say we talk about a turbine. Now this turbine has a motor component. Okay. Now this turbine has a motor component. When we bought this turbine, we thought it has a life of 10 years. After 3 years, the motor got damaged. Now this motor has to be replaced. It is a major part of the turbine. So the cost to replace the motor will be capitalized. So why should we capitalize? See, the original motor we thought has a life of 10 years. We used it for let's say 2 or 3 years. Then we bought a new motor. Now the life has extended. We got a new motor. Now this new motor has a life of another 10 years. So we got 2 more extra years to use it. And hence, it is giving us more benefit and hence the cost has to be capitalized. Now the existing motor which got damaged, that cost we have to de-recognize. Now there will be a challenge because originally we would not have separated the turbine and the motor. Everything was accounted as a single turbine. So what we need to do, we need to estimate the cost of the motor and we need to de-recognize that. So the parts of some items of PPE may require replacement at regular intervals. So some items may require regular replacements at regular intervals. The carrying amount of those parts that are replaced should be de-recognized, and if the efficiency of the asset increases by replacing parts, then it should be capitalized. So basically what it means, that existing you will de-recognize, new cost you will capitalize, as simple as. So parts of some items of PPE may require replacement at regular intervals. So the carrying amount of those parts that are replaced should be de-recognized and the carrying amount of new parts should be capitalized. Generally the assumption is that the new part that is being added will increase the efficiency or the life of the asset and accordingly we will capitalize that. Then the third category we have is major inspections and overhaul. Okay, what is this major inspection and overhaul? So if you are operating things like let us say aircraft or ships and all of that, there is a mandatory requirement after 2 years, 3 years, 4 years, you have to get a major inspection and overhauling done. So this major inspection and overhaul generally happen in the case of let us say aircraft or ships, where there is a requirement that let us say after you fly the aircraft for 3 years, after 3 years you have to carry out a major inspection. Whether there is default or not, whether there is any problem or not, each and every part has to be checked in detail. So this major inspection and overhaul generally happens in case of aircraft, ships, and sometimes for larger plants also, they will carry out a major inspection, say for example every 3 years. So what is the use of this major inspection or overhaul? So say an aircraft has flown for 3 years or a ship has been in operation for 3 years. Then in most of the cases law requires that you have to carry out a major inspection activity. Means each and every part, each and every component of the aircraft, everything will be checked. Everything will be seen if whether it requires repair or not. Whether there is fault or not, you still have to get this inspection done. Okay. See, normal repairs, when do we do? When there is a problem. But this is mandatorily to be done, whether or not there is any problem. And when you are doing this inspection or overall activity, what happens is if you find any problem, then you will try to correct that. Okay, you will correct that, not try to correct that, you will actually correct that. So, this is a major cost, and this major inspection or overall, generally let's say it's carried out over a period of 3 years. So, the cost that I am incurring to carry out this major inspection is actually extending or allowing me to use that asset for another 3 years. Okay, or you can think of it this way, that the utility of this inspection lasts for 3 years. So, the cost of major inspection and overhaul is added to the cost of PPE, because without that you cannot operate the plant, without that you cannot operate the aircraft, without that you cannot operate the ship. So, such cost is added to the cost of PPE. So, what about the existing overhaul cost? That existing overhaul cost will be derecognized. Okay, so basically let us say if we incur 10,000 on overhaul, this 10,000 will be depreciated over a 3-year period. This amount will become 0. Again, when you incur 10,000, that you will add to the cost of PPE. A condition of continuing to operate an item of PPE, for example an aircraft, may be performing regular major inspection for fault regardless of whether parts of the items are replaced. The inspection costs are recognized irrespective of whether the cost of the previous inspection was identified in the transaction in which the item was acquired or constructed. Meaning to say, when I purchase the aircraft, there is no requirement for inspection. The aircraft is in a working condition. The aircraft can be flown in the current condition. I will not pay separately for inspection. After 3 years, I have to carry out this inspection activity. So, after 3 years, when I carry out this inspection activity, the cost of inspection is added to the cost of PPE, because with that I can run the aircraft for another 3 years. I am getting the benefit for the next 3 years. So, then what about the existing inspection cost? So, we will have to estimate. When I purchased the aircraft, it was in a flying condition, what would have been my inspection cost at that point of time, and accordingly I will carry out the depreciation computation. Okay. So, what we will do to the existing WDV, we will add the cost of new part or new inspection and reduce the WDV of old part to get the revised WDV. So, what you will do, basically the cost of new part or new inspection you will add to the PPE, and existing WDV of the old part or old inspection you will derecognize. This, when we do a couple of questions, you will have more clarity. Okay. So, in a nutshell, day-to-day repairs and maintenance expensed. If we will get future economic benefits more than the original capacity, or if the efficiency improves, or if the life improves, then the subsequent cost will be capitalized. If there is a major inspection or overhaul, then that cost will be capitalized. If there is a replacement of major part, existing carrying amount derecognized, new cost will be added. Let's have a look at this question to get a better understanding of how does replacement of part work. Okay, same concept we can apply for your major inspection and overhauls as well. Bharat Infrastructure Limited acquired a heavy machinery at a cost of rupees 1000 lakhs. Just say 1000. The breakdown of its component is not provided. So, when we buy a lorry or heavy machinery here, breakdown of component is not provided. The estimated useful life of the machinery is 10 years. So, we will use it over a period of 10 years. At the end of year 6, at the end of year 6 means we started when did we buy? Year 1, nothing is given, so year 1. At the end of year 6 means after we have used it for 6 years, the turbine, which is a major component of the machinery, needed replacement as further usage and maintenance was uneconomical. So, after 6 years we are replacing the turbine. The remainder of the machine is in good condition and is expected to last for the remaining 4 years. The cost of the new turbine is 450 lakhs. Give the accounting treatment for the new turbine assuming SLM depreciation and a discount rate of 8%. Now, don't say, sir, we have not yet done depreciation. How can we compute? You have done it in foundation, right? Same logic will apply here. Okay. So, we'll come to depreciation, but this question is important for you to understand. Now, here the thing that you have to understand is we have purchased for 1000 lakhs. when we have to replace this turbine, so what has happened? Turbine we have replaced at 450 lakhs. Always remember, whenever a major component is replaced, we will add the cost of the new component or new part to the overall property, plant and equipment. So this 450 lakhs we have to add, there is no doubt. But the existing cost of turbine should be de-recognized. Do we have existing cost? No. Breakup is not available. So then what we will do? We will have to estimate what will be the cost of the turbine when we had purchased this particular machine. In other words, today we have replaced at 450 lakhs. Today we have purchased at 450 lakhs. 6 years back, what would have been the cost of this particular turbine? That is what we need to estimate. So what we will do is, computation of estimated cost of turbine in year 1. So cost in year 6 is how much? 450 lakhs. What have they said? Discount rate of 8%. So this basically what they are saying is, if something is worth 450 lakhs today, if you have to go back 6 years and compute, consider a rate of 6%. Think of it like inflation. Okay, so this is at year 6. At year 6 the value is how much? 450 lakhs. I need the value at year 0 or beginning of year 1. That means what do I need to do? I need to calculate the present value at this point. So this 450, I can say that this is my future value at year 6, correct or not? 450 is future value at year 6. What is the present value at year 0? That is what we need to compute. So this is like my future value. Period is 6 years. Rate is given to be 8%. What is the value at year 0 or beginning of year 1? Is equal to future value divided by 1 plus rate to the power of n, that is 450 divided by 1.08 to the power of 6. So 450 divided by 1.08 is equal to 1, 2, 3, 4, 5, 6. 283.576. That is 283.58 lakhs. Sir, what is this 283.58 lakhs? Again, think of it carefully. Today, the value is 450 lakhs. If I have to go back 6 years and estimate the value, then that value comes to 28358 lakhs. Or take yourself back to year 0 and say, okay, after 6 years, the value is 450 lakhs. What is the value today? 283.58 lakhs. So this is the valuation at year 0. Now, if you see, cost of machine is how much? Total cost of machine is 1000. Okay. How much is turbine? Turbine is estimated to be 283.58 lakhs and others is 1000 minus 283.58 lakhs, that is 716.42 lakhs. So what are we saying? See when we purchased it, the turbine was worth 283, the total is 1000 and others is worth 716.42. Then useful life was 10 years. Depreciation for 6 years is equal to cost, there is no residual value, divide by 10 into 6. So this is 600, 283.58 divided by 10 into 6, 170.15 and 716.42 divided by 10 into 6, it is 429.85. Okay. So what is this? This is depreciation. Depreciation for 6 years for turbine and for other components. So this is called what? Component depreciation. So what have we done? The total cost of 1000 we have split between turbine and others and depreciated for 6 years. So carrying amount 400, 283.58 minus 170.15, 113.43, and this is 286.57. Now how should you rate this? The total carrying amount of the machinery is 400. The estimated carrying amount of turbine is 113.43 and the carrying amount of other component is 286.57. Now what has happened is, on this date we replace this turbine. The old turbine goes out of the book, new turbine comes into the book. Sir, why are we doing this? It is a major part, and please understand, if the original turbine was expected to last for 10 years, the new turbine also will last for 10 years. Means we will get 4 years of extra life. Sir, but what will we do of the machine without the turbine? At least we can sell off the turbine separately, no? So we will de-recognize old part of 113.43 and we will recognize cost of new turbine of 450 lakhs. So then what will happen? Carrying amount will be, so here there is no adjustment. From the total we will remove 113.43 and we will add 450. So 400 minus 113.43 plus 450, we get 736.57. Now this is the new carrying amount of the machinery. Turbine is worth 450 and this is worth 286.57. Now on this 450, subsequently we will charge depreciation depending on what does the management estimate to be its useful life. Now this question is important. Please practice this a couple of times, and in place of this, if they had said that, okay, it is not about replacement of part, but it is about major inspection. They incurred a major inspection cost of so much after this many years, then for that also you will do the same treatment. Let's now have a look at the next question. So let's say there is a shipping company and this shipping company has purchased some ships. As per the requirement, the ship has to be brought in for a major inspection and overhaul after every 5 years. So there will be some docking area, or there will be some companies which would be carrying out this major inspection and overhaul. So there is a major inspection and overhauling requirement when every 5 years. This ship has a life of 20 years. So you will operate the ship for 20 years. After every 5 years, you have to take that ship to a particular docking area and there you have to get it inspected and overhaul has to be done. Right? Now, let us say the cost of the ship is 20 million. So when you purchase the ship, the cost of the ship is 20 million. So if you buy a new ship, you have paid 20 million to buy the ship. Okay? And this inspection will cost an estimated 5 million. So today, let's say if you have to carry out an overhaul and major inspection, the estimated cost is 5 million. What is the total cost? 20 million. Now understand this example very carefully. If I am going to buy a new car, okay, if I am going to buy a new car, when I purchase the new car, will I pay separately for maintenance or repairs on that day? I will not, because the car is in an operating condition. When I buy the car, it is fit to be driven on the road. But let us say after every 15 years you have to get a fitness test done. That point of time you will have to pay again for the fitness test and overhauling and all of that. The same thing for the ship. When I buy a new ship, do I pay separately for overhaul and maintenance? I will not. Why? Because the ship is in a running condition. So can I say that this ship is already in an overhaul condition? It is already in a running condition. Okay, the word used is overhaul. Overhaul means fully, completely. You are doing detailed inspection and you are correcting any defects. So a new ship is already in a running condition. I don't have to pay anything extra for that overhaul. So now when we pay 20 million and get a new ship, it is in a running condition. How long can I run that without inspection? For 5 years. After 5 years, today I have estimated that if I have to do an inspection, I'll have to spend how much? 5 million. Now, can I say that out of this 20 million that I have paid, because it is already in a running condition, can I allocate 5 million towards that overhaul and that repair part and 15 million for other cost of the ship? So, what I am saying, ship is in a running condition. Because it is in a running condition, a notional cost of 5 million I am attributing towards that inspection and overhaul that will happen today, and which has a life of 5 years. Why am I splitting this? Because after 5 years, I will need to carry out the inspection again, and 15 million is towards other parts of the ship. Okay. So, whenever we have overhaul or major repairs and inspection, which is a major component of our cost, we will segregate that and do the accounting. Okay. So, when we do the accounting, similar to the one which we did in the previous example and the previous illustration, what we did, same concept we are applying here. So, cost of ship and overhaul and repair, 15 million and 5 million. We are not paying this separately. We are paying 20 million for the ship. But what we are saying, the benefit of this 5 million will get only for 5 years. Okay. Depreciation for 5 years. How much will be the depreciation? See, useful life is 20. So, 15 divided by 20 into 5, and this is 5 divided by 5 into 5, which is 15 divided by 20 into 5, I get 3.75, and here I get 5. So, if I pull out a total column, this is 20 and this is 8.75. What is the carrying amount after 5 years? The carrying amount after 5 years is 15 minus 3.75, which is 11.25, and this is 0, and total is 11.25. Now, at end of 5th year, let us say we carried out the overhaul. And actual cost of overhaul turned out to be 6 million. So, revised carrying amount is 11.25 for the ship component, 6 for the overall component, and 17.25 total. Now, what will happen is, this 11.25 I will depreciate over the remaining 15 years, and this 6 I will depreciate over the remaining 5 years. So, depreciation per year, this is 11.25 divided by 15, same 0.75, and 6 divided by 5, this is 1.2. So, every year I will be depreciating on this basis after the 6th year. So, here what did we understand? Whenever there is a major part of an asset that we are acquiring, now that major part can be, let us say, in case of a machine, it can be turbine, it can be motor. For aircrafts, it can be, let us say, seats. For things like, overhauling cost, the overhaul cost itself is a major component. Okay. So, this is how we will do the calculation, separate the component and do the accounting accordingly. Now, having understood how do we initially recognize a property, plant and equipment, what is to be done with the subsequent cost that we incur, now we will move on to the next part, which is depreciation. This is something which you are already aware of. There is nothing new that you will be learning conceptually, but the type of questions that we see at CA intermediate level will be slightly of a higher degree in terms of difficulty. Okay, there will be way too many combinations, confusions and all of that, and that is where you have to be careful. Remaining the method of depreciation, how to calculate depreciation, what are residual value, all of these you have already learned. Okay, so it will be more like a recap with new types of questions. Now, when we say depreciation, please understand, we recognize a property, plant and equipment. This gives us future economic benefits for a period of more than 12 months, right? So, whatever is the PPE cost, what do? We show this cost as an asset in the balance sheet. In the balance sheet, a property, plant and equipment is the cost. And against this cost, we get what? Future economic benefit. So, when we come back to the matching concept, if I am getting benefit the cost should also be recognized, correct? Now, because I have shown the cost in the balance sheet, how will I recognize? I will recognize that using depreciation. So, depreciation is nothing but it is a systematic allocation of cost of PPE over the useful life. So, if I purchase, let us say, a car. Sir, why do you keep giving car example? Car is something which you can relate closely, okay? Then this example you can extend to anything else. So, if I say, let's say I purchase a car for my business at a cost of 10 lakhs and the life of the car is 10 years. The life of the car is 10 years and at end of 10 years, I expect that I will get a value of 1 lakh. This 1 lakh is called residual value. Now here conceptually one thing you have to understand, the question will tell you residual value. This 1 lakh of residual value is not the value that you will receive at the end of 10th year. This 1 lakh of residual value is today's estimate of a 10-year-old car. Means today, because this cost is as per today's value. So residual value should also be as per today's value. So today, what will be the value of the car? So today, what will be the value of a car which has run for 10 years? So if the asset has reached end of its life today, what will I get? I will get 1 lakh. This is called residual value. You don't need to do any fancy discounting, compounding and all of that. Conceptually, residual value means value as of today for a car which is 10 years. Okay. So this whatever amount I have paid, this is called cost. We already saw what are the components of cost. This 1 lakh is called the residual value. The difference between the cost and the residual value, cost minus residual value, that is 9 lakhs. This is called depreciable amount or depreciable value. Means what? We will compute depreciation considering 9 lakhs or we will depreciate 9 lakhs over the life of the particular asset. Okay. So, now how do we allocate this depreciable value over the life of the asset? See, there are multiple ways. One is called straight line method, SLM, straight line method. Second one is called WDV method, written down value method, or reducing balance method. Third one, sometimes we also use units of production method. So using this example, let us quickly see. If I do straight line method, straight line means what? Every year the depreciation amount will be same. So here depreciation is calculated as depreciable amount divided by useful life. Depreciable value is what? Depreciable value is cost minus residual value. So this is equal to 9 lakhs. 9 lakhs divided by 10 years, 90,000. What does it mean? Every year we will charge a depreciation of 90,000. In other words, the cost that is allocated to a particular year of this particular car is 90,000 under SLM method. Under SLM method, the assumption is that the benefit that we get will be equal over the life of the asset. Now this estimate of useful life, management can make estimate. So if you go to the MCA website and you click on Acts, you get the Companies Act. Alright. Now in the Companies Act, there is one schedule called Schedule 2. So Schedule 2, what does it tell us? Schedule 2 tells us what are the useful life to compute depreciation. So when you go to Schedule 2 of the Companies Act, which talks about depreciation for companies. So here you can see depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. The depreciable amount of an asset is the cost or other amount substituted for cost less its residual value. This other amount will come to it later. Useful life of an asset is the period over which an asset is expected to be available for use by an entity. So what is the period, what is the time period over which the entity will use it, or the number of production or similar units expected to be obtained. So that is where we will use the units method. That is where we will use the unit of production method. Then most important thing, useful life of an asset shall not ordinarily be different from the useful life specified in part C. So in part C of the schedule, they have said this should be the useful life normally. Can management use a different useful life? Yes, they can use a different useful life. They have said, okay, buildings other than factory buildings, 60 years, 30 years. So Companies Act has given a recommendatory thing that, okay, this can be the useful life. For exam purpose, you will get it, but you should also know what does the Companies Act say. Sir, can we use a different useful life? You can use the different useful life with proper disclosures and justification. Okay. Then another important thing, if you see here, provided where a company adopts a useful life different from what is specified in Part C or uses a residual value different from the limit specified above, the financial statement shall disclose and provide justification supported by technical advice. So that is what they have said. Now, what is the residual value? The residual value of an asset shall not be more than 5% of the original cost. This is again recommended. So what the Companies Act is saying, more than 5%, what the Companies Act is saying, the residual value should not be more than 5%. Okay. Can I have a different residual value? Yes, you can have different residual value. Then you have to give a proper justification. So, as far as depreciation calculation is concerned, we need the depreciable value, which is nothing but the cost minus the residual value. We need the residual value as per Companies Act. It has to be less than 5%. If we will follow what is given in the question. Then useful life is the life over which the entity will use that particular asset. So if I am expecting that I will use the car in my business for 10 years, the actual life may be 15 years, but I feel in my business the life will only be 10 years. I will depreciate that over a period of 10 years. Okay, that is the understanding. Now accounting entry is very simple. Depreciation account debit to car account or PPE account, 90,000. Now this is called net method. This is called net method, means I am directly crediting the depreciation amount to the car account. There is also a gross method where I pass an entry saying depreciation account debit 90,000 to accumulated depreciation 90,000. When I do this in the balance sheet, I will say car cost 10 lakhs. A lot of students make this mistake. They take 9 lakhs for disclosure purpose. No, you have to take the actual cost less accumulated depreciation 90,000. Carrying amount is 9 lakh 10,000. This is called carrying amount. This is called carrying amount. Okay. Now coming to WDV method. Now as far as WDV method is concerned, okay, here in the examination rate of depreciation will be given. In the examination, rate of depreciation will be given. You will not be required to calculate. Some odd cases where you may have to calculate the rate, very rare. Okay, it's not that they will be testing. Very rare. If you have to calculate the rate, then I'll tell you the formula with the help of which you can calculate. All right. Now, say for example, the rate of depreciation in this case works out to 10%. Now, this 10% is always on cost, not on residual value. Okay. So, how does it work? Cost 10 lakhs. Depreciation for year 1, 10% of 10 lakh, 1 lakh. Carrying amount 9 lakhs. Then second year depreciation for year 2. Now it will be 10% of 9 lakhs. It will be 10% of 9 lakh, which is 90,000. So carrying amount is 8 lakh 10,000. Then depreciation for year 3 will be 81,000. So 8 lakh 10,000 minus 81,000, you get 7 lakh 29,000. Okay, this is how you have to do. Now, for MCQ purpose, if you have to figure out these numbers quickly, then I'll give you some shortcuts. That is depreciation shortcut for WDV method or reducing balance method. So, cost is how much? Cost is 10 lakhs. Rate of depreciation is 10%. Now, let us say we have used that asset for 5 years. How can we quickly calculate the depreciation for 5th year. Depreciation for 5th year. Now, one way to do is 1 lakh into 10% minus into 10% and all of that. The faster way to do is year 1 depreciation. Year 1 depreciation is equal to 1 lakh. Okay. Year 2 depreciation will be 90% of this or 0.9 times. Okay. Then year 3 0.9 times, year 4 0.9 times and year 5 0.9 times. 0.9 into 1 lakh will give us year 2 depreciation 90,000 is equal to year 3 depreciation is equal to year 4 depreciation is equal to year 5 depreciation, which is 65,610. So this is year 1, year 2, year 3, year 4, year 5. This you can do to calculate quickly. Similarly, if you need WDV, let us say at the end of 4th year, how to do? Take the original cost 10 lakhs, original cost 10 lakhs into 0.9 first year into 0.9 second year into 0.9 third year into 0.9 fourth year. So 0.9 into 10 lakhs is equal to first year, second year is equal to third year is equal to fourth year. You get 656,100. Of this 10% is for the 5th year. So this is 5th year depreciation and this is WDV at the end of 4th year. Okay. This, as and when you practice more and more, it will help you to solve MCQs faster. That is the whole purpose. Accounting entry, same like we did for SLM, same thing will work. Now the third one is unit of production method or output method, what we say. Now what does that mean? See, my assumption under SLM method is that I will get benefit equally over the life of the asset. The assumption under WDV method is that in the initial years I will get more benefit, in the later years I will get less benefit. Now in unit of production method, the assumption is that benefit is linked to production. Now in case of car, the best indication is number of kilometer. So assume in year 1 I expect to run the car for 2 lakhs kilometer. Like this, in year 2 I expect to run the car for 1,50,000 kilometers. Year 3 some number, let us say 1 lakh. Year 4 1,20,000. Like this we can make estimate till year 10. Okay. Now the depreciation has to be allocated based on the unit of production divided by the total estimate kilometer. So here in year 1 how much am I expecting to ride? 2 lakhs. What is the total? Let us say total for 10 years is 15 lakhs. I am expecting to ride the car or use the car for 15 lakh kilometers. So what is the depreciation for year 1 under unit of production method? Year 1 depreciation is my depreciable value multiplied by number of kilometers divided by total estimated kilometer. So depreciable value is 9 lakhs into year 1 I ran for 2 lakh kilometers divided by total estimated kilometers of 15 lakhs. So 9 lakhs into 20 divided by, so 9 lakhs into 2 divided by 15, I get 1,20,000. Similarly for year 2 is how much? 1,50,000. So you will do 9 lakhs into 1,50,000 divided by 15 lakhs. You get how much? 90,000. So like this every year we will charge depreciation based on output. Okay, so output generally is, let us say, number of units, number of kilograms of some output produced. Here I said kilometer because that is what the vehicle is running on. Okay, so this is the summary of depreciation. Depreciation is the allocation of depreciable value. I wrote cost here. Cost or depreciable value is an appropriate word. Depreciable value of PPE over the useful life. Okay, depreciation depends on cost. What is the cost? What is the depreciable value and what is the useful life? Largely used is SLM, WDV or unit of production method. Okay, as we do more and more questions, you will get more comfortable with calculating depreciation. So a quick recap of whatever we have done. The depreciable amount of an asset should be allocated on a systematic basis. Systematic means it has to be dependent on how the benefits are derived. Either use SLM, WDV, unit of production, but it has to be systematic. basis over the life of the asset. So what is depreciable amount? Historical cost minus estimated residual value. Subsequently, we will understand something called as revaluation model. Okay. When we follow revaluation model, instead of cost, we will use the revalued amount. Once we do revaluation, you will be able to understand this. The depreciation charge for each period should be recognized in the statement of P&L. So what do? Depreciation is charged to the statement of P&L unless it is included in the carrying amount of another asset. So normally the thing is depreciation account debit to accumulated depreciation, then P&L account debit to depreciation. So this is the second entry. That is the meaning of charging it to the profit and loss. But sometimes what may happen is, let us say I am using a machinery for manufacturing of inventories. Then in that case, what will I do? In that case, I will not take it to P&L. I will add it to my cost of inventory. So I will debit the inventory account and credit the depreciation. Similarly, sometimes what may happen is I may be using a machinery to construct a building. So the depreciation on that machinery will be added to the building account and not to the P&L. When do we start depreciation? Very, very important for all of you to remember this, because ICAI keeps confusing students based on these dates. When to start depreciation? When the asset is available for use. Whether used or not does not matter. Whether you use it or do not use it, you will start depreciation from which date? The date on which the asset is available to use. And what is the meaning of asset being available to use? Our standard theory, that is, when it is in the location and condition necessary for it to be capable of operating in the manner intended by management. If I am the management, where do I want the asset to be? How should the asset be functioning? Is it installed? Is it ready? Yes sir, it is ready. We don't want to use it for 3 months, no problem, but depreciation will start from the date when it is ready for use. And till when do we charge depreciation? When will we stop depreciation? Depreciation stops or ceases means to stop, when the asset is retired from active use and is held for disposal, or the date that the asset is derecognized. So there are two things what the standard is saying. Number one, the asset is retired from active use. So I gave you one example, right? 10 years is the useful life of the car that I have purchased. After 8 years I have realized that this car is no longer useful to me. So after 8 years I have said, okay, I am not using this car, I will sell off this car. This will no longer be used in the business. On that date or from that date onwards, you will not charge depreciation. The date you have decided, yes, I have held it for disposal. Means I am no longer using that asset in my business. It is there with me. The car is still with me. I have not yet been able to sell the car, but I am no longer using that car. So the day I have retired it from active use, it is no longer being used, and if I have held it for sale, then from that date I will not charge depreciation. Or if the asset is derecognized, sometimes what may happen is I may directly sell it off, or the asset got damaged. Okay, so when I have derecognized it, meaning the asset is no longer a part of my asset base, then of course I can't charge depreciation. So the thing to remember, when it is available for use, from this date you will start depreciation. Then when you derecognize it, you will stop, or if you hold it for disposal, then also you will not charge depreciation. Then another thing, sometimes it may happen that temporarily we are not using the asset, but we have not hold it for sale. So let us say car is there for 2-3 months, I have not used the car. That does not mean I will not charge depreciation. Okay, if I am not using the car and if I want to sell it, if I am holding it for disposal, only then I will stop charging depreciation. Otherwise I will continue to charge depreciation. So temporarily if I am not using, even in that period I should charge depreciation. Then as we have already discussed, in some assets there are one or more significant components. So there we follow component accounting for depreciation. Like we took the example, right? Aircraft, engine has a separate life, seats have a separate life, major components. Okay. Similarly, we took an example of turbine, right? So whenever we have an asset or an item of PPE which has two or more significant components. Now, what could be these two or more significant components? More example, let us say you have a truck plus trailer. So if you see this, okay, now there is a truck, the empty body of the truck would look like this, and then you have put up a container there. Assuming for a moment the container has a lesser useful life, maybe in 5 years you have to replace the container, okay, but the truck has a life of 15 years and the cost of container is also significant. So if you have two or more than two significant component in an item of property, plant and equipment, you will capitalize them separately, depreciate them separately. In the balance sheet you may give a single presentation, but accounting you will do separately. Another example could be, though we don't follow that, let us say you are buying a computer, not the laptop, a computer. A computer has a separate monitor, a separate processing unit, okay. So maybe the monitor has a longer useful life, CPU has a shorter useful life. You can do segregation and you can do the accounting, right? Same way, let us say you buy a UPS system. Now in case of a UPS system, the battery will have a shorter useful life, the UPS will have a longer useful life, okay, because the lives are different and they have to be significant. Now don't think that, for this truck we will calculate tire separately, steering wheel separately, seat separately. No, they have to be significant. The component itself has to be significant, and accordingly you can do separate accounting. Another example where component accounting could be followed is, let's say there is a huge factory premise. Now in that factory premise there are multiple plant and machineries. You will not say that entire single factory is a single asset. You will try to segregate to the extent possible significant component. Again, we are not looking at insignificant or immaterial parts, right? Only the significant component. So if an asset consists of different and significant physical component, that is, if an item of PPE comprises two or more significant component with substantially different useful life, usage or flow of economic benefits, then each component should be recognized and depreciated separately over its individual useful life, right? When a significant component is replaced or restored, the old component is de-recognized and the cost of the new component is capitalized. So older component you will de-recognize, newer component you will capitalize. Land and buildings are separable assets and are accounted for separately even when they are acquired together. Land will account for it separately, building will account for it separately, because land has an indefinite useful life, whereas building has a limited useful life. Then sometimes cost of land may include cost of site dismantlement, removal and restoration. So we saw some examples, right? We purchased an old factory building, we have demolished that building, we have incurred cost for that, and now that land is ready for use. Maybe later on you will again construct something on that land. After 20 years, 25 years, again you have to dismantle. So the cost related to dismantling, removal and restoration will be depreciated over that period of 25 years. So till what time will you get the benefit out of that dismantling? Over that period only you will do the depreciation. Whereas land, because it has indefinite useful life, you will not depreciate. Meaning to say, if the cost is 10 lakhs total cost, okay, out of this you have incurred 1 lakh for demolition and restoration and 9 lakh for the normal land. This 9 lakh will not be depreciated, whereas this 1 lakh will be depreciated over the period in which you believe that you will get the benefit of that dismantling. So let's say I will construct a building and that building will last for 25 years. So this 1 lakh can be depreciated over 25 years. Then sometimes you can combine more than one depreciation method. Let us say, for some component you can follow SLM, for some component WDV, perfectly acceptable. Now let's have a look at few questions where we'll understand the calculation of depreciation and concept of depreciation. Entity A has a policy of not providing for depreciation on property, plant and equipment capitalized in the year until the following year, but provides for a full year's depreciation in the year of disposal of an asset. Is this acceptable? So what are they saying? They do not provide depreciation on PPE capitalized in the year. So if in the current year I am capitalizing an item of PPE, I am not providing any depreciation. But when we sell or when we dispose that asset, in that year we are providing full depreciation. Is this acceptable? Now, when should we start providing depreciation? We should start providing depreciation when the asset is ready for use. So even if the asset is ready for use for a part of the year, let us say in January the asset became ready for use. from January till April or January till March, we need to provide for depreciation. So the depreciable amount of a tangible fixed asset should be allocated on a systematic basis over its useful life. Useful life means the period over which the asset is expected to be available for use. Depreciation should commence as soon as the asset is acquired and is available for use. So, as and when the asset becomes ready for use, we need to provide for depreciation. Okay. So, the policy of the company for not providing for depreciation in the year of purchase is not acceptable, or in the year of acquisition is not acceptable. Yes, some companies do follow a policy that in the year of disposal, full year depreciation will be provided. That is still acceptable because it will have same impact on the P&L. So that is not a problem. Whereas you cannot say in the year in which I have acquired, I will not provide for any depreciation. Let's look at the next one. Entity A purchased an asset on 1st of January of year 13 for 1 lakh, and the asset had an estimated useful life of 10 years and a residual value of nil. On 1st of January of 17, the directors reviewed the estimated life and decided that the asset will probably be useful for a further 4 years. Calculate the amount of depreciation for each year if the company charges depreciation on a straight line basis. Now, these type of questions keep getting tested frequently in the examination. All right. So, what is that? They have purchased a asset for how much? For 1 lakh. Asset had an estimated useful life of 10 years. The asset is expected to last for 10 years. So, the question is, provide depreciation or compute depreciation for each of the year. So, let us see. So, whenever you get these type of questions in the examination, take care of the years very carefully. Okay, you should not be missing out on counting the number of years. That should not happen. So, purchased when? On 1st of January of 13, and when did they review? 1st of January of 17, means 13, 14, 15, 16. 4 years they thought they'll have a life of 10 years. Then on 1st of January of 17, they revised it for a further 4 years. That means they're saying that from 17, it will be useful only for 4 more years. So, cost of machinery only, right? Asset. Cost of asset. How much? 1 lakh. Useful life 10 years. Depreciation per year is equal to cost minus residual value divided by useful life. What is cost? 1 lakh. Residual value 0. Useful life 10. So how much? 10,000 per year. Now, for how many years will we charge 10,000 per year? Depreciation for 2013, 14, 15 and 16 is 10,000 per year. So, total depreciation for 4 years is equal to 40,000. Now, what happened? On 1st of January of 17, they have changed the estimate of useful life. Now, they are saying, earlier what they were saying, from 13 till 22, not 23, okay, 13 till 22, they will use it. In the year 17, when 4 years have been completed, we still have 6 years left, 17, 18, 19, 20, 21, 22. But now what they're saying, this will not be 6, it will be only 4 years. Now, always remember, whenever there is a change in the useful life or the residual value, 2 changes are possible. What are those? Useful life or residual value. Whenever the changes happen, from the date of change going forward, you will use the revised estimates to compute the depreciation. Because always remember, both this residual value and useful life are estimates. We are estimating what is the useful life. How many years can we use the asset? It is an estimate. Cost is not an estimate. Cost is an actual spending that you have done. Useful life is an estimate. Residual value is an estimate. How much will we get from this asset at the end of its useful life? is also an estimate. Whenever these two estimates change, we will compute revised depreciation from the year in which the change has happened. So here change happened in 17. So what do we need to do? We need to compute carrying amount as on 1st of January of 17. 1 lakh cost minus 40,000 we have already depreciated. The carrying amount is 60,000. Cost minus depreciation gives us carrying amount. Carrying amount is nothing but the opening balance of property, plant and equipment as on 1st of January. Or carrying amount is also called to be sometimes book value. Okay, different terminologies are used. 60,000 is the value as of 1st of January. Now, revised useful life. Revised useful life is how much? 4 years. So, depreciation from 2017 onwards is equal to 60,000 divided by 4, that is 15,000. So, from that period, 15,000 per year of depreciation will be charged. Let's look at the next question. Entity B constructs a machine for its own use. Construction is completed on 1st of November, but the company does not begin using the machine until 1st of March. Comment when the entity should start charging depreciation. I've told you already, and always keep this in mind. Once the asset is ready for its intended use, whether put to use or not, okay, don't get confused between what income tax act says. Here it is always when it is ready for use. So when was it ready for use? It was ready for use on 1st of November. So you will start charging depreciation from 1st of November itself. Now you may have a doubt, sir, why are we charging depreciation even though the asset is not being used or it is starting, we are using it after a delay? See, there are multiple factors that impact depreciation. One of the factor is time. So considering the time factor, we get into this rule that once the asset is ready for use, we should start depreciation. Look at the next one. A property costing 10 lakhs was bought in 2016. Its estimated total physical life is 50 years. However, the company considers it is likely that it will sell the property after 20 years. The total life of the asset, the economic life of the asset is 50 years. But what is the useful life? Useful life means how much? Useful life means for how many years will the company use? They will use only for 20 years. The estimated residual value in 20 years based on 2016 prices is 10 lakhs and 9 lakhs. Calculate the amount of depreciation. Now, for calculating depreciation, we need the depreciable amount. For calculating depreciation, we need depreciable amount. What is depreciable amount? Cost minus residual value. Cost is how much? 10 lakhs. First scenario, residual value is 10 lakhs. If the residual value is 10 lakhs, then the depreciable amount will become how much? 10 lakh minus 10 lakh? 0. So, will we charge any depreciation? No depreciation, because we are expecting that we will recover the entire value. We will recover the entire value of the machinery. Second, 9 lakhs. 9 lakhs means depreciable amount will be 10 lakhs minus 9 lakhs, which is 1 lakh depreciable amount. So depreciation will be 1 lakh divided by 20. That will be 5,000 per year. Simple and straightforward. These are more conceptual. Okay. No need to do these again and again for your examination or for your revision. Right. These questions are only for your conceptual understanding. Now, sometimes what may happen is carrying amount will be less than the residual value. Okay. So, say for example, cost is 1 lakh. Depreciation we have already charged 20,000. Now, carrying amount is 80,000. Today, when we estimated the residual value became 90,000. Which means we cannot further charge depreciation, and the standard requires reviewing the estimates of useful life as well as the residual value at each year end. So the moment residual value becomes more than the carrying amount, we will not be charging any further depreciation. B Limited owns an asset with an original cost of 2 lakhs. On acquisition, management determined that the useful life was 10 years. So originally it's 10 years. And the residual value would be 20,000. Residual value is 20,000. The asset is now 8 years old, means 8 years has passed by. And during this time, there have been no revisions to the residual value. At the end of year 8, so after 8 years have been completed, management has reviewed the useful life and the residual value and has determined that the useful life can be extended to 12 years. Now here extended to 12 years means what? Originally we thought it is 10 years, now we are saying it is 12 years. Not extended by. So when we say extended by 12 years, then we are saying we are increasing it by 12 years. That's not happening. And sometimes we may say from this state we will use it for 5 more years. That's a different scenario. In view of the maintenance program adopted by the company, as a result, the residual value will be reduced to 10,000. This is at the end of year 8. How would the above changes in estimates be made by B limit? So now in this case, what has happened? Originally, we bought something for 2 lakhs. Residual value was 20,000. 8 years we have used. So first thing that we have to do, so cost of asset. Cost of asset is how much? 2 lakhs. Always follow a proper structure so that you can do it better in the exam. Okay. Residual value 20,000. Depreciable amount 2 lakhs minus 20,000, 1 lakh 80,000. Useful life 10 years. Depreciation per year 1 lakh 80,000 divided by 10, 18,000. So how many years did they use? They used it for 8 years. So depreciation for 8 years is equal to 18,000 into 8. So 18,000 into 8, 8 8 is 64, 61, 144,000. This is the total depreciation for 8 years. Now, what is the carrying amount? Carrying amount means what? Carrying amount means the total cost minus depreciation. Carrying amount is equal to 2 lakhs minus 1,44,000. So 2 lakhs minus 1,44,000 if you do, we get 56,000. What is this? 1 minus 2. Okay, 2 lakhs minus 1,44,000, 56,000. At this stage, what did they do? They revised the useful life to 12 years. Earlier we thought 10 years. We have used it for 8 years. Now we are saying total life will be 12 years. Which means how many years of life is left? 4 years of life is left. So remaining life is equal to how many years? 4 years. Residual value is how much? Now residual value is 10,000. So depreciation for year 9 onwards till 12 year per year is equal to carrying amount is how much? 56,000 minus 10,000, the residual value, divided by 4. 56 minus 10, 46,000 divided by 4. 4 times are 40, 11,500 per year. So from year 8 on, so from year 9 onwards, you will charge 11,500 of depreciation per year. Let's now have a look at the next question. In year 1617, an entity acquired a new freehold building with a useful life of 50 years for rupees 90 lakhs. What did they buy? Building. The entity desires to calculate the depreciation charge per annum using a SLM method. It has identified the following components with no residual value of lift and fixtures at the end of their life as follows. So you have purchased something for 90 lakhs. What are the various components? Land 20 lakhs, roof 10 lakhs, lift 5 lakhs, fixtures 5 lakhs, remainder of the building 50 lakhs. The total is 90 lakhs. And each one having a separate useful life. Land indefinite or infinite life, that is land has unlimited useful life. There could be cases where, let us say the government says, okay, you can use this land only for 25 years. After that, you have to give it back to the government or something like that. Then land has limited life. Otherwise, land has indefinite life. Roof has 25 years. Lifts, fixtures, and remainder of the building Calculate depreciation for year 16-17 as per componentization method. So basically, we need to calculate depreciation. Now, there is no residual value of lift, fixtures, and they have also not given residual value of roof and remainder of the building. So very simple. Depreciation is cost minus residual value divided by life. So 10 lakhs divided by 25, 40,000. 5 lakhs divided by 20, 25,000. 5 lakhs divided by 10, 50,000. 50 lakhs divided by 50, 1 lakh. So total is 1 lakh 150 1 lakh 92 15000. So that is the total depreciation. Now see, in the examination they are saying calculate depreciation for 16-17. Calculate individually and also write the total amount of depreciation is 2 lakh 15. So quick recap of the concepts that we have done in depreciation. Factors determining depreciation. Depreciation is dependent on the cost. Sometimes we may follow the revaluation model where revaluation amount is also relevant. Then what is the useful life and what is the residual value? What is useful life? Useful life is the period over which an asset is expected to be available for use by an entity. So what you are saying, if there is an asset, for how many years or for what period of time are we going to use that asset? How many years will the entity use that asset? That is called the useful life. Or it can also be number of production or similar units expected to be obtained from the asset. So one is to look at it from the point of view of time. How many years? 5 years, 10 years, 15 years, right? We also saw the Companies Act schedule where they say, okay, these are the number of years. Otherwise, sometimes the entity may decide that, okay, years is not appropriate. Let us look at the output. How many units are being produced? I gave you the example of kilometer. So that also becomes the useful life. Then what are the factors that determine the life of the asset? One is expected usage. So typically, let us say if you have a machinery and the company runs for 8 hours per day, only one shift. Okay, then the machine may last for, let us say, 5 years. So there is a machine, my factory runs 8 hours a day, it will last for 5 years. If I move to a 3-shift factory, that is the factory runs 24 hours a day, will the machine run for 5 years? May not run, right? Because you are using more. So if your usage is more, then the useful life will come down. If you are using it for more number of hours every day, the useful life will come down. Then expected physical wear and tear. So how much is the asset likely to be physically damaged because of usage? Now to understand this, if I have to give a very simple example, let us say again going back to a taxi business. One taxi runs cars, same cars, okay, same cars, this runs on highway, whereas the other car runs on rough terrains, hills, jungles, okay, rocky surfaces. Which car will last longer? The car which will run on highways will last longer. Okay, so what will be the physical wear and tear? Okay, how it is exposed to physical damage, that also decides the useful life. Then technical or commercial obsolescence. Obsolescence means being outdated. So how quickly will the asset be technically or commercially outdated? So of late what happens is a lot of things are dependent on technology. New technologies keep on coming up, year after year. So if I purchase a machinery or if I purchase an asset, maybe after 2 or 3 years the technology becomes outdated. Newer technologies are available in the market which are more efficient. So if I have new technologies in the market, the older technologies I will not want to use, I will want to replace that. So for example, if you are using a mobile phone, okay, earlier we used to have landline. That single landline will last for 15 years. But now after every 2-3 years you will replace the phone. Why? Because new technology is available, new cameras are available, new features are available, right? So based on that, the life of the asset also changes. So if the technical change is happening frequently, the life will automatically reduce. So technical or commercial obsolescence. Obsolescence means being outdated, arising from changes or improvements. So either there are changes in the market or improvements in the market related to, let us say, production or change in the market demand for the product or service output of the asset. So multiple things are possible. One, the product that we are manufacturing, maybe the demand for that product itself will go down after 3-4 years. So if the demand for the product will not be there, what will be the machine of use? So I'll have to replace the machine. Okay. Or efficiency of the product goes down because of the technological changes. So you would have seen this, right? As and when new software updates happen, after 4 or 5 updates, your mobile will start functioning slow. Okay. So because of all of these factors, the life of the asset also changes. So similar things can also be seen in machinery. So for example, these days, if you look at a lot of products or equipments, they are highly technologically integrated. So you have like washing machines which are Wi-Fi enabled. Now, if I have to manufacture washing machines which are Wi-Fi enabled, the existing machineries may not be useful or sufficient to manufacture. I will have to replace the machine. There may be new machines available in the market which can produce more output. So instead of having my existing machinery which is producing lesser output, I may want to replace that. So because of all of these changes, the life of the asset also varies. So if technological changes are fast, if the machine becomes obsolete faster, the life is lesser. If there are very less technological changes, then in that case, life will be longer. So simple example, the table. A table does not have any technology, right? So this will have a life of 15 years, for example. But at the same time, if I am using some smart table, there is something else integrated in this table, then the life will be lesser. Legal or similar limits on the use of the asset. Sometimes you may be legally restricted to not use an asset beyond a specified period of time. For example, now they keep on saying in the Northern Capital Region, 10 years is the life of the vehicle. So after 10 years, you can't use the vehicle. Across the country, if you go, 15 years is the initial life. So you'll assume that 15 years is the life. After that, if you want to use, you have to get it fitness tested and all of those things. Okay. So if there is a legal restriction, that will restrict the life of the. So when we talk about useful life, don't get confused with economic life. For example, a car may run for 20 years economically without having any problem in the efficiency. But the government may say you can run it only for 15 years. So my useful life will only be 15 years. Or economic life may be 20 years. I want to use it only for 10 years. After 10 years, I want to sell the car. So useful life will be 10 years. Then we spoke about residual value. It is an estimated amount which can be recovered from the asset at the end of its useful life. So once the useful life ends, what is the amount that I can recover? What is the amount that I can realize? The estimate of that is called residual value. Residual value is a current estimate based on similar asset which would have reached the end of their useful life. As I told you, it is not the estimate of value after 20 years. It is the estimate of value of an asset which has lived 20 years or which has been used for 20 years as of today. Now you may have a doubt, sir, if there is a new asset in the market, there is no other similar asset in the market, how do we estimate? So even there is a management judgment. They would say, okay, if this asset was 20 years old, anyways, I'm thinking of using it for 20 years. If this asset was 20 years old, what would have been the residual value? Now, if a lot of cases, if you are not able to decide clearly, you can use, benchmarks like, let us say 5%, what we saw in the Companies Act. The estimation is made by the management at the time of acquisition. If the estimated residual value is insignificant, the value is considered as. If it is insignificant, maybe you buy a machine of 1 crore, and if the residual value is estimated at 10,000, you may very well know that as well. The residual value and the useful life should be reviewed at least at the end of financial year. So this is very important. At the end of each financial year or reporting period, you have to review the estimated life and the estimated residual value. Any change from expectation should be accounted for as a change in accounting estimate. Now, please understand, if I am changing the estimate of residual value or estimate of useful life, it is treated as a change in accounting estimate as per AS 5. The remaining depreciable amount should be depreciated over the remaining revised useful life. This we have already seen in a couple of questions. Now, sometimes there may be tricky MCQs related to residual value and carrying amount. If residual value is greater than or equal to carrying amount, you will no longer charge depreciation. Depreciation should stop. So, for example, 1 lakh is the cost. Depreciation charge so far is 80,000. Carrying amount is 20,000. Now, I am expecting that the residual value will be 25,000 or 20,000. If my residual value becomes greater than the carrying amount, I will not charge any further depreciation. But what if the fair value is more than the carrying amount? Means this is residual value at the end of useful life. Today the fair value in the market is 30,000. Should I say I will not charge depreciation? No, you should charge depreciation. You should continue to charge depreciation even if the fair value is more than carrying. When will you stop charging depreciation? If the residual value is greater than the carrying amount. What are the methods of depreciation? Depreciation method used shall reflect the pattern in which the asset future economic benefits are expected to be consumed by the entity. How will the entity consume the future economic benefit, or how will the entity get the future economic benefit? Based on that, the depreciation method has to be chosen. Now you can choose straight line depreciation, which is also called as SLM method. We have already seen. You will take the cost, you will reduce the residual value and divide it by useful life. Diminishing balance method, also known as WDV method. Here, based on the opening balance, you will calculate depreciation. Units of production method. Here it is based on expected use or output. Now, whenever we choose a method of depreciation, the management should consider true and fair view. Means the depreciation charge should reflect the true and fair picture. So, for example, if I am buying an asset, I know initial years the consumption or the usage will be higher or the benefits will be higher. Later years the benefit will be lower. Then should I choose SLM or WDV? I will choose WDV because initially I have to charge higher depreciation. So it should represent a fair picture of the way in which we are using the asset. Then prudence. Prudence is more like conservatism. We should provide for all anticipated expenses. So if, for example, I am not sure of how much will be the life of the asset. Okay, if I am not sure that how much will be the life of the asset, so I should take lowest possible useful life. So let us say 5 to 10 years is the expected life. Now should I charge depreciation over 10 years or 5 years? So I have to see realistically how much will I use, 5 years or 6 years. So accordingly I should charge. I should not extend it to 10 years and reduce the depreciation charge. Substance over form. Now this you will understand also in AS 19. Even if you don't own the asset, legally even if you don't own the asset, we'll have to provide for depreciation in terms of, let us say, a finance lease. That you will understand in AS 19. Okay. Or another way to understand substance over form is, legally I can use the asset for 10 years, but I am expecting to use it over only a 6-year period. So I should provide depreciation over 6 years. And materiality. So materiality means if there are small assets. Now say for example, I buy a mobile handset of 3,000 rupees for my office purpose. Okay, just to make calls. Is it a PPE? Yes, it is a PPE. But then if I start computing WDV rate of depreciation for that, or if I have to charge depreciation on SLM basis, it may be a very tedious exercise. Okay, small item is not significant in terms of overall assets of the company. So I can say that, okay, if it is less than 5,000 value, I will charge 100% depreciation in the year of acquisition itself while selecting the depreciation method. So these are the factors to be considered. Depreciation can be zero if the entity follows number of unit of production basis for depreciation and no production happens in a particular year. So if we are following unit of production method for my car example, and if in a particular year the car does not run, then the depreciation charge can be zero. In that case, we should consider impairment as per AS 28. Depreciation method should not be based on ratio of revenue. Now you may have a doubt, sir. You said you can have it based on output. Yes. Then why not based on revenue? What is the difference? My revenue is dependent on output? Not really. Your revenue is dependent on output and price. Price is dependent on demand and supply. So revenue always may not give a true picture of the usage of the machine, because revenue is dependent on a lot of external factors. So because revenue is dependent on demand, supply, inflation, sales volume, etc., you can consider output, but you cannot consider revenue. Okay. In very rare circumstances, if you believe that revenue is a true indicator of the economic benefit that you have got from the asset, then you can use it, but generally we will not consider. So for choosing the depreciation method, true and fair view, materiality, prudence and substance over form should be considered. Depreciation can be zero, in which case if you are following unit of production method. Depreciation method should not be based on ratio of revenue. Then sometimes we may have some additions or extension to an existing PPE. Say for example, we have a two-wheeler. we added one more seat. You get that extra seat and you convert that into 3-seater you see in some of those movies. Now this two-wheeler has a life of 10 years, and this extra seat that we are adding on the side, like, so if you have to see, so you can see it here, there is a bullet and there is a sidecar that makes it the third seat. Now you have added this sidecar. Now the two-wheeler has a useful life of, let us say, 10 years. Originally when you purchase, it's 10 years. Over how many years should I depreciate this sidecar? So that is the question. So let us say the original two-wheeler, the main two-wheeler, has a life of 10 years. This extra one seat, which is a sidecar, this has a life of independently 10 years itself. But you attached this sidecar after 4 years. Means two-wheeler will now be useful only for 6 years. Okay. The two-wheeler initially when I purchased, it was having a life of 10 years. After 4 years, I have attached a sidecar. Sidecar independently has a life of 10 years. But along with the motorcycle, if you see, you have only life of 6 years. Over how many years should I depreciate this additional sidecar? If the sidecar cannot be used independently, you will depreciate over the remaining life of the existing asset. Means, if this sidecar is of no use to me, other than attaching it to the bike has a life of 6 years, depreciate over 6 years. Whereas, if it can be used independently and has a separate identity, depreciate independently as if it is a separate asset. So, whenever you attach something to an existing asset, let us say I have a camera, I have attached one more lens, or I have purchased one more lens for this camera. Now, can I use that lens independently of this camera later also? If yes, then capitalize and depreciate separately. If no, add it to the original cost and depreciate accordingly, right? So like that in machineries also, if you are getting some additions, if you are carrying out some extensions, some modifications, then you have to see, can I use that extension or addition independently? If yes, then you will depreciate as if it's a new asset in itself. If no, then you will depreciate that over the remaining life of the existing asset. Then coming to impairment, this you will understand in AS 28. Whenever, so impairment means loss. Whenever the entity feels that the recoverable amount is less than the carrying amount, then you have to charge something called as impairment. Then carrying amount is considered to be the gross book value or the cost or revalued amount minus accumulated depreciation minus accumulated impairment loss. You get the carrying amount. When do we get impairment loss? If the benefit that we get from the asset is less than the carrying amount, there is an impairment loss. Okay. Right now, don't worry about it. When we go to AS 28, we'll understand in depth as to what is impairment, how it is computed, and all of that. Now, so far we have understood what is PPE, the meaning of PPE, when do we initially recognize it, at what value should we initially recognize it. Always remember, initial recognition happens at cost only. Then we spoke about what to do with subsequent expenses, when to charge it off to repairs and maintenance, and when can we capitalize, what happens to replaced parts and components. All of these things we have discussed, and then we also discussed about depreciation. Now moving on to another important aspect of the standard that talks about subsequent measurement. Subsequent measurement. So initially we measure at cost. Now when it comes to subsequent measurement, the standard gives us two choices. What are those two choices? One is called the cost model. This I am sure all of you are comfortable with, but still we'll cover that as well. And the second one is called the revaluation model. And in this revaluation model is where some of the students find difficulty in understanding. Okay, so please pay utmost attention. We'll practice enough questions and we'll ensure that we don't forget this for the examination. Okay. Now, sir, what is cost model and what is this revaluation model? Why revaluation and all of that we'll understand. So when we say cost model, it means initially recognized at cost. From this cost, every period you will reduce depreciation, which we call accumulated depreciation, and you will reduce impairment as per accounting standard 28. This gives you the carrying amount. This gives you the carrying amount. So when we follow the cost model, what do? Initially we recognize that cost. How to compute cost? We have already seen that. Then we will charge depreciation. How to compute depreciation? That also we have seen. Then we will charge something called as impairment. This we will understand in accounting standard 28. Okay, right now no need to break your head on this. For now, just understand this impairment is something like a loss. Okay. After adjusting depreciation and impairment, the value that you get is called the carrying amount, and this amount is shown in the balance sheet. So when you see in the balance sheet property, plant and equipment, you see the net carrying amount in the balance sheet. So in the cost model, there is no change. Okay, whatever initially you have recognized, you will continue to recognize at that value. From there, you will reduce the depreciation and impairment. So then what is this revaluation model? Revaluation model basically requires you to measure the fair value of the asset. Now, just to give you some context, let us say some land was purchased 10 years back. And 10 years back, the cost of the land was 10 lakhs. Okay. Now, land, as we know, we will not depreciate. Okay. Land has an indefinite or infinite useful life. We will continue to use that land. Today, if you look at today's value, the worth is 1 crore. The worth is 1 crore or 50 lakhs, whatever is the number. The value has increased. Now, what the standard says is, see, you have a land. The land was costing 10 lakhs. Currently, the value is 1 crore. So, if you show the land at 10 lakhs only, it may not give a true and fair picture. Okay. So, the standard allows an entity, it's not a mandatory requirement. The standard allows an entity to use something called as revaluation model to bring the value of the asset close to its fair value or market value. See, it can be upward valuation, it can be downward valuation also. But generally, even if the entity does not follow revaluation model and if the value of asset declines, it may be covered under AS 28. That is still possible. But if there is an increase in value of the land or value of any other property, plant, equipment, then in that case, showing at 10 lakhs, management may feel we are not representing a true and fair picture. So what we will do, we will do something called as revaluation and show it at 1 crore. So this model, revaluation model that we talk about, basically allows the management to bring the value of the asset to its fair value. Okay. So in the revaluation model, we measure the asset at fair value. Subsequently, any depreciation and all is charged on this fair value. Depreciation or if there is any impairment that is happening, that is done on fair value. Sir, is it possible that even after measuring an asset at fair value, there is an impairment loss? Yes, possible, because under impairment, you will see we measure something called as fair value minus cost to sell. So there may be a possibility of impairment loss also. Okay. So in revaluation model, so you will have fair value, which we call to be the revalued amount. From that, you will reduce accumulated depreciation. After you carry out revaluation, depreciation is based on revised fair value and you will consider accumulated impairment loss. So the other model where the standard allows the entity to show the asset at its fair value is called the revaluation model. So we have two models, cost model and revaluation model. Cost model we have been doing all throughout. Revaluation model, some of you may still remember, there was a small part in foundation, but still this is one where we will focus more. Okay. Now coming to revaluation model, what is the idea? To bring the asset to close to its fair value in the books. So if we take an example, let us say cost is 1 lakh, residual value is 20,000, life is 5 years. Okay, life is 5 years. So how will it look like? Date, particulars, amount. I am not preparing a ledger, I am preparing a statement. Okay. So year 1, cost 1 lakh. How much will be the depreciation? Depreciation is equal to cost 1 lakh minus residual value 20,000 divided by useful life. So 1 lakh minus 20, 80,000 divided by 5, 16,000 is the depreciation. So depreciation is 16,000. Carrying amount is 84,000. Then let us say in year 2, depreciation is again 16,000. So the carrying amount comes to 0, 0, 0, 14 minus 6, 8, and 7 minus 1, 6, 68,000. Okay. So like this, you will charge depreciation for 5 years. Say for a moment, after year 2 or at the end of year 2, the company chooses or the company decides to follow revaluation model for this property, plant and equipment. Is it allowed? Yes, it is allowed. There is no restriction. So they want to follow revaluation model. Revaluation model means what? We will revalue the carrying amount of property, plant and equipment. Now if you remember, you have done revaluation in partnership also. The same thing that is what we are doing here. Okay. So when we start to follow the revaluation model, we need to determine something called as fair value. Fair value. And let us say the fair value of this asset works out to 80,000. See, it is not necessary that it will always be an upward revaluation. It can be a downward revaluation also. But for our understanding, let us say this is 80,000. Okay. Now, difference between carrying amount and fair value. So fair value is 80,000, carrying amount is 68,000. This difference of 12,000 is called revaluation surplus. It is like a gain. It is like a gain. But please remember, it is not a realized gain. It is not a realized gain. This is called revaluation surplus. And this will be shown in the balance sheet as a separate item. You cannot pay dividend out of revaluation surplus. Okay. So here what is happening? We purchased an asset for 1 lakh. We used it for 2 years. The value became, or the carrying amount became 68,000. On that date, the management carried out a fair value exercise and figured out that the fair value of the asset is much 80,000. So what are we doing? In the balance sheet, if you see, cost 1 lakh, depreciation 2 years, depreciation 32,000. So 1 lakh minus 32,000, you get 68,000. So this is your cost model, or if you follow the cost model, you got 68,000. Now what are we saying? We are saying that this 68,000 is not reflecting a clear picture. It is not giving us true picture. We will increase this value to 80,000. Now if I am increasing something on the asset side, is it a gain or a loss to me? Always remember, if asset increases, it is a gain. If liability increases, it's a loss. So there is a gain. How much of gain? We calculated the gain to be of 12,000. That 12,000 of gain, you will say, is my revaluation surplus of 12,000. So here we increased by 12,000. The liability and equity side also increased by 12,000. A separate line item under your reserves and surplus, you will show revaluation reserve. Okay. Now, how do we increase this 68,000 to 80,000 in the books? That is the next question. So whenever there is a revaluation that is happening, we are increasing. Okay. How to increase? There are two ways. The first method is depreciation elimination method. First one is depreciation elimination method. What does that mean? Whatever depreciation balance you have, this you will transfer to property, plant and equipment account and bring the property, plant and equipment to 68,000, because in your books you have PPE account to bank 1 lakh, that was in year 1. In year 2, you have to balance brought down 1 lakh, and here you have by balance carried down 1 lakh. Okay. And accumulated depreciation you have in year 1 by depreciation or by P&L 16,000, and in year 2 also you have by depreciation 16,000. So you have 32,000, right? So that is how this number is presented. Now in the depreciation elimination approach, what we do is This depreciation accumulated of 32,000 we transfer to the PPE account. Means we'll debit this account saying to PPE account 32,000. So this account becomes 0. And here you will say by accumulated depreciation 32,000. Now after you pass this entry, what is the balance? 1 lakh minus 32,000, your balance is 68,000. This 68,000 I have to increase to how much? I have to increase to 80,000. So what do I need to do? So to increase, I have to pass an entry saying to revaluation reserve 16,000. So now after we pass this entry of transferring depreciation, what is the balance? The balance is 68,000. That 68,000 we have to increase to how much? 80,000. Means we need to increase it by 12,000. So you will put on the debit side to revaluation reserve or surplus, how much? 12,000. After you pass this entry for 12,000, what will be your balance? 1 lakh plus 12,000 minus 32,000. The balance will become 80,000. Okay, this is how we increase the value of property, plant and equipment when we follow the depreciation eliminated approach. When we follow the depreciation elimination approach. So what do we do? In case depreciation is eliminated, first thing, transfer balance of depreciation or accumulated depreciation account to PPE. Then pass entry for increase or decrease in PPE due to revaluation. Okay. So first entry, accumulated depreciation account debit, whatever is the number, to PPE account, whatever is the number. Okay. So this is what is called the depreciation elimination approach. Where what do? We transfer the depreciation balance to PPE balance and we will increase the balance in PPE to the fair value. Okay, that is the first method. So after you have eliminated depreciation, the next entry is to record the increase in value of PPE. Because we are increasing the value of PPE, we will debit PPE and we will credit revaluation reserve or revaluation surplus. Sir, what happens when it is decreased? We will understand subsequently. Okay. Now, in the same case, there is one more approach which is called gross approach. Then for revaluation, we have one more method which is called the gross or restatement approach. Now, what is this restatement approach? Very simple. Okay. Continuing with the same example, let us say cost is how much? 1 lakh. Accumulated depreciation we have computed 32,000. So what is the carrying amount? Carrying amount we got 68,000. What is the revalued amount? Revalued amount is 80. Revalued amount is 80,000. So what is the revaluation? 12,000 is the revaluation. Okay, this you are clear of. Now in the restatement approach, what we do is, see, we have to increase 68,000 to 80,000. So we are increasing by how much? 12,000. What is 12,000 as a percentage of 68,000? So if you compute 12,000 as a percentage of 68,000, how much do we get? So if you do 12,000 divided by 68,000, we get 17.64 or 17.65%. 17.65%. Okay. So how much should be the revaluation? So this approach says, because you are increasing it by 17.65%, increase this by 17.65%, increase depreciation also by 17.65%. So if I do that, here I'll get 17,650, and if I do into 32,000, I get 5647. I will round it off to 5650. Okay. In examination, if you don't get a round figure percentage, what you can do is you can simply say increase in this cost will be 1 lakh into 12 by 68, and increase in depreciation will be 32,000 into 12 by 68. So if you do that, you get 17,647 here, and here you will get 5647. I have rounded that to 17,650 and 5650. So what is the revalued amount? Revalued amount is 1,17,650 and 37,650. The difference will come to 80,000. So this is my revised PPE gross carrying amount, and this is my revised accumulated depreciation carrying amount. So the entry will be increase PPE by 17,650, increase depreciation by 5650. So increase PPE means debit balance have to increase. So I will debit PPE account. How much? 17,650. 2. I have to increase accumulated depreciation account, which is having a credit balance. So I need to credit that. So I will say to accumulated depreciation account 5,650. And the difference between these two, we will transfer to an account called revaluation surplus account 12,000. So a quick recap of whatever we have done so far in revaluation model. Revaluation model means we are bringing the asset to fair value. To bring the asset to fair value, there are two approaches. One is the depreciation elimination approach. That is, you close the depreciation account and transfer the balance to the PPE account. Second is increase or decrease. See, here it is increase, there can be decrease also. Change the cost and accumulated depreciation in proportion of what has changed as the overall net carrying amount. So in restatement approach, number 1, compute revaluation amount. It can be positive, negative by carrying amount. Then new gross amount is equal to old amount plus old amount into revaluation amount divided by carrying amount. No need to remember this formula. As you practice, you will get to know. And new accumulated depreciation account is equal to accumulated depreciation plus accumulated depreciation into revalued amount divided by carrying amount. So whatever is this revaluation amount, you divide by original carrying amount, you get the individual numbers. Okay, so you will get the ratio of 12,000 by 68,000, multiply it with cost and multiply it with accumulated depreciation. Where will you take the credit to? You will take the credit to revaluation surplus, right? So this is how we carry out revaluation accounting. Now, after this revaluation happens, subsequent depreciation should be based on revalued amount only. Subsequent depreciation should be based on revalued amount only. That is, what is the revalued amount? Revalued amount is 80,000 less residual value. We thought it will be 20,000. So now we are left with how much? 60,000. How many years have passed by? 2 years have passed by. So remaining life is equal to 3. So depreciation is equal to 60,000 by 3, 20,000. So earlier we were charging depreciation of 16,000 per annum. Now we will charge depreciation of 20,000 per annum. Okay. So how do we calculate revised depreciation? Take the revalued amount. Don't take the restated cost. You have to take the revalued amount or fair value on the date of revaluation. From that, reduce the residual value. How much life is left? 3 years is left. So 20,000 is the depreciation. So what happens? If you see years 3, 4, 5, depreciation on original cost would have been 16,000, 16,000, 16,000. Depreciation on revalued amount is 20,000, 20,000, 20,000. So what is the difference? Difference is 4,000. Difference is 4,000. Sir, what is this difference about? This difference basically represents excess amount debited to P&L. Because we have increased, in this example, we have increased the value of the asset. So, excess amount debited to P&L is how much? 4,000. And if you see 4 plus 4 plus 4, total excess amount debited to P&L is how much? 12,000. That 12,000 we have accumulated in revaluation reserve. Okay. Now, here is the most important part of revaluation treatment. That is, I have charged extra 4,000 of depreciation in P&L. So, what the standard says is, see, you have booked a gain in revaluation surplus. You have booked a gain in revaluation surplus. This extra depreciation, what you can do, you can transfer from revaluation surplus to retained earnings. Okay, so you can transfer from revaluation surplus to retained earnings this 4,000. The idea is, impact, see, excess debit to P&L is 4,000, correct? We have debited extra 4,000 to P&L, which means reduced profit and hence retained earning balance. How much? 4,000. See, if I charge 4,000 more to the P&L, my retained earning balance will go down by 4,000. This 4,000 can be compensated by passing this entry, that is revaluation surplus 4,000 debit. Please remember, revaluation surplus has a credit balance. We are debiting this to retained earnings 4,000. So, standard says periodically you can transfer from revaluation surplus to retained earnings to the extent of excess depreciation. That is the first option. Second option is, if you don't want to transfer, don't transfer, no problem. Keep it in revaluation surplus. When you finally sell off that asset, when you finally dispose of that asset, then transfer the revaluation surplus balance to the retained earnings account. But you can never transfer this revaluation surplus amount to P&L. This is not allowed. You cannot route it through P&L. Logically, if you see, I am charging 4,000 extra depreciation in the P&L. That is, boss, as per your choice. You wanted revalued amount, show depreciation as per revalued amount. What option the standard is giving is, okay, you have charged 4,000 extra depreciation. To that extent, you can transfer from revaluation surplus to retained earnings. One option. Second option, don't do anything, transfer it at the end of the period. Okay. So far, whatever we have discussed, suddenly it may appear too much to assimilate or understand. So what we will do, quickly we will recap everything and ensure that you have remembered each and everything from the treatment that has to be given for revaluation. Okay, first time, yes, it can seem challenging, no need to worry. Now when we run through the theory once again, you will get utmost clarity. Measurement after recognition or subsequent recognition, we can follow cost model or the revaluation model. Under the cost model, we will take the initial cost, accumulated depreciation and impairment loss. Under the revaluation model, we will take fair value on the date of revaluation, subsequent accumulated depreciation and subsequent accumulated impairment loss. In one of these two ways, we can do the subsequent measurement. Now, whenever entity follows a revaluation model, what should be the frequency? We should carry out with sufficient regularity to ensure that carrying amount does not differ materially from that which would be determined using fair value at the end of the reporting period. Basically, what it means is, it is not that you do once in 10 years. If you do once in 10 years, carrying amount will be very different from the fair value. You have to do it at sufficient intervals. You have to do at sufficient regularity such that the carrying amount is a close approximation of the fair value. Okay. The frequency of revaluation depends on the changes in the fair value of the items of PPE. If PPE experiences significant and volatile changes in fair value, there must be annual revaluation. Otherwise, you can revalue in 3 to 5 years. So this is one thing you can remember for MCQ. The standard says, if there is wide fluctuation in fair value, today the fair value is 1 lakh, next year fair value will be 3 lakhs, then again fair value will come down to 2 lakhs. Extreme volatility. If you see extreme volatility, then in that case, you will do annual revaluation. Okay. Extreme volatility means, look at a player, someone will score century in one match, then for 10 match he will not perform. Then again 1 century will score, again he will not perform. So there is a lot of volatility in performance. Similarly, if there is a lot of volatility in the fair value, you need to do annual revaluation. However, if the fair value does not change significantly, then you can do once in 3 years or 5 years, depending on the management judgment. But one thing you have to keep in mind, whenever you do, or you should do it at such frequency so that the amount that you show in the books are not significantly or materially different from their respective fair values. Okay, that is the frequency. Now, what do we do with accumulated depreciation on the date of revaluation? We discussed two approaches. One is depreciation elimination approach, second one is restatement approach. What do we do in depreciation elimination approach? We will debit whatever is there in accumulated depreciation and will credit that to PPE. Basically, we will transfer the accumulated depreciation to the PPE account. In other words, we will bring the PPE account to the carrying amount itself. Accumulated depreciation is eliminated against the gross carrying amount. So, this thing, right? Initial cost, what we say, this is called the gross amount or gross block without depreciation. In the restatement approach, it is restated proportionately with the change in carrying amount. So, once again, a quick recap. If 100 is the cost and if accumulated depreciation is 20, carrying amount is how much? Carrying amount is 80. Let us say revalued amount works out to 60. Revalued amount is 60. So, what has happened? There is a reduction of 20. Reduction of 20 means reduction of 20 out of 80. So, here you will do 100 into 20 out of 80. 100 into 20 by 80. Here you will reduce by 25 and 20 into 20 by 80. Here you reduce by 5. So, this will become 75. This will become 50. Carrying amount will be 60. So, whatever is this proportion 20 by 80, that is revalued amount by carrying amount, whatever is the proportion, with that proportion either you will increase the gross block and the depreciation or you will reduce the gross block and the depreciation. Okay. The revalued amount should not be more than recoverable amount as per AS 20. This when we do impairment, that point of time we will understand. Then the standard says revaluation is to be made for the entire class of asset or entire class of PPE. What is the meaning of that? Say for example, company has office building at two locations. Okay, so let us say one is at Mumbai and the other one is at Chennai. Okay, these are the two office buildings. Right now, the company wants to revalue this Mumbai property because the value has gone up. They don't want to revalue Chennai property because the value has gone down. What the standard says is, once you have touched a particular asset or an item of PPE in a class of asset, you have to do the revaluation for all the assets in that class. Now, sir, what is this class of asset? Class of asset basically means assets which are similar in nature, which have similar use. So, for example, buildings are similar in nature, they have similar use. Office building is different from factory building. Factory building, the usage is very different. Factory building, the nature is very different. Office building and office building are same. Office building and factory building is not same. So what they're saying, if you are doing it for office building, which is a class of asset, then you have to do it for all the assets which are falling in that office building class. Similarly, if you are doing for factory building, do for all factory building. If you are doing for land, do for all the parcels of land. If you are doing, let us say, for air conditioning equipment, do for all the air conditioning equipment. Okay. So whichever asset you pick up in an asset class, or if you have decided to do revaluation for an item in an asset class, you have to do it for the entire class. So think of it like if you are looking at a school, you have class 1, class 2, class 3, standard 1, standard 2, standard 3, like that till standard 10. Each student is like an item of PPE. Each student is like an item of PPE. If I want to revalue the marks of one student, I have to revalue the marks of all the students. Okay. But if I have revalued the marks of class 1 students, it is not necessary that I revalue the marks of class 2 students. Are you able to understand? So if I pick a particular class and I say, no, I will revalue only this student marks, then what will others do? Others will feel bad. Of course, assets where there is nothing to feel bad, but what the intention of the standard is, management cannot be selective. You cannot say, I will revalue this asset, I will not revalue this asset, because one place I am getting a gain, another place I am getting a loss. That is not allowed. So if you are picking up a class, you have to do it for the entire class of asset. All right. If the entity takes a decision to revalue its building, for example, it should revalue all the buildings of the entity. Revaluation of selective assets within a class is not permitted. The entity can divide the PP into classes based on the nature of items like land and buildings, machinery, ships, aircrafts, etc. And different usage can mean different classes. Office building separate, factory building separate. Cars which are used for director is separate. Cars which are given on hire can be separate. Okay, that can be separate class. But if you decide to revalue the car given on hire, all the cars given on hire should be revalued, right? So that is about revaluation of a class of assets. Now, moving on to the accounting aspect. What do we do with the revaluation surplus or revaluation loss? See, there are two scenarios. One is you increase the value of asset. In that case, we say there is a gain. And if you reduce the value of the asset, there is a loss. How do we deal with it? Very simple and stepwise framework is there. Don't get unnecessarily confused or scared. I see a lot of students get scared because of the language used. So I have simplified it to the extent possible. Just follow this framework. You will be through in this particular concept. Okay. So first is, what do we do when there is first time revaluation? In the first time revaluation, what is to be done? First time revaluation, always remember, if there is a gain, we will take it to revaluation surplus. If there is a loss, we will take it to P&L. If it is first time, gain, revaluation surplus, loss, P&L. If required, write this down in the notebook itself. Okay. So whenever there is an upward revaluation or a gain, you will credit it to owner's interest under a heading called revaluation surplus. This is presented under reserves and surplus. Dividend cannot be paid out of this. All right. Then if there is a downward revaluation, you will charge to P&L account. You will debit it to P&L account. See, downward revaluation means what? We are crediting PPE. Here we are debiting PPE. Okay. Whether it is gross method or whether it is, depreciation elimination method, we are increasing the value of PPE on a net basis. So debit is PPE. Here credit goes to revaluation surplus. Here credit is PPE. Debit goes to profit and loss account. So upward revaluation PPE account debit to revaluation surplus. Downward revaluation P&L account debit to PPE account. Okay. Till the time you are able to recall this on your own, you keep on revising, because in examination you should not struggle as to what is to be done when there is upward and downward revaluation, and questions from there are highly scoring. There is no scope to cut any marks. All right. Okay. Then subsequent revaluation, what is to be done? So now for subsequent revaluation, what is to be done? Let us continue with our same example. We had a revaluation surplus in our example of 12,000. Assume this 12,000 is kept in revaluation surplus only, nothing is transferred to retained earnings. In the next year, there is a downward revaluation because fair value changed negatively. And downward revaluation, multiple scenarios are possible. First scenario, fair value is 50,000. Second scenario, fair value is 40,000. Okay. This is what after 1 year. Now, in year 3, what was the opening balance? Opening balance was the fair value. Correct. Opening balance PP was the fair value, and fair value we computed as 80,000. And if you see, the revalued amount we computed as 80,000. Correct. And depreciation of 20,000 per year is being charged. So in year 3, what is the depreciation? Depreciation for year 3 is 20,000. So what is the carrying amount? Carrying amount now is 60,000. So at the end of year 3, after revaluation in year 2, carrying amount is 60,000. First scenario, fair value is 50,000. Fair value is 50,000. Second scenario, fair value is 40,000. Now, if fair value is 50,000, how much is the revaluation loss? Revaluation loss is 10,000. Here the revaluation loss is 20,000. Right? Okay. Now, how do we treat with this revaluation loss? The standard says, first go and check how much is there in revaluation surplus. So you go back, you open the revaluation surplus account and say how much is the balance. Revaluation surplus balance, what you have, is 12,000. Revaluation surplus balance is 12,000. So what the standard says is, if you have balance in revaluation surplus, first draw from the revaluation surplus, or first utilize that revaluation surplus. So you go and you knock. So you go and you knock the revaluation surplus and say, how much balance do you have for this asset? Not for all the assets. For this asset, how much balance do you have? Revaluation surplus says, I have 12,000 of balance. Okay. How much is the loss? 10,000. Can you absorb? Of course, yes, I can absorb. I have 12,000. I can fully absorb. So I say this entire loss of 10,000 will be transferred to revaluation surplus. So you will say debit revaluation surplus 10,000, credit PPE 10,000. All right. Now there could be one more scenario where revaluation surplus is not 12,000 but revaluation surplus is 8,000 because we have transferred 4,000 from revaluation surplus to the retained earnings. In that case, the balance is not sufficient. So treatment will be as per this. Now in the second case, you go and ask the revaluation surplus, what is your balance? He says 12,000. So there is a shortfall of 8,000. Don't get confused between this 8,000 and this 8,000. Okay, this is coincidence. 12,000 is the balance in revaluation surplus. My loss is 20,000. 8,000 is the shortfall. So what do we do in that case? We will utilize full revaluation surplus of 12,000. Credit PPE. How much? 20,000. We have to reduce the PPE value by 20,000. The balance will be debited to P&L, that is 8,000. So the idea is, if first time there was an upward revaluation and subsequently if there is a downward revaluation, first priority is check what is the balance in revaluation surplus. If balance available, utilize that balance. Utilize that balance means debit revaluation surplus, don't go to P&L. If balance is not sufficient in the revaluation surplus, then you have to go and open the P&L and you have to transfer the balance to the P&L. Okay, so this is the entry. So for subsequent revaluation, if first time is an upward revaluation, earlier we had done upward revaluation, we had increased the value of asset. Now subsequently also we are doing upward, then no problem, directly add to revaluations. But subsequently if you are doing a downward revaluation, use existing revaluation surplus, whatever is available, balance transfer to P&L. Okay. Then if first time there was a downward revaluation, earlier we had done a downward revaluation, now we are doing again downward revaluation, what is to be done? Debit to P&L. Now if you are doing upward revaluation, then you have to go and ask, for this asset how much did I debit to P&L earlier? Because first time downward means we have debited P&L. How much did we debit to P&L? To that extent you will credit to P&L, balance you will credit to revaluation surplus. So in this scenario, when first time there is a downward and subsequently there is an upward revaluation, you will debit PP because you are increasing the value to P&L for whatever you have transferred earlier and balance to revaluation surplus. Okay. There could also be deferred tax impact as per accounting standard 22 when we go there, and at your level it is not very much tested, but definitely we will touch upon when we go to accounting standard 22. Now whatever revaluation surplus balance we have accumulated, standard gives us two options. We have already discussed that. Option number one, the surplus may be transferred directly to retained earnings when the asset is derecognized. So basically meaning, don't touch the revaluation surplus. Okay, don't transfer anything to retained earnings. When the asset gets disposed of or when the asset is derecognized, at that point of time, the balance you transfer to retained earnings. That is option number one. What is option number two? Option number two means the surplus may be transferred as the asset is used by the entity. Basically, depreciation as per revalued amount minus depreciation as per original cost. Whatever is this difference, the 4,000 difference that we computed, right? That difference periodically you can transfer from where? From revaluation surplus to where? To retained earnings. Sir, can we transfer to P&L? Never. You can never transfer revaluation surplus amount to P&L. Alright, let's now have a look at the next questions. Entity A is a large manufacturing group. It owns a number of industrial buildings such as factories and warehouses and office buildings in several capital cities. So, manufacturing group, it has factories, warehouses, etc. The industrial buildings are located in industrial zones, whereas the office buildings are in central business districts. So basically the warehouse, the industrial buildings are in industrial zones. So if you look at any towns or cities, there are specified industrial zones, and the office buildings are in central business districts, maybe in the center of the city. Entity A's management wants to apply the revaluation model. Can they apply? Of course you can apply to the subsequent measurement of the office buildings, but continue to apply historical cost model to the industrial building. Okay, so what they're saying, they want to apply for office buildings, they want to apply revaluation model, and for the industrial building, they want to apply the cost model. State whether this is acceptable under AS10 or not with reasons. Now, as per AS10, a revaluation model has to be applied based on what? Based on class of assets. Now, what is a class of asset? Class of asset is a group of asset which has similar nature, similar purpose. For the purpose of the standard, office buildings are a separate class. The factory buildings are separate class. Okay, each one has its own class. So, can I say I want to revalue one class and not revalue the other class? Permissible. It is absolutely allowed. But if I am applying the revaluation model to one class of asset, then all the items in that particular class have to be revalued. So, okay. So here, because the office building is a separate class of asset, industrial building is a separate class of asset, I can apply the revaluation model to one and not apply to the other. A company can choose to apply a cost model or revaluation model to measure PPE and must apply a single policy to a class of PPE. A class of PPE is a group of assets of similar nature and use in the operations of the enterprise. So this is the theory you have to write. The office buildings can be directly distinguished from the industrial buildings in terms of their function, their nature and location. And AS10 permits assets to be revalued on a class by class basis. So each class you can do a separate valuation. The different characteristics of the building enable them to be classified as different PPE classes, and the different measurement models can therefore be applied to these classes for subsequent measurement. Hence, entity A's management can apply revaluation model to the office building, but all properties within the class of office building must be carried at revalued. Simple and straight. Then let's look at the next one. Very simple. You have already seen this. Just a quick recap for our understanding. A Limited has an item of plant with a cost of 1 lakh. At the date of revaluation, accumulated depreciation is 55,000. So initially, to avoid getting confused, just write down 1 lakh cost. Accumulated depreciation 55,000. Carrying amount 45,000. The fair value of the asset by reference to transaction in similar asset is assessed to be 65,000. So fair value is 65,000. How much is revaluation? Revaluation surplus is 20,000. Okay, how do we account for it? Now the question has not said whether to follow depreciation elimination approach or whether to follow gross. You can assume one of them and do, and if time permits, do both the ways, because sometimes ICI is crazy. I have seen cases where they wanted students in CA final, same concept is there. They wanted students to solve using both the methods because they did not specify which method is to be done. So one is you can eliminate the accumulated depreciation, whatever is 55,000. This has a credit balance. So now you will debit that. So debit accumulated depreciation, credit the asset account 55,000, 55,000, and then revaluation surplus, debit to asset account, credit to revaluation 20,000. But if you want to restate, how will you do? So you will see what is the proportion, 20,000 out of 45,000. So here you will say 1 lakh into 20,000 divided by 45,000. This also 55 into 20 divided by 45,000. So 1 lakh into 20 by 45. 1 lakh into 20 divided by 45. I get 44,444. So 44,444.44. So that is 14444.44. And this will be 55 divided by 45 into 20. 24,444.44. So 55 plus 24 is 79. 55 plus 24 is 79. 444.44. So 14 minus 9, 5, and 13 minus 7, 6, 65,000. So that is also possible. In that case, what will be the entry? In that case, you will not pass the first entry, you will just pass one single entry. Debit PPE 44,444. Credit accumulated depreciation 24,444.44, and credit revaluation surplus 20,000. See, under both the methods, the amount that you will credit to revaluation surplus is not going to change. Alright, let's look at the next question. Arca Limited purchased a machinery for 3,000 lakhs. Depreciation was charged at 10% on SLM basis for a useful life of 10 years. See, if they have told 10%, and of course, if there is no residual value, it has to be 10 years. So another things, another reason why they mentioned is 10% on SLM basis when they have said, and 10 years means there is no residual useful life. The other thing is 10% on SLM basis you will apply on cost, not on depreciable amount. Whether it is WDV rate or whether it is SLM rate, the rate is applicable on cost only. Okay, please keep that in mind. At the end of year 4, the machinery was revalued to 2,700 lakhs and the same was adopted. What will be the carrying amount of the asset at the end of year 5 and year 6, assuming no change in useful life? So, first, cost of plant. How much? 3,000. Then depreciation as 10% for how many years? For 4 years. So, depreciation at the rate of 10% for 4 years. That is 3,000 into 10% into 4. So, 1,200. Which means carrying amount at end of year 4. See, you have to calculate the carrying amount till the date of revaluation. Okay, so that is one thing you have to keep in mind. This is 1,800. Revalued amount. They revalued the amount to how much? 2,700. So, revalued amount is 2,700. Hence, revaluation surplus is 900. How do we get that? 2,700 minus 1,800. Okay, so that is the thing. Then, what will be the carrying amount of the asset at the end of year 5 and year 6? So, this is still year 4. Okay. Now, remaining useful life 6 years. Revised depreciation per year is 2,700 by 6. You will always take the revalued amount and divide it by useful life. If there is residual value, you will reduce the residual value from the revalued amount. So 2,700 divided by 6, if I do 6 4 is 24, 3, 6 5 is 30, 450. So carrying amount at end of year 5 is equal to 2,700 minus 450, you get 2,250, and at the end of year 6 is equal to, so this is basically 2,700 minus 450, and this is 2,250 minus 450. If I do, I get 18. Okay. The same thing has been presented here in a neat tabular format for exam. Now, so far what we have done, we have talked about recognition. Then we also talked about measurement. Measurement means at what value should we measure the property, plant and equipment. Measurement we talked under initial as well as subsequent. Correct. Now, there are some small aspects that we need to discuss. We'll do that towards the end. The next part of the standard talks about derecognition. Recognition means recognizing in the books. You pass an entry, you create a property, plant and equipment as an asset in the books. That is called recognition. Derecognition means you are moving that property, plant and equipment out of the books. Now, when do we derecognize? We will derecognize it either when we have sold it off, we have disposed it off, or we don't expect any future economic benefits. Remember, for recognition, what was the criteria? We need future economic benefit. Now, if I realize that I will not get any future economic benefit, then I will not continue to recognize that asset. I will derecognize that asset. Then, whenever I derecognize the asset and if I receive some amount, for example, if I sold the asset, whatever I have received as net sales proceed, I will compare that with what was the carrying amount. If net sales proceed is more than the carrying amount, there is a gain to be booked. Where will I book the gain? I will book the gain in the P&L. If the net sale proceeds is less than the carrying amount, I will book a loss. Where will I book the loss? In the P&L. And at the time of derecognition, if there is some balance in revaluation surplus left, that has to be transferred to retained earnings. Don't transfer to P&L. I'm telling again and again, students make this mistake. Don't transfer to P&L. It has to be transferred to retained earnings. So, the carrying amount of an item of property, plant and equipment should be derecognized on disposal. This is when you sell it or when you scrap it, when no future economic benefits are expected from its use or disposal. So if I have decided or if I figured out that by using this asset I am not going to get any future economic benefit, then I will have to derecognize the PPE. The gain or loss arising from the derecognition of a PPE is included in the P&L when the item is derecognized. Transfers from revaluation surplus to general reserve or retained earnings should not be made through the statement of P&L. This we have already discussed. Now, to determine what is the date of disposal of an item of PPE, entity applies the criteria in AS9 for recognizing revenue from sale of goods. What is the meaning of this? As per AS9, when do we recognize the sale of goods? When risk and rewards have been transferred. Similarly, when do I say that a property, plant and equipment will be derecognized? When the risk and rewards have been transferred or when the control has been transferred. Okay. So similarly to the principles of AS9, I will apply the same principles here to decide what is the date of transfer or derecognition. Okay, that is what is done as per accounting standard. Now what we will do, we'll have a look at some of the comprehensive illustrations. Okay, these illustrations you need to practice a lot. Once you have a comfort on these type of illustrations, trust me, this chapter will give you 5 to 7 marks easily. There is no doubt about that. Just few things to keep in mind. Careful in calculation, careful in counting the number of years, which method is being used, what is to be capitalized, what is not to be capitalized. Okay. Skanda Limited acquired a machinery for rupees 2 crores 50 lakhs 5 years ago. So they acquired 5 years ago. Depreciation was charged at 10% per annum on SLM basis, useful life being 10 years, which implies if it's 10% per annum and the life is 10 years, means residual value is 0. At the beginning of year 3, machinery was revalued to 3 lakhs. So started at 2,50,000, 2-year depreciation is provided, then it is revalued. Initially, if you get confused with so much of information, you can just draw a simple timeline. So here it was purchased for 250. Year 1 is done, year 2 is done. So year 1 is completed, 2 is completed, right? And this is the 3rd year completion. So beginning of year 3, here there is a revaluation, with the surplus and revaluation being credited to revaluation reserve. Of course, what is there to tell? That is how we will do. Depreciation was provided on the revalued amount over the balance useful life of 8 years. If this information is not given, then also it is the same thing. The machinery was sold in the current year for 1 crore 12 lakh 50,000. Current year means what? See, we are talking about 5 years ago we purchased. After that we used for 2 years. Then current year we have sold, means after revaluation how many years did we use? 3 years. This understanding is important. So we sold, so we used in the 3rd year, we used in the 4th year, we used in the 5th year, and here is when we sold. Give the accounting treatment for the above in the company's accounts. What will be the treatment if the machinery faced only 42 lakh 50,000? Alright, so first, what is the cost? Cost is 2 crores 50 lakhs. Cost is 2 crores 50 lakhs. Depreciation at 10% for 2 years. Because what they have said that at the beginning of year 3, so we need the closing balance at the end of year 2. So depreciation for 2 years is 2.5 crores into 10% into 2. Okay, how much is that? 50 lakhs. So what is the carrying amount? Carrying amount at beginning of year 3 or end of year 2, both mean the same, it is 2 crores. Revalued amount, how much did they revalue it to? Revalued amount is given to be 3 crores. So revalued amount is 3 crores. What does that mean? The difference is revaluation surplus. Revaluation surplus is 1. This 1 crore will be credited to what? Revaluation reserve. Then the machinery was sold in the current year. So now from here we need to calculate what is the remaining useful life. How much is the remaining useful life? See, it had a life of 10 years. 2 years we have used. So it is 8 years. What is the revised depreciation per year? There is no residual value. So revised depreciation is 3 crores divided by 8. 300, 1, 2, 1, 2, 3 divided by 8. 300 divided by 8. 8 3s are 24. 6. 8 7s are 56. 4 8 5s are 40. 1s 10s 100, 1000, 10,000 lakh, 10 lakh. Depreciation per year is 37 lakhs 50,000. Depreciation for 3 years is equal to 375,121 into 3. So 375 into 3, 1125. 1125, 1, 2, 3, 4, 1, 2, 3, 4, 3, 0. 1 crore 12 lakh 50,000. Okay, this is the depreciation. Now, what is the carrying amount at end of year 5? That is 3 crores revalued amount minus 1 crore 12 lakh accumulated depreciation. So this will be 1 crore 87 lakh 50,000. Okay, how much did we get? 1 crore 87 lakh 50,000. That is the carrying amount at the end of year. Now, what have they said? They have sold it for 1 crore 12 lakh 50,000. So, sale value 1 crore 12 lakh 50,000. So, what is the loss? Loss is 75 lakhs. First scenario, loss is 75 lakhs. If you sold for 42 lakh 50,000, loss is 1 crore 45 lakhs. Loss is simple way to calculate. Okay. Then, what to do with the revaluation surplus? The question has not mentioned whether they have transferred from revaluation surplus to retained earnings periodically. Because that is not mentioned, entire 1 crore of revaluation surplus here that we have calculated, that will be transferred to retained earnings in the year of disposal. Now, if the company wanted to transfer periodically, periodic transfer is equal to new depreciation minus old depreciation. That is equal to, new depreciation was 37 lakh 50,000. Old depreciation was 25 lakhs. That is equal to 12 lakh 50. 12 lakh 50,000. This 12 lakh 50,000, if you do it over a period of 8 years, you get 1 crore. So 12 lakh 50,000, if you do it over a period of 8 years, you get 1 crore. Simple, straightforward. Tell me one thing, if you get this question for 5 marks or 6 marks, will you not be able to attempt this? Will you not be able to get 5 out of 5? And these type of questions give you confidence in the examination that yes, I am doing things right, I am scoring marks, I am getting exemption. We should not think we should not be thinking anything below exemption in advance. Let's have a look at this question. Very comprehensive and important for last day revision. Okay, and this also is important. The previous one which we did last day, definitely you should be revising. Akshar Limited installed a new plant, not a qualifying asset. Why did they mention this? Because if any interest is there as per AS 16, you will not capitalize. At its production facility and incurred the following costs. Cost of the plant as per supplier's invoice 30 lakhs. Initial delivery and handling cost 1 lakh. So 30 lakhs will we consider? Yes. Initial delivery and handling cost will we consider? Yes, definitely. Cost of site preparation 2 lakh. Is it included in cost of PPE? If that site preparation is required for the purpose of construction or installation of my PPE, I will consider that. Consultant fee for advice on acquisition of plant 50,000. Will we consider? Yes. Interest charges paid to supplier against deferred credit. See, it is not a qualifying asset. So, if whatever is paid to supplier against deferred credit, you will not consider. That is one. Second, when you do AS 16, then you will understand that generally machinery items, vehicles and all are in ready to use condition. So, interest on those we should not be considering. Alright, then estimate of dismantling and cost of dismantling and site restoration cost 50,000 after 10 years, present value is 30,000. Now, what will we consider here? 30 or 50? We will always consider present value. If information is not given, we will discount. If discounting rate is not given, then whatever is value given, that will consider to be present value. Okay. Operating losses before commercial production 40,000, this we will ignore. The company identified motors installed in the plant as a separate component and a cost of 5 lakhs purchase price and other costs were allocated to them proportionately. What is the meaning of this? They have said out of all of these, there is a motor costing 5 lakhs which is a separate component. Then on this, remaining other costs have to be allocated proportionately. So, what is my total cost? 30 lakhs. Out of that, 5 lakhs is motors. So, out of 35 lakhs is motor means how much? 5 out of 30 is motor. 1/6 is motor. So, from remaining cost, whatever remaining cost we are incurring, 1/6 of the cost we should add to motors. Okay. The company estimates the useful life of the plant and those of the motors as 10 years and 6 years. Remaining plant 10 years, this motor 6 years. And SLM method of depreciation is used. At the end of year 4, the company replaces the motors and installed in the plant at a cost of 6 lakhs and estimated the useful life of new motors to be 5 years. So, what we will do? Remaining plant will depreciate separately, motors will depreciate separately. At the end of 4 years, the original life was how much? 6. They replaced in 4 years, no problem. Existing carrying amount we will de-recognize, new carrying amount we will recognize. Also, the company revalued its entire class of fixed asset at the end of year 4. At the end of year 4, entire class of fixed asset is revalued. The revalued amount of plant as a whole is 25 lakhs. At the end of year 8, the company decides to retire the plant from active use and dispose the plant for 6 lakhs. There is no change in the dismantling and site restoration liability during the use. You are required to explain how the transaction will be accounted in accordance with ACCA. Such a big question. Generally, we will not get it as such for 5 or 6 marks. They may include this as a part of case study, some bits and part of this. But anyways, comprehensive question, you should do it once with me and once on your own. That will give you 100% confidence. So now here, first objective is to compute the cost of plant and motor. Calculation of cost of PPE. Alright. Now here, first purchase price. Purchase price is how much? Purchase price they have given is 30 lakhs. After that, initial delivery we will consider 1 lakh. Cost of site preparation 2 lakh. Initial delivery 1 lakh. Then site preparation 2 lakhs. Alright. Then consultant fees 50,000. Yes. Interest charges will not consider. We have to write a note for that. And present value is 30,000. So 50,000 and 30,000. 50,000 and 30,000. What is this 50,000? 50,000 is consultant charges. Consultant charges 50,000. Then present value of decommissioning liability 30,000. Alright. Okay. Then operating losses will not consider. So for whatever we have not considered, no, in examination, make sure you write a note. Then they have said motor is separate component and cost of 5 lakhs is and other costs were allocated proportionately. So first we will see what is the total cost. Total cost 30, 31, 32, 33, 33 lakhs 80,000. 33 lakhs 80,000. Now in this we have to split between the plant cost and motor cost. Plant and motor cost. How to split? They have said motor cost is 5 lakhs out of 30,000. This means this is 25 out of 30. This is 1/6. This is 5/6. So 3380 divided by 6. 3380 divided by 6. We get 5,63,333.33. 5,63,333.33. And this will be 3380 into 5 divided by 6. 2816. 28 lakhs 16,666.67. See, you can round it off and do also. That is also allowed. You can say this is 28,16,667 and this is 5,63,333. Okay, that is the cost. All right, that is the cost. So total is 33,80,000. Now, life. How much is the life? Plant, they said, have a life of 10 years and motor have life of 6 years. So plant has a life of 10 years, motor has a life of 6 years. Depreciation per annum. They have not given anything about residual value. So this will be 2,81,666.7 and this will be 5633333 divided by 6, 93,888.83. 93,888.83. Now, when did the replacement happen? Replacement happened after 4 years. So depreciation for 4 years will be 281,666.7 into 4. You get 11,26,666.8. We can now do 11,26,666.8. We can say 667. Okay. Then 93,888.83 into 4. 375,555. 375,555. So carrying amount at end of year 4 is how much? Here it is 28,16,667 minus 112,667. 6667. 16,90,000. 16,90,000. This is the carrying amount at the end of year 4 for plant component. For the remaining component, 563,333 minus 3,75,000. 3,75,555. 187,778. 187,778. Okay. You can do the total. Total column is just for reference. You can do it on your notebook. This is the carrying amount. Now what happened? Two things happened. First, we replace the motor. Okay, we replace the motor. So less derecognition. How much? 187,778. Now, whenever we are derecognizing and there is no proceeds being received, we are saying we are replacing. So this entire amount of 1,87,778 will be recognized in P&L as a loss because that part is no longer useful. Okay. So after you derecognize, this becomes 0 and this is still at 16,90,000. Add new part. What is the cost of new part? The cost of new part is 6 lakhs. The company replaces the motor installed at a cost of 6 lakhs and new life is 5 years. So new cost is 6 lakhs. At the same time, what they have said, this is very important. Also, the company revalued its entire class of fixed asset at the end of year 4. Revalued amount of plant as a whole is 25 lakhs. And at the end of year 8, the company decides to retire the plant from active. So what has happened? They're saying now the total value of the plant is 25 lakhs, including motors. Now, we just replace the motor at 6 lakhs. So what is the fair value of the motor? Fair value of motor is 6 lakh itself. Fair value of motor is 6 lakhs itself. Okay. So fair value of asset. This is 6 lakhs. Total we are saying 25 lakhs. So this becomes 19 lakhs. So these become my new carrying amount. Okay. What is the revaluation surplus? Revaluation surplus is 19 minus 16, 10, 3,10,000. Here there is no revaluation surplus. So what has happened? We purchase plant and motor. Motor we want to depreciate over 6-year period, but we could use it only for 4 years. At the end of 4 years, the depreciation charge was 3,75,555. After that, we got a carrying amount of 1,87,000. That we derecognize. Now the value became 0. We bought a new part at 6 lakhs. The carrying amount is 6 lakhs. What is the revalued amount for this? See, just now we installed, no? That itself is the fair value. So that 6 lakhs becomes the fair value. Total fair value is how much? 25 lakhs. What is the fair value of the plant component, other plant component? 19 lakhs. And 3,10,000 becomes my revaluation surplus. 3,10,000 becomes my revaluation surplus. Now, from here, what is the revised useful life or remaining useful life, not revised, remaining useful life? This part it is 6 years, this part it is 5 years. The question has given that it will be 5 years. Then how long did they use? They used it till year 8, at the end of year 8. So we need 4 years depreciation. So depreciation for 4 years is equal to how much? 19 lakhs divided by 6 into 4. 6 lakhs divided by 6, sorry, divided by 5 into 4. So that is equal to 19 lakhs divided by 6 into 4, we get 12,66,666. 12,66,667. 6 lakhs, this is 4,80,000. This is the total depreciation. Okay. So carrying amount at end of year 8. This 4 years means year 4 to year 8. Carrying amount is 19 minus 12,666 minus 19. If I do, I get 6,33,333, and here I get 1,20,000. If at all at some step you are finding it, sir, I am not able to follow, I am not able to understand, I lost track, please pause this video, read the question again and try solving it along with me, because this is a difficult question. I am not saying this is an easy question, way too many information, and the only way is to follow a structured process. So what did we follow as a structured process? See, initially we calculated the cost, then we know life is different, 10 years and 6 years. After that we needed depreciation for 4 years. This is from year 1 to year 4. Then we got carrying amount at the end of year 4. This part is de-recognized. So this part is completely de-recognized, and we purchased a new part at 6 lakhs. The total revalued number given was 25 lakhs. Out of that, 6 lakh is towards motors that we have purchased. So 19 lakhs will become the value of the plant. This 19 lakhs and 6 lakhs will now be depreciated over balance period of 6 years and 5 years. Depreciation we computed, and carrying amount is so much. And what did they do? They sold the plant as a whole for 6 lakhs. Sale value is 6 lakhs. Now, how much should I allocate to motor and how much should I allocate to plant? It is generally done based on the relative fair values. If relative fair values are not available, you can take relative carrying amount. Means total is how much? 633 plus 120. 633 plus 120. What is the total? The total is 633 plus 120. 6 plus 1 7. 5 3 3 3 3. Okay. So what we will do? This 6 lakhs we will allocate as 6 lakhs into 633,333 out of 753,333. So that is 6 into 633,333 divided by 753,333. 5,04,425. 5,04,425. And balance minus 6, whatever is balance, 95,575. 95,575 is towards the motor. So what we have done, basically we have seen what is the total carrying amount. 633 plus 120, total carrying amount is 7,53,000. Out of the 7,53,000, how much can I allocate to 633? 633 out of 7,533. So 6 lakhs into 633 divided by 7,533, I got 5,04,425. Similarly, if I do 120 into 630, similarly if I do 6 lakhs into 120 by 753, I'll get 9,575. So what is the loss or gain? See, 633 minus 4, so there is a loss. 633 minus 504,425. 633,333 minus 504,425. There is a loss of 128,908. 128,908. How did I get this 128,908? The carrying amount 6,33,000 minus the sale proceeds. There is a loss. Here, how much is the loss? 120, 123 minus 95575. 24425. 24425. 128,907, 24425. Now, few things that you have to keep in mind. Since the asset is not a qualifying asset, payment of interest to the supplier is not capitalized. Operating losses are also not capitalized. This is the point you have to make. Then the company should de-recognize the existing carrying amount of motors replaced of 1,87,000 and the acquisition cost of new motors would be capitalized as a separate component. Then revaluation surplus should be transferred directly to retained earnings. Allocation of disposal proceeds for the plant is apportioned based on the carrying amount. Alternatively, it may be apportioned as 1/6 towards motor and 5/6 towards plant based on the reasoning that initially motors amounted to 1/6 of the entire plant. This may not be preferable because there has been revaluation of the plant and a disposal and subsequent acquisition of the motor, which is not in the initial proportion of 5/6 and 1/6. So this you can actually ignore. This is just a note that you can have alternate treatments. Originally they said, right, 5/6 and 1/6, but then there was a disposal, there was a revaluation. So we have considered based on the carrying amount. These notes you need to write. Do practice this question once on your own to follow the logical flow, to follow the logical structure of the way you have to answer in the examination. Always prefer tabular format. Do it in a step by step basis. You will be able to handle the question very well in the examination. So now we have reached to the last part of the standard that talks about disclosure requirements. Now disclosure requirements are there in all the standards. They are important, but again, don't waste too much of time in remembering them. And like we do in most of the standards, we'll first have a look at the actual disclosure done by a company and then come back to what all do we disclose as per the accounting standard. Now here I have taken a financial statement or annual report for 2016 because after Ind AS implementation, listed companies have to prepare their financial statements as per Ind AS. Though we can get unlisted companies financial statement, listed companies have a more structured way of giving the disclosure. So if you see in the balance sheet here, under asset side, under non-current asset, earlier we used to have tangible, intangible assets. Now this tangible asset is replaced with property, plant and equipment. Okay, so that this note number 11 will talk about what is the breakup of property, plant and equipment. And correspondingly, if you come to the profit and loss account, here you have depreciation and amortization expense. Depreciation as per accounting standard 10, amortization as per accounting standard 26. So coming to the specific disclosure aspect, tangible fixed asset, now we will call it property, plant and equipment, including in-house capitalization and capital work in progress, CWIP. Before the asset is ready, we capture it or we record it as capital work in progress, are stated at cost except those which are revalued from time to time on the basis of current replacement cost value to the company net of accumulated depreciation. So what are they saying? Either they will follow the cost model or they have been following the revaluation model. Asset taken on finance lease are stated at fair value of the asset or present value of minimum lease payment, whichever is lower. This is as per accounting standard 19. Subsequent expenditure related to an item of fixed asset are added to its book value only if they increase the future benefit from the existing asset beyond its previously assessed standard of performance. This also we have discussed. Any future expenditure we will capitalize when the future economic benefits will be more than what we were initially getting. Losses arising from retirement of and gain or losses from disposal of fixed asset which are carried at cost are recognized in statement of P&L. De-recognition criteria, this also we have seen. Intangible assets are stated at acquisition cost, net of accumulated amortization and impairment losses, if any. This when we do accounting standard 26, that point of time we will understand. Depreciation is being provided as given below. Depreciation on fixed asset of the company is provided on a pro rata basis on straight line method. So we are saying which method of depreciation are we following? Using the useful life of asset prescribed in Schedule 2 of the Companies Act. So I have shown you the Schedule 2, accordingly they are providing. Intangible assets over 1 to 5 years. Okay, fine. Leasehold land is amortized over the period of lease. Improvements are amortized on SLM basis over the period of 3 years or lease period, whichever is lower. Right, so that is about the accounting policy. Now coming to note number 11. Okay, so of course the name will change. It will be now be property, plant and equipment. Here you can see leasehold land, leasehold improvement. Leasehold means land that you have taken on lease. Leasehold improvement means on the leased asset if you have carried out some improvement. Freehold land, what we own. So lease means that you have taken on lease. Freehold means what we own. Building, plant and machinery, furniture, office equipment, vehicles, computers. What are these? These are our class of asset. Then they're saying gross block. Now this gross block basically represents either the cost or revalued amount. Okay, cost or revalued amount. We have opening balance, addition, deletion, closing balance. So we have to give what was the opening balance of gross block. Gross block means without depreciation. What is the opening balance? How much have we added additions during the year? How much have we deleted or disposed of deletions or disposals during the year? And what is the closing balance? Then same thing for depreciation. What was the opening balance? Accumulated depreciation opening balance. Addition, adjustment when we have disposed, and closing balance, and you have to give the net block. This reconciliation has to be given by each and every company. Okay, so this is the format generally followed, and we also need to give the format for previous year as well. Then they have given some notes. Land and building amounting to this much are pending registration in the name of the company. So we have purchased the land, but it is not yet registered. Certain land and buildings are included above on revalued amount. So they have also told what is the revalued amount. And from this number here, this is the depreciation for the year. So whatever is the addition, we say this is the depreciation for the year, and this is charged to P&L. So this is what we disclose in the financial statements. Now let us see what the standard has to tell. The financial statement should disclose for each class of property, plant and equipment the measurement basis, whether you are following the cost model or revaluation model for determining the gross carrying amount. Gross amount, right? The first column that we saw. Then depreciation method used. Are we using SLM or WDV or unit of production? Useful life or the depreciation rate. So either you tell what is the useful life or you give us what is the depreciation rate. In case of useful life or the depreciation rates used are different from those specified in the statute governing the enterprise, it should make a specific mention of that fact. So if you are using a rate which is different from what is given by Companies Act, then you have to disclose it separately. The gross carrying amount and the accumulated depreciation at the beginning and at the end of the year aggregated with accumulated impairment loss. So what was the total depreciation and impairment at the beginning? During the year, how much have you added? How much adjusted? What is the closing balance? The reconciliation of the carrying amount at the beginning and at the end of the period showing additions. Reconciliation means what was the opening balance? What are the movements during the period? And what is the closing balance? Asset retired from active use and held for disposal, you have to disclose separately. Acquisition through business combination. If there is something that has been acquired through business combination or amalgamation, you have to show it separately. Increases or decreases resulting from revaluation and from impairment losses recognized or reversed in revaluation surplus in accordance with Accounting Standard 28. So, what is the increase or decrease in revaluation and how much have you recognized in the P&L? How much have you recognized in the revaluation reserve? All of that has to be disclosed. Impairment losses recognized as per AS 28, impairment losses reversed. What is the depreciation? Then net exchange differences arising on the translation of the financial statements of a non-integral foreign operation in accordance with AS 11. So now basically what happens is when you translate a foreign operation, you will understand this in AS 11 and also in branch accounting. When you translate that, there is an exchange difference. So what is the change because of this difference? That also you have to disclose, and any other changes. You should also disclose existence and amount of restrictions on title and property, plant and equipment placed as security. So you have to disclose two things. Are there any restriction on title? Court case is going on. Okay, we are fighting for the court case. Or if some registration is pending, then if you have given it as a security to the bank for taking the loan, all of that has to be disclosed. Amount of expenditure recognized in the carrying amount of an item of PPE in the course of its construction. So how much of expenditure have you recognized in the PPE? So for example, what happens is, let us say salary expense. Out of this you have capitalized, let us say 5 crores of salary. So you have to disclose 5 crores of salary expense has been capitalized. Amount of contractual commitment for the acquisition of property, plant and equipment. Here we are talking about commitment, not thinking that we will buy. Let us say we have placed an order for buying 20 computers. Okay. Now we have given a firm commitment. Firm commitment means I cannot withdraw from the contract. Okay. It's a firm commitment. It's like you have already committed. You cannot withdraw. If you are just planning to buy, if you are just making inquiries, that point of time we don't say it's a commitment. But when you're saying you have already committed to something, then you cannot withdraw. So if there are contractual commitment for acquisition of any item of PPE, that you have to disclose. Why it is important? It is important because if I have given an order to buy 20 computers, I am carrying a liability on my head. So that has to be disclosed. And also the investor should know, okay, this company is going to buy 20 computers, looks like they are expanding. Okay, so that has to be disclosed. Then if it is not disclosed separately on the face of statement of P&L, amount of compensation from third parties for items of PPE that were impaired, lost or given up, that is included in the statement of P&L. For this, we'll take one example also subsequently. If let us say an asset has been damaged, the car met with an accident, insurance company compensated the amount. So there is a gain. If there is a gain, the amount of gain, if we have not disclosed separately in the P&L, that you have to disclose. The amount of asset retired from active use and held for disposal. What are those assets which we are not using currently and which we want to dispose subsequently? This will be classified under current category, not under non. If items of PPE are stated at revalued amounts, the following should also be disclosed. If you are recording PPE at revaluation model, you should disclose effective date of revaluation, whether an independent valuer was involved. Have you taken help of a professional independent valuer? The method and significant assumptions applied in estimating the fair value. How did we get to the fair value of the item? So let us say if you want to do a fair value of the building, what did you consider? Did you consider nearby market rates? Did you consider the rental value? Did you consider any recently concluded transaction? All of that you have to disclose. The extent to which the fair value of the items were determined directly by reference to observable prices in an active market or recent market transaction on arm's length term, or were estimated using other valuation techniques. See, this is slightly advanced level disclosure. No need to worry about it too much for the examination. But what they're trying to say tell here is, how have you arrived at the fair value? Okay, so if I have to do a fair valuation of, let us say, my building, okay, what is the first thing? They're saying, have we determined it directly by reference to observable prices in active market? Is there an active market? Active market means frequently buying and selling keeps on happening. So if there is an active market, have I gone to the active market and checked, okay, what is the price of my current building? So this you can associate more better with, let us say, a car. If I have a car, I want to determine its fair value. Where should I go? I will go to the second-hand car market where thousands of cars are being bought and sold. Now these days you can find online also, right? You have likes of Spinny is there, where you can, Car Deco is there, where you can actually see what is the price of the car. So if it is based on a price that is coming from the market, that is called observable price in an active market. To give you another example, though it is not an item of PPE, stock market. So whatever price you see in the stock market, that is a quote derived from active market. Okay. Or have we used recent market transaction on arm's length? We don't have an active market for the building that we have. We don't have an active market. But my neighbor sold similar building to an unrelated party at, let us say, 1 crore. So I can say, okay, based on that, the value of my property is 1 crore. Or if that was half my size and they sold it for 1 crore, I will say my property is valued at 2. Okay. Then, or were estimated using other valuation technique. Now, I don't have observable market for the building. Recently, there were no transactions. So what did I do? I estimated how much rent will I get from this building. Okay. How much rent will I get from this building? I used a discount rate to get to the present value of rental income. So that present value can be a representative of the fair value. So there are multiple ways to determine fair value. We call them level 1 input, level 2 input, level 3 input. Just for your understanding, don't worry for the examination. Have we determined using an active market? Is there an active market for the asset? And have I taken the quote from that market? Or have I seen similar transaction and determined the fair value? Or I don't have an active market, I didn't get to see a similar transaction. I use some valuation technique. One famous method of valuation is discounted cash flow method. In financial management, you will understand about this. Have I used that to determine? So that you need to disclose. The revaluation surplus indicating the change for the period and any restriction on distribution of the balance to the share. Now, revaluation surplus cannot be used to distribute it as dividend to the shareholders. So that you need to disclose. Disclosure of the methods adopted and the estimated useful life or the depreciation rate. Disclosure as per AS5 if applicable, and information on impaired PPE. All of this you need to disclose. And there are some voluntary disclosures. Carrying amount of temporarily idle PPE. There is a machinery. I have not used it for 4 months. Temporarily it is idle. What is the value of that? Gross carrying amount of fully depreciated PPE that is still in use. Sometimes what may happen is we have fully depreciated a property, plant and equipment. Assuming useful life is 5 years, we have fully depreciated it. Subsequently, we are still using it. So what is the gross carrying amount? For each revalued class of PPE, carrying amount that would have been recognized had the asset been carried under cost. What does this mean? If there is an asset on revaluation model, also give the comparable cost model valuation. Means if revaluation was not done, what would have been the value? That is the meaning of this thing. And the carrying amount of PPE retired from active use and not held for disposal. So one is we are saying carrying amount retired from active use and held for disposal. Something which we are not using, but we have not yet held it for disposal, that we can disclose. These are voluntary disclosures. Now, don't sit and start mugging up everything. Read it 2-3 times. You will get a sense of what all have to be disclosed. Now, there are a few small aspects that are left in the standard, and post that we will wind up the standard. Okay. So, one is related to changes in decommissioning liability. A quick recap. What do? Present value of decommissioning liability is added to cost of PPE. This we have already seen. Then subsequently, what do? This present value of decommissioning liability, we carry out the unwinding of this. We carry out the unwinding of discount, and every period we add the interest amount to the decommissioning liability, interest being charged to P&L. Okay. So for example, I will take a very simple example. Let us say life is 3 years. Discount rate is 10%. And estimated decommissioning cost is, let us say, 10,000. Okay, so what do? First thing we'll compute present value of decommissioning cost is equal to 10,000 divided by 1.1 to the power of 3, or 10,000 into present value factor of 10% for 3 years. Either ways you can do. This we have done multiple times, right? So what is the present value? 10,000 divided by 1.1 to the power of 3. If I do, I get 7,513. Okay. Now, what I'll do, I will use the 7,513 and just show you on a table. Okay. No need to worry about it. We have done this multiple times. I'll just show you on the table how the liability moves and what happens if there is a change. So we have 3 years, year 1, year 2 and year 3. Opening balance we computed 7513. How much is the interest? Interest is 7513 into 10%, that is 0.1. And what is the closing balance? Closing balance is opening balance plus interest. Please remember, there are no payments that are happening. So this is how it will happen. Now, in the second year, what happens? In the second year, 8264 becomes the opening balance, and whatever we did here, that becomes the interest, and this becomes the closing balance. Third year, 9,000 becomes the opening balance, interest, closing balance. Okay. So this calculation we have seen. Now, what we are saying is, this is the balance of liability. End of year 1, 8264, 9090 and 10,000. This we have completed. What if there is a change in liability itself? Now, one thing that you have to understand is, liability is anyways changing, but this change is happening due to passage of time. If it is happening due to passage of time, you just add it to liability, book the amount to the P&L. So first year interest expense, you would say interest expense 751 to decommissioning liability 751. No problem at all. But if there is a change other than due to passage of time, sir, how can there be a change? Say for example, this estimate that we had made that it will be 10,000, instead of 10,000 we think now it will become 12,000. Possible? Yes. Or the discount rate has changed, or the estimated provision has come down. Anything is possible. So if there are changes because of, let us say, changes in estimate. Now what is the change in estimate? Say for example, we have estimated that now at the end of first year is completed, or at the beginning of second year, we have estimated that the liability will now be 12,000. Right now what is the estimate? That it is 10,000. Now we are saying it will be 12,000 when at the beginning of second year. It can happen anytime. Okay, I'm just giving this for easier understanding. So if now the estimate is 12,000 instead of 10,000, what happens? We need to calculate present value of 12,000. We'll calculate present value of 12,000. At what rate? At 10% for 2 years. For how many years? 2 years, because 1 year has already passed. So what is the present value? If you see the present value, 12,000 divided by 1.1 divided by 1.1, if I do, I get 9917. I get how much? 9917. This is what? This is present value of 12,000. So if the present value of 12,000 at 10% for 2 years is 9917, current liability is 8264, there is a change in liability. This is called change in liability. The liability has not changed because of passage of time. The liability has changed because our estimate has changed. So now what to do with this difference? How do we handle this difference? Please understand, we have to increase the liability. We have to increase the liability. Means we will pass an entry saying to provision for decommissioning. How much is the amount? So 9917 minus 8200, assume for a moment difference is 1700, just for easier calculation. Okay, so we will say this number is 1700, 1600 something. What will we debit? We will debit the property, plant and equipment account. We will say property, plant and equipment account debit to provision for decommissioning liability. In other words, any increase or decrease in the liability of decommissioning will be debited or credited to property, plant and equipment account. As simple as that. So the nutshell of the discussion is, if the present value of the decommissioning expense changes because of changes in estimate, because of changes in discount rate, then whatever is the difference, that difference will be adjusted against the cost of PPE or the carrying amount of PPE. So if there is an increase in liability, I have to credit the liability. Same way, I have to increase something on the asset side, I will debit the asset. If there is a decrease in liability, then I will credit the asset. However, if the asset is carried under revaluation model, what I have discussed so far is for cost model. If it happens on a revalued asset, then change in liability is treated like revaluation changes. So two things: if there is a change in decommissioning liability, cost model, whatever is the change, add to or reduce from the PPE. If it is a revaluation model, treat it as if you have done the changes in revaluation surplus. Okay, so if there are changes in decommissioning, restoration and similar liabilities, the change can happen because of change in the estimated outflow. We thought initially 10,000, now it has become 12,000, or change in the current market based discount rate. So that can be a possibility, or increase that reflects the passage of time. Three things are possible. Here you will not change PPE amount. Okay, because it is due to passage of time. Interest expense, I'll just add it to the liability and book it under P&L. Now, if there are changes in the first two category, if the related asset is measured using cost model, changes in liability shall be added to or deducted from the cost of the asset in the current period, and related provision is adjusted accordingly. Meaning to say, if liability balance in the books is, let us say, 15,000. Okay, liability balance in the books is 15,000. Present value of liability re-estimated is, let us say, 12,000. What has happened? There is a reduction of 3,000. I have to reduce the liability by 3,000. Reduce means I have to debit the liability. So I will debit provision for decommissioning by 3,000, and the corresponding impact goes to property, plant and equipment. Okay, so that is how it is done. Now, if, for example, the PPE has a balance of only 2,000. Sir, how is it possible? It is possible. You have depreciated the property, plant and equipment, and today the carrying amount of property, plant and equipment is only 2,000. Whereas the reduction in decommissioning liability is 3,000. Now, can I credit this amount to PPE by 3,000? I cannot, because I have carrying amount of only 2,000. So only 2,000 I can reduce. So then what about balance 1,000? The balance 1,000 of reduction is recognized in the income statement. Okay. Then if the asset is measured using revaluation model, what is to be done? Very simple. Revaluation model. If the asset is measured using a revaluation model, then what is to be done? If it is measured using the revaluation model, let us say current liability is 12,000. Revised liability, that is present value, is 15,000. What has happened? It has increased by 3,000. So if it has increased by 3,000, I will credit provision for decommissioning liability. How much? 3,000. What should I debit? I should debit revaluation surplus. How much? 3,000. I have to debit revaluation surplus 3,000. Sir, why are we not debiting PPE? We are not debiting PPE because PPE is already at fair value. I cannot increase that beyond fair value. Okay. Now you may have a doubt. Sir, why are we not debiting PPE? What will happen is, if you debit to PPE, PPE balance will increase. But PPE has to be done at fair value. And under revaluation model, it's already at fair value. Again, you have to reduce the PPE balance. Means again, you have to adjust the revaluation surplus. So directly we are adjusting revaluation surplus. So what if revaluation surplus does not have balance? Then in that case, you will transfer to P&L if balance not sufficient. So increase in liability, you will debit to revaluation. So what about decrease? Let us say it was 12,000. Now it has become 9,000. There is a reduction of 3,000. Reduction of 3,000 means I will debit provision for decommissioning. I will credit revaluation. If earlier some amount was recognized in P&L, if some amount was debited in P&L, I will credit the P&L account. So I will use P&L if used earlier to debit loss. So very simple and straightforward. Changes in liability for revaluation model cases. If liability increases, I will debit revaluation surplus. If balance not available, I will debit P&L. If liability decreases, it's a gain. Think of it. If liability decreases, it's a gain. If there is a gain, I will credit revaluation surplus. But earlier, if you had charged something to P&L on account of revaluation, to that extent, I will credit the P&L. All right. Any increase in liability is adjusted against revaluation surplus. Increase in liability means loss. Increase in liability means loss. To the extent of balance available, any excess is recognized in P&L. Any decrease in liability is recognized in revaluation reserve because it's a gain. If any revaluation deficit is charged to P&L in the prior period, to that extent will charge to P&L. Simple and straightforward. Then one important thing, if because of the change in liability, we have to add to the cost of PPE, because there is a change in liability, increase in liability, we are increasing the cost amount of PPE, then in that case, you should also test for impairment as per AS 28, because I am increasing the value of asset. Now the question is, will I get future economic benefits to that amount? So you have to test it for impairment as per AS 28. Similarly, if there is a change in liability, here also we have to see whether the asset needs to be tested for impairment. Now that we have completed the major crux part of the standard, there are few things that we had left which we will be completing now. One is related to the scope. Okay. Now, when we talk about scope, we are talking about what does accounting standard 10 cover and what does it not cover. Okay. First thing, the standard does not deal with the following. First one, biological assets related to agricultural activity other than bearer plant. This is a slightly tricky kind of an exclusion which you need to understand carefully. What are they saying? They're saying this does not apply to biological assets. Sir, what are biological assets? If let us say I have a dairy farm, I have cows or buffaloes, okay, that is a biological asset. If I have a horticulture business, I have plantations, I have trees, those are biological assets. So biological assets are basically living animals or plants. They are basically living animals or plants. Now what the standard is saying is, if you have a biological asset, that is a living animal or plant, cow, buffalo, goats, pigs, trees, rice plantation, whatever it is, that are related to agricultural activity. So if there is a biological asset which is related to agricultural activity, so if I have, let us say, cows for dairy farming purpose, that is covered under agricultural activity, that is excluded from accounting standard 10. Though cow is my asset, though buffaloes are my asset, though there are goats, sheep, though those are my asset, I will not treat them as asset under accounting standard 10. Okay, so if you understand, those assets give me benefit for more than a period of 12 months, but still I will not cover them under AS 10. The challenges are basically due to identifying what is the value, what is the cost that is being incurred, and all of those things. However, bearer plants are covered. So biological asset, living animal or plant related to agricultural activity, cows, goats, buffalo, sheep, plantations, all of those things are related to agricultural activity, those are excluded. However, bearer plants are included. So only bearer plants related to agricultural activity are included. All other biological assets are excluded. Now, if I have to ask you, if let us say a company has purchased dogs for security purpose, is that covered here? Yes, because that is a biological asset but not related to agricultural activity. Okay, so if a biological asset is not related to agricultural activity, then that is covered here, otherwise it is not covered here. Now the key question is, sir, what is this bearer plant? Bearer plant basically is a living plant. It's very careful, huh? You are saying living plant, not dead plant, that is used in the production or supply of agricultural produce. Best example, let us say orange tree or a mango tree, best for you to understand. So it's a living plant, yes. It is used to supply agricultural produce, yes. Now there are rice plantation, plantation or paddy fields, what you say, okay, I'm using it just very generically. Are paddy living plants? Yes, they are living plants. Are they used to supply agricultural produce? Yes, but they are not bearer plants, because second part of definition says it is expected to bear produce for more than a period of 12 months. So plants which are used for supply of agricultural produce and which give you harvest only one time or in less than 12 months period it is done, then those are not considered to be bearer plants. Those are not considered to be bearer plants, and they have a remote likelihood of being sold as an agricultural produce except for incidental scrap sale. So the third part of the meaning means, if you have a orange tree, you are not cutting the tree as it is and selling it as an agricultural produce. Like in the case of, let us say, if there is a teakwood plantation, in case of teakwood plantation, you are not getting any fruits. You will allow the trees to grow. Once the tree reaches the age or the size at which you can cut down the tree and sell the trees themselves as wood. So there, the plant itself is the agricultural produce. You don't have any other fruits, etc., which are being harvested. The plant itself is the agricultural produce. So a bearer plant is not cut down and sold as an agricultural produce primarily. See, if the plant has aged, if the plant is about to die, then you may cut down and sell it as wood. So let us say you get mango wood also. So you may cut down the mango tree and sell it as wood after, let us say, 15 years, 20 years of its life. Okay, of course they may live for more than that period, but you will cut down and sell it only as a scrap sale. Your purpose is what? To have the plant which will give you fruits that you will sell it in the market. Okay, or let us say tea gardens, there also you pluck the tea leaves. So tea leaves are the agricultural produce. Your idea is not to cut down the plant itself and sell it as an agricultural produce. So once again, bearer plants is living plant used in the production or supply of agricultural produce, for example oranges, is expected to bear produce for more than a period of 12 months. So it will be giving you produce for more than a period of 12 months and has a remote likelihood, remote means very, very less chance, of being sold as an agricultural produce except for incidental scraps. So if you are growing teak wood, in case of teak wood, the idea is to cut down the tree and sell the tree as an agricultural produce. That is not a bearer plant. So what is covered? Bearer plant used in agricultural activity is covered. Any other biological asset, whether it is plant or animal, which is related to agricultural activity, is not covered. So biological asset related to agricultural activity other than bearer plants are not covered. So then how do we value them? As far as Ind AS is concerned, we have a separate standard. Otherwise, you will follow the guidance note and prevailing industry practices to do the accounting. Then wasting assets including mineral rights, expenditure on the exploration for and extraction of mineral oils, natural gas and similar non-regenerative resources. So wasting asset, what is the meaning of wasting asset? If you take the example of, let us say, crude oil exploration or crude oil extraction, as and when you start extracting the crude oil, the reserve is limited, as they say. So the more you keep on extracting, the resource is being consumed, the resource is being depleted and it will get over. That is what is called wasting asset. So if there is a wasting asset, like in case of mineral rights, extraction of minerals, expenditure on exploration and extraction of minerals, oil, natural gas and similar non-regenerative resources. So non-regenerative means they will not regenerate, they will not renew. So coal mine will have limited quantity of coal, will have limited quantity of coal. After you have extracted all of that, will you again get more coal? You will not get, because it will not regenerate. See, plants, they will regenerate, the minerals will not regenerate. So even those are outside the scope of property, plant and equipment. The reason simply being, it's very difficult to estimate the valuation part. That is one thing. It is very difficult to estimate how much will you get. So there we do not capitalize and hence we do not capitalize those under accounting standard 10. Investment property as defined in AS 13 should be accounted for in accordance with the cost model prescribed in the standard. So if there is an investment property, I gave you example initially, that is covered under AS 13, you will be accounted using the cost model only. Means you will not follow the revaluation model for investment property. If however you have PPE which are used to develop and maintain the assets, let us say for example you have machinery for extraction of coal. Now that machinery is capitalized as PPE. The coal, the right on coal that you have, the coal extraction, the coal reserve that you have, which will give you benefit for more than a period of 12 months, that is not capitalized under accounting standard 10. So these are few things which you need to remember as far as scope and exclusion is concerned. Then we have things like spare parts, standby equipment and servicing equipment. Now spare part means, let us say I have a machinery. The machinery has a chain. Okay, machinery like you see a cycle chain. Now the chain may be a specialized chain, so I have purchased a spare part and I have kept it aside, because if at all there is a breakdown, I can use the chain and repair the machinery or get the machinery back to functioning condition. So if there are spare or standby equipment is, let's say, extra battery for running the machine, or servicing equipment. Some machines may require specialized servicing equipment. So how do we deal with this? These are recognized in accordance with this standard when they meet the definition of PPE. Otherwise, they are classified as inventory and charged to the statement of P&L when it is issued for usage. So what they're saying is, if the item meets the definition of PPE. Now, what is the definition of PPE? PPE are tangible items held in the use of production or supply of goods or services, rental to others and administrative purposes, and they will be used for a period of more than 12 months. So you will use it for a period of more than 12 months. Now you have to see, does it meet this definition and will we get future economic benefit? Of course, you will get future economic benefit, because without that standby equipment, if the machine fails, you will not be able to run it. But is this condition satisfied? If yes, then you will call it a PPE. If no, let us say the life itself is 3 months, 4 months. In 3 months, 4 months time, you will consume the spare part. Then you will treat it as a part of inventory. Okay. Sometimes there may be individually insignificant items. So let us say sometimes there may be individually insignificant items. Okay. So there may be some tools that are being used. There are some dies. So what is a die? If you can see on the screen, right? So there is a metal structure and there are some engravings inside. So if you use this and let's say you pour hot metal in this, it will create a proper shape of the inside structure. That is called dies. Now you may have lot of dies like this. Now these are individually, these are insignificant. So what the standard says is, if there are individually insignificant items, you can aggregate them together and present it as a single item. It may be appropriate to aggregate individually insignificant items and to apply recognition criteria to the aggregate value. Individually, maybe 200, 300, 500 rupees, you may say insignificant, but there are thousands of dies like that. You can aggregate all the dies together and say, okay, all the set of die is a single item of property, plant and equipment. Now, the logic here is, these items will be used for more than 12 months period, and hence it makes sense to capitalize. Individually, value is not significant. Individually, value is not great, but on an aggregate basis, the value will be significant. Then, as far as impairment is concerned, we must calculate the recoverable amount in accordance with AS 28. So, when we do AS 28, we will understand this in detail. It's a loss. When we say impairment, there is a loss. Now, sometimes what happens is, you get compensation from third parties for items of PPE that were impaired, lost or given up. Means, let's say I have a car, as I told you, the car got damaged. Okay, now the car got damaged, I get a replacement of the car, or I get the value for the car. Now, there are two things that's happening. One, my existing car got damaged, there is a loss on that. Second, I'm getting a new asset. So, treat these as two different transactions. Whatever loss has happened on the existing car, recognize the loss. Whatever new asset I'm getting, that is a gain. That gain will be recognized in P&L when the compensation becomes receivable. Then, I had also mentioned that how to calculate rate for WDV method. This is not tested in the examination, but also for our understanding it is important. Okay, so let us say cost is 10,000, useful life is 4 years, useful life is 4 years, residual value is, let us say, 1000. What is the rate under WDV? Okay, under SLM it is easy. See, under SLM what you will do, you will take cost minus residual value divided by life. Life is 4. So, you have 10,000 minus 1,000, 9,000 divided by 4. So, this becomes 2250. So, percentage is 2250 divided by cost. Rate is always on cost. So, this is what? 22.5% per year. Okay, that is how we calculate. But when it comes to WDV, it's not straightforward. So, we use the future value formula. Future value is equal to present value multiplied by 1 plus rate to the power of n. What is the future value? 1000. What is the present value? 10,000 into 1 plus rate we do not know to the power of 4. So, if you see, 1 plus rate to the power of 4 is equal to 1000 by 10,000. Simple ratio calculation, which means 1 plus r to the power of 4 is equal to, if you see, these 3 zeros go off and these 3 zero goes off, 1 by 10, or 1 plus r is equal to under root 4th root of 1 by 10, correct? Or r is equal to 4th root of 1 by 10 minus 1. Now, how much is 1 by 10 4th root? Just on a calculator you can do 1 divided by 10 and press square root 2 times. Now, sir, what if they give us 5th root, 6th root, 7th root? Then there are shortcuts available how to do it on calculator, but trust me, it will not come in the examination. Even if it comes, if you know the calculator trick, use the trick. Otherwise, it is worth leaving it for the 4 or 5 marks for which it will be tested. Okay. So, if you do 4th root of 1 by 10, that is 1 divided by 10, that you get 0.1, square root 2 times, you get 0.5623 minus 1. R is equal to 0.5623 minus 1. If I do, I get 4376 minus 0.4376, or R is equal to 43.76%. Sir, what about this negative sign? See, if it is increasing, we generally add. Present value is equal to 1 plus R to the power of n. Here, because it is decreasing, we got the answer in minus. So, what you can do for your calculation, you can say residual value is equal to cost into 1 minus rate of depreciation to the power of n, or R is equal to, you can write it in this format, that is n root of, what is the residual value? Residual value is 1000, nth root of residual value by cost. Now, had we used minus here, so what would have happened is this would have become minus R is equal to nth root of RV divided by cost plus cost minus 1. Okay, that's how it would have become. So, if you reshuffle them, you will get R is equal to 1 minus nth root of residual value by cost. Okay, so what is the formula? To get the rate, you will take 1 minus nth root of residual value divided by cost. So, you will get, in this example, we get 43.76%. So, now using those numbers, if we calculate, cost was how much? 10,000. Okay, first year depreciation is based on 43.76%. Correct? That is what I have calculated. So, depreciation will be 10,000 into 43.76%, that is 4376. What will be the carrying amount? 10,000 minus 4376. If we do, we get 5624. Again, if we repeat the same thing next year, we get depreciation of how much? 43.76% of 5624, we get 2461. So, what is the closing value? 5624 minus 2461. If we do, we get 3162. Okay. Then that 3162, again, if we apply the same depreciation formula 43.76%, we get 1384. Okay, the closing balance will become 1778. Again, same depreciation formula if we apply for the next year, fourth year, we get 7778. And what is the closing balance? 1778 minus 778, we get 1000. So whenever we have WDV based calculation, how do? We calculate the rate as 1 minus residual value by cost under root of useful life. That rate, whatever we get, if we apply this, we get the closing residual value as 1000. Okay, this is only for your understanding, and if at all when you start working in your articleship and all, if you have to calculate, you will use there. Institute has not been testing these things in the examination, but it is important for you to understand how do we calculate these items. Let's look at few more questions. An entity acquires the right to use an underground cave for gas storage purposes for a period of 50 years. The cave is filled with gas, but a substantial part of that gas will only be used to keep the cave under pressure in order to be able to get the gas out of the cave. It is not possible to distinguish the gas that will be used to keep the cave under pressure and the rest of the gas. Evaluate whether AS10 would apply or accounting standard 2 would apply. Okay. Now here what is happening? There is a right to use an underground cave for gas storage. And what you will do? You will extract the gas from that thing and you will sell it in the market. Now, generally to such gas storage and all which are wasting assets, you will not apply AS10. But what they're saying, they will use a substantial part of the gas to keep the cave under pressure in order to be able to get the gas out. So, if the cave has 100 units of gas, let us assume 30 is kept permanently. 30 we will not use. 30 we will not even extract. That 30 is required to be kept so that you can extract the remaining gas. So that 30 which is permanently kept is like a dead stock that is required for you to operate the extraction. So in such case, what do? This 30 is treated as property, plant and equipment under AS10, and the remaining 70 is treated as inventory. As per AS10, certain items of PPE qualify for recognition because they are they enable an enterprise to derive future economic benefit from related assets. The total volume of gas must be split into gas held for sale, that is AS2 treatment, and gas held to keep the cave under pressure. How much gas, how much of the asset you need to keep the cave under functioning, that part will be recognized as PPE. Next, entity operates an oil refining plant. For the refining process to take place, the plant must contain a certain minimum quantity of oil. This can only be taken out once the plant is abandoned and would then be polluted to such an extent that the plant value is significantly reduced. Evaluate whether AS10 would apply or AS2 would apply. So the portion of oil which remains in the plant should be treated as per AS10 and the remaining part should be accounted as per AS2. Meaning to say, we are operating an oil refining plant. For the process to take place, it must contain a minimum quantity of oil. So the tank must have minimum quantity of oil. That oil we cannot use it subsequently, we cannot extract it subsequently. So that oil will remain as it is. So it is like I am incurring some cost to buy oil or produce oil, which will be kept in the plant, which will ensure the plant is functioning. So If for example you consider this to be the tank, the water which has to be there minimum, okay, below which it cannot fall down, the cost of this water is required, or the portion of this water is required for the enterprise to get future economic benefit from the overall plant. So the cost of this water is treated as property, plant and equipment as per AS10. Now this you may find it illogical, sir, how can stock of water be called as plant? It is not just about the stock of water or whether it is a machinery. It is like it is an item that will be there, it is required to run the business, and hence it is a part of PPE. Entity A carried plant and machinery in its book at 2 lakhs. These were destroyed in a fire. Assets were insured, new for old, and were replaced. Okay, there is a machinery got damaged. Insurance is new for old, means even if the old machinery gets damaged, we will get new machinery. It was replaced by the insurance company with the new machines that cost 20 lakhs. Machines were acquired by the insurance company and the company did not receive 20 lakhs as cash compensation. How will the entity account? So this is like exchange of asset, but because this is related to impaired or damaged asset, the treatment is slightly different. Now one is 2 lakhs of machine got damaged, so that's a loss. I will book the loss. And the moment insurance company confirms I am giving you 20 lakhs worth of asset, that I will recognize as a gain. So first I will recognize P&L to plant 2 lakhs for loss, insurance company to P&L for the gain portion, and whenever we receive the new machine, we will record it at 20 lakhs. Now here, it is not advisable to record the machinery at 2 lakhs, that is the value of machinery given up, because what we are getting is completely different. It's a significantly different thing, and you cannot say that, the old value is reflective of new value. That is why we are recognizing the gain based on the new valuation. Entity A should account for the loss in the P&L on derecognition of the carrying value of plant and machinery in accordance with AS10, and should separately recognize a receivable and a gain in the income statement resulting from the insurance proceeds under accounting standard 29. All right, in accordance with accounting standard 29. Now, if you see, some questions are computational easy, somewhere you have to write the theory, and that is why theoretical and conceptual understanding is very, very important. And AS10 has now gained significant importance in terms of your being tested as a part of MCQ as well.